first quarter, which is just about completed. You had earnings, you had margins at record high levels. Part of that's benefiting from higher inflation. A lot of those costs are getting pushed through. But ultimately, it's really companies that are investing for growth have been outperforming.
Well, what's up, guys? What's up? What's up? What's up? It is Thursday, and it is one hell of an interesting last, like 14 hours, something like that. I don't know. Um, just like yesterday had nothing to do with the crypto market. It was all about the terrible stock market. Today is going to be the opposite. It's going to be back all about the crypto market because, just as I have there in the thumbnail of this in title, um, if you happen to not be aware, Elon Musk decided to
Largest companies in the market: Amazon, Apple, Microsoft, Google, Facebook. Those five companies comprising around 20,
Elon
22%
Musk decided
of
to
the equity cap. Record amount of concentration relative to history, other than last fall when
make
it hit
some
around 20%.
comments and change the policy that they had about
Arithmetic are going to drive the overall averages. And so what did you see with
about
these companies?
the
Sales up 40%
Tesla
in the
and
first
their
quarter.
not their investment,
Rest of the market,
but
sales,
their
up around
decision to
8%, 9%
accept
in
the
that
not
range.
Bitcoin,
So
sorry,
the
investment in
data
Bitcoin, their
would
decision
suggest
to
the business activity is really, really strong.
accept
I think
Bitcoin
the
as a payment
durability of the
on
business
their
was
cars,
reflected last
which
year when they really
I think they
already
said
had
they were
sales
going to do
down
maybe
in the
a
second
couple of
quarter
months
last
ago,
year,
or
down
maybe 2 months
7%.
ago, something
These
like that.
companies had 18%
Maybe 3 months ago.
positive
It's been a
revenue growth.
while,
So I think the
but it was
story
earlier this
of
year.
these companies is
And
the
at
durability
the same
of their
time,
business models.
Tesla
And
goes
then
over and
more
guides.
important is looking forward. I mean, that is the question we're
Funny
going to be
enough, they
focusing on in
$2
terms of
million
managing the portfolios, working with
of
clients, and the idea of these
of
companies
Bitcoin just to
investing
hold and have on the balance
extraordinary
sheet.
amounts of money
And of course,
reinvesting in their
huge
business. The typical
uh,
company in the United States
increase in
reinvests maybe
it led to a
11%
huge increase
of
in
its
the
cash
price of
flow from
Bitcoin, which
operations
you
to
could
grow their
make an
business.
argument as
That
a
is to say,
complicated
growing in the form of
situation, but
capex and
at the same
investment
time,
in R&D.
they weren't going to have,
Also,
I
the
think if they
11%,
did, they would
these
have been in
companies
some
are like
serious trouble with the
65%.
SEC.
Most of their cash flow goes
And
back into the business. That
really
is
all
a
they did
real
was just
differentiator when
save
you
and
think
maybe
about the business outlook for
investing
2022.
in something, just made
Market's already charting very
a
focusing
financial
on earnings
statement
growth for
about the
next year,
company. They
and
didn't
companies are investing
say
this
anything
year.
like,
Best
hey,
position
we're
going
investing
into
here and
next year. So I think
we
that's
want
how
you
I
guys
would
too
think
as
about
well.
it in
Right?
terms of
Nothing like
those
that.
big
So
stocks, Morgan
as long as they didn't put anything like that, yeah, it is a fun strategy, sure, but it's not gonna happen. But doesn't mean that it can't just be kind of an innocent arrangement. Having said that, now after they invested in it, then they said they would start accepting Bitcoin as a payment, and now they're saying they're not going to accept Bitcoin for payment anymore. And the thing I see here as being a potential long-term risk is not just that they've made this comment about them not accepting payment. That's one thing. The real challenge is the reason why they're accepting, or why they're doing it. They're not doing it because they have faith in it, or just because they decided they want to go a different direction. For whatever reason, they've decided it's not some random decision about their company's operation or their faith in Bitcoin. It isn't, and they are just not saying the right thing. They said the reason why they're wanting to stop it is because of the environmental risk related to uh, the environmental risk related to the mining of Bitcoin. And although that is okay, maybe a legitimate concern, I'm not saying it shouldn't be a legitimate concern. I think my concern about the legitimacy of that concern is twofold. One of them is you knew about, well, security A, you knew about that 3 months ago when you made this decision. Like that nothing changed between now and 3 months ago. You decided to do this as far as the environmental concerns. So that's it. Secondly, which I know this one kind of gets into a debatable topic, is that the
Speaking of
sure
rising
the
rates,
mining of
David,
Bitcoin
Fed funds
um,
futures are now
may
pricing in
have a
80%
lot of
chance
environmental
of a
impact
hike in
because
late
they're mining
22. It
lithium,
was 66
which
just
is
last week. I guess
creating
I'm wondering,
batteries for these
how
cars,
should we think
also
about
has
those odds
a,
if in fact these bottlenecks are going to tighten
a large
or make
impact.
things a little bit tougher on the supply side for the next
And
couple of months?
I
So you
just
go
find it
through, as we did on the conference calls and all the transcripts
interesting,
that just took place for
I
the first quarter
suppose.
results
Do
for
I
all
want to say
companies,
that?
and they were
Do I want to say
talking about the idea of bottlenecks
I
and
find it
price
interesting
inflation, and
that
but they're also
that
talking
the
about the recovery
company
in the
that
economic
is
activity. So there's sort of two halves of that car. We can look at it as, yes, there's pricing
uh,
pressures and there's a
that
disruption on the
it has
supply
those
chain, the Port of Los
potentially
Angeles and Long Beach, and the train
negative
transitions and through cargo
environmental
transportation, and
side
all these
effects
issues
of
are
their
definitely
operation,
real,
like
and they're present, and they're current
Tesla and the
issues.
lithium
They'll
mines
persist
and
for
all that
several
stuff.
months. Our argument, probably for 6 months, based on the
Also,
conversations I have with
is
executives,
now
is expected to be there. First, and that is,
criticizing Bitcoin.
that's also
For
reflective of better
what I
economic
see as the
activity and
serious
higher
concern
earnings.
here
And so it's a trade-off between the
is
valuation and the
the
earnings growth.
people
Our argument, or my
that
argument, is the earnings. It's really an
is
earnings story
could this
as a
be? I mean, we
recovery.
know
And
that
then thinking about that
Tesla, we
in
know
terms
Elon
of
Musk
cash
has
flow. Where
such
do
a
companies direct
large
their
hand
money?
in
I
this.
mean, we're
The reason
looking
why
for
I say that it's
45%
a
in cash directed towards cash
give and
M&A.
take of the way
We'll
is
be
because
happy about that.
his
Record
this
market
individual
activity in the
move
fourth
has
quarter and in the
brought
first
down
quarter.
the
Likely to continue
Bitcoin
in
market
terms of
down to
companies. And the
even
same
if
thing
it's
for
low
companies
last night. I
investing
think
for
the
growth.
very brief low of
All right.
46
Well,
something
David
thousand,
Kostin, thanks for joining us to kick
47,000
off
something
the
like
hour
that.
here.
Coming
The
off
S&P is up
originally high
1.3%.
again, what, 3 or 4 weeks
As
ago
we head to a quick
before
break,
Coinbase
here's a look
launched.
at our roadmap for the rest of
65,000,
the
a
hour.
huge
After a 6-day shutdown,
plus more like
Colonial
65,000
Pipeline says
yesterday, but it
all
had
of
a
its
10%
markets
drop
should
just from
receive
some
product
announcements.
by midday.
And
Just what are the broader energy sector implications?
what
Well,
I
let's
worry
talk
is
with
that
the
if
CEO
they
of
are
Pioneer
making a
Resources.
statement that's an
Plus, is
environmental
it
risk,
time to buy the
and
tech dip?
it's an environmental
Amazon,
risk
Microsoft, all
no
rallying,
matter
of
what.
course. We
It's
just
not
talked to
just
David about that
whether
rally,
they
in fact, call.
currently think it's environmental risk. And if it's
And
truly
crypto
environmental
crashing
risk that's
following
causing
Elon Musk's Bitcoin
it,
reversal.
then
We're going to decode that move
the
later on this hour as we got the
challenge
best
here
day
is
for
more
stocks in at
along the
least a
lines
month.
of
Squawk on the street. I'll be right back.
is it is this a larger thing in this giant social movement away from Bitcoin due to its environmental risk? And it's not just one company making this comment. That I think is a concern that if there's going to be a long-term risk and ripple effect, it is, and they're going to, is this going to open the eyes to the, uh, environmental quality regulators and things like that? I really don't know, but I think that's a big concern to consider here. That it's not just about Tesla and Elon Musk. Is whether it's really whether or not their influence will actually change the. I mean, look at it in the diamond world. I think the diamond world is a good comparison here. Diamond world is, it's an infinite resource type of thing, and there's been this huge push for mostly for human rights, but a little bit environmental rights of or environmental risk to not buy diamonds from certain areas, certain the blood diamonds and whatever you want to call them. And so because of that, we've seen a huge push away from certain, whether it's De Beers or some of the other diamond mines, and more towards the ones that either create diamonds safely, conflict free, whatever, or even towards the synthetic and lab created diamonds are now becoming more commonplace due to those concerns. So could we be seeing the exact same migration of Bitcoin where it's going to go from, being this thing that no one's really thinking about it as having environmental risk? Now it does have an environmental risk and potentially a human rights risk because a lot of these giant diamond or Bitcoin farms are in China and Russia and other areas of the world where they're less concerned about things like environmental and human rights. Um, could that become a thing? Could there become a giant worldwide movement against Bitcoin due to its human rights and its environmental risk? And if so, could that be the beginning of the end, at least in this iteration of Bitcoin, until they fix that? I really don't know. was expecting Ethereum to have a similar issue. Ethereum also has an issue where there is currently no cap on the number of coins that have the original Ethereum, and they're saying that maybe on the new Ethereum 2.0 they cap on that. They're going to be more environmentally friendly to mine. So that's becoming something that Bitcoin or Ethereum has tried to pivot to, but not so much on the Bitcoin side. So I haven't heard about those. So just all around interesting things. So of course today we are watching their we're watching Bitcoin. So let's see what we got Bitcoin on the top. You can see there's a huge drop right here in volume created, and then it just kind of chilled here in the bottom. You got some second wave drop over here. I'm not sure why that second wave happened. Tesla comments and announcement was made right here. Let me see timing wise. I didn't really see anything timing wise. It's a new coin, obviously, on the Bitcoin side. But anyway, something happened right there at 7 o'clock p.m. here Central Time. It's 5 o'clock Central Time, and then it started to stabilize, and it's since been hovering around 50. I think it dipped around 45. So it's been hovering around 50 ever since. It's not Death Star to Bitcoin, but it has hurt it. Ethereum kind of did the same thing with all its partners. You can see Litecoin coming in at seriously. This is again not trust, so it's not minute for minute dollar, but it is. It also has a dip in the middle. Ethereum just flying high yesterday from 4,400 to 3,600 ish in one in the same 24 hours, which is a 20-ish% drop. Absolutely insane. So it's no longer at its all-time high of 4,400, but it has bounced up to 39. Tesla, we also saw that there was an issue there. So look at this. Look at the same time. So Tesla made that announcement. Let's do this. Let's go to 5. They made that announcement right about. Must have been right. No, it couldn't have been right there. That must have been when they went to it. Anyway, it was right here. It's hard to really see, but right there. And really, if you look at this from right post market, middle of the night, it had almost the exact same track as Bitcoin. It bottomed out way down here at like 570 something like that. And then it started to drop back up. Had a really good surge first thing this morning, over time. And then it's making a comeback, but it's still below 600. I still think it's coming back up. It's kind of in recovery for us in the market today. It's doing all. As you can see, I've got two futures here in the middle. It's up 4%. The Nasdaq's going to trade 1.1%, 1.2% right now. I haven't even opened it in the past half a bit, so it's looking okay. So I think Tesla's recovering because of that, but it's also not recovering by much. It's only up 0.5. Only up to 592. Not recovering as fast because I think a lot of people are upset about the Bitcoin move. Is this a question of Tesla's ability to effectively do things? Is this an issue with Tesla's balance sheet? Is this a strategic play where they're going to make these comments? And it's not saying they're going to sell Bitcoin. They didn't make any comments that they were going to sell their Bitcoin. They only made comments that they were going to accept Bitcoin payment, which they could clearly just say that because Bitcoin's too important. And all that's going to do is they're waiting for it to drop to 40,000. They're going to go in and buy another $1 billion worth of Bitcoin on their balance sheet. It's just a classic strategic financial move by Elon. So there's a lot going into this move actually means. So anyway, that's kind of where we're at. Let's take a peek at the market here. Yeah, Nasdaq's up 3.5%. Well, 1.37. So it's off high 0.5%. Nasdaq up 1.26. Dow up 1.31. I wonder if there's going to be some sort of a true recovery, or if it's just going to be kind of a Wednesday, Tuesday, where it's just a bounce back recovery. Volatility index is dropping like a rock today, but that's expected. Treasury yield way up yesterday. It's down slightly to 1.2 or 1.274 now for today, which is good news. That is helping the rest of the market. Most things are up. Oil and stocks are slightly down for the inverse from yesterday. Seeing some good news. Bitcoin's up 6%. Zoom not up as much as I'd like it to be, but it's up 1.3%. EXTI, same as Zoom, up a little bit, not as much as I'd like. Sun up 2.5%. But okay, so pipeline stocks like energy trades were up 3.66%. Next thing got fell slightly. So that's good. And we also have power real estate. I love that stock. Oh man, look at AMC. Man, I took AMC off the big board. Now I need to put it back on. It's the only Bitcoin that can put AMC in base here. Okay, 11.9 years. It is good looking. Might have opportunity to get back up to 12.13. It looks like we might be there, which is fantastic. A lot of the other meme stocks are also surging. Express up 8%, BlackBerry up 1, Bed Bath & Beyond 1, Office up 3. Nokia, that's the best. Interesting. The downside is we are back up 1%. Just going to our markets and marketing for very long time. Voyager surging back. We are looking very long. It is surging back 7% since it's possible. Oh man, so I mean, today looks like it's going to be a good recovery day in the high growth stocks. I feel it's going to be similar to how Tuesday was, where it's going to be good, which is great. But you know, we're not going to get 3% back. We lost 3%. That's hopefully we can get something moving there out of AMC. That would be fantastic. AMC switch back up to 13, $14. Listen, 12.43. So AMC is on right now. I am super happy about that. I've owned AMC at 12.94.
David, as we go to break,
It's
shares
pretty
of
good.
Alibaba on the move,
Been
close to the
dying to
lows
get out of that
of
stock.
the year and almost 1 year low here
I
after
need to.
reporting an
I want to
operating
put
loss
profit on it.
since
And,
going public. The cause, of
you
course,
know,
is that
similar to
anti-dumping
GameStop,
monopoly
get out of
fine
it.
of almost $3
Lost in
billion
there for a while, and then
by
can
Chinese
get
regulators.
back in
Let's
at a
walk on
good
the street
time.
comes back in a couple of minutes.
Also
Stay
get some
with
of
us.
that capital back. So 180 shares times 12. That's $2,100 of money I can get back to put against the margin I have. So that would be a fantastic one to cash all out on if it keeps going up today. I'm looking forward to that. Anyway, going to keep an eye on that one as well as the rest of the cryptos. Let's turn it back over to the news, and I got some work to do over here. And of course, they're a commercial, but they'll be back in just a minute.
Bitcoin did fall below 50K today in the wake of that move by Tesla. We're going to decode that later on this hour. After the break, though, Bernstein forecasting a potential $10 billion problem for Apple as those shares are on the rise after falling below the 200-day for the first time in a year. We'll talk to the analyst behind the call next.
All right, guys, hate me if you want. I really don't care. I have changed my limit orders on AMC. I own 180 shares. I've put in a sell order for 179 of them. Sometimes I like to keep one share of a stock just to keep it on my list at $12.99. I currently own it at $12.94 on average, dollar cost averaged. So I would at least get all my capital back, except for what, $3. So if it goes up to $12.99, I mean, if it peaks out here at $12.14 and goes back down to $10.50 by the end of the day, then I may change that limit order, right? But since it's surging today, it might be a good opportunity to just get out, get that capital back. Again, the real reason why I'm doing it is I've had that money tied up now for 3 months. It hasn't done hardly anything, and is in my margin. So I need to get that capital back, pay it against my margin, and then we can, move on. Redeploy that money elsewhere that's a little going to make me some more money. And then if AMC crashes back down to 7, then maybe I'll pick it up again. Just like I said with GameStop.
I'm Seema Modi, and here's your CNBC COVID update. India's death toll remaining above 4,000 for a second straight day. A lack of oxygen contributed to the deaths of at least 37 people at 2 different hospitals, according to local media reports. British Prime Minister Boris Johnson admitting the government is anxious about the highly transmissible Indian variant spreading in the UK. Officials are worried the strain could upend plans to ease restrictions in June. The president of the second largest teachers union in the U.S. will reportedly call for all schools to reopen for full-time in-person learning this fall. And the International Olympic Committee supports Japan's mitigation measures and is confident that Tokyo Olympics will be a historic event despite public opposition. SoftBank CEO Masa Son telling Squawk Box this morning he's afraid.
I am very much afraid of having Olympics. I don't know how they can support sending athlete.
He's not the only one questioning the government's decision to move forward. Morgan, I'll send it back to you.
Seema Modi, thank you. We're about an hour into the trading sessions. All the major averages are bouncing back after the losses we saw to start the week. The S&P is up 1.4%. Let's take a look at the biggest leaders on the S&P right now as well. It's Lam Research, it's Applied Materials, but it's also Nucor, a steel name, and Ralph Lauren as well. In terms of the laggards, all of the major sectors are in the green. Energy, though, is the underperformer, and perhaps not surprisingly, it is largely energy names that are in the red on this first hour of trade, David.
Yeah, and Morgan, of course, as you know, a lot of the large cap technology names have been amongst some of the worst performers during this sell-off until today. Josh Lipton joins us now with a look at where people might want to put their money. Josh.
So, David, let's start with Apple, which is higher right now, but we know, of course, it has been a rough stretch for the iPhone maker, closing yesterday below its 200-day moving average for the first time in more than a year, on pace here for its worst week since late February. If there's a rotation out of tech, then Apple is going to get hit. Also, though, some investors do question whether the company can really sustain the tremendous momentum it's seeing. Bulls like Gene Munster of Loop Ventures counter that Apple is a buy, though. There's a big pool of iPhone fans, he says, says they will continue upgrading, especially as the 5G rollout continues. And Munster bets that Mac and iPad will continue showing strong growth in the quarters ahead. Another area to watch, the semis, with the SMH also higher in early trading here, but on pace for its worst week since March of last year. Bernstein's Stacy Rasgon says the pressure is not that surprising. Valuations became stretched after remarkable runs, and during the earnings season, there was a lot of hot talk about continued shortages and supply constraints. Having said that, Stacy remains a believer in the companies that make the equipment used to manufacture chips. Applied Materials and Lam Research, he says, are buys. Finally, take a look at the Hero. That's the ETF that tracks the video game industry, trying to avoid its 11th day of losses in the last 13 sessions. Zynga, Take-Two, Activision, and EA, all now underperforming the market over the past 12 months. But Andrew Urquhart over at Jefferies bets that these game makers will keep growing on the back of strong content and solid pipelines. And valuations, he says, now look very reasonable. Andrew is a fan of Zynga, Activision, and EA. Back to you all.
Josh, thanks for that. It's a good place to start with our next guest, who's got a new call on Apple, seeing some potentially worrisome trends and similarities between the cycle on the iPhone 12 and an old cycle with the 6. Let's dive in further with Bernstein senior research analyst Tony Saganaki. Tony, welcome. Good to see you again.
Thanks for having me. Good morning.
It might take some reminding of our viewers what happened with the 6, because it actually was good for a while and then created some problems in the cycles to follow. What's your call?
Sure. So our observation is that there have been 3 pretty strong iPhone cycles over the last 7 years. The iPhone 6 cycle, when Apple introduced the first larger screen phones, that was a very strong cycle. The iPhone 10 cycle in 2018, where Apple introduced no Face ID, Face ID, and removed the home screen button and had edge-to-edge displays. That was a strong cycle. And then the current cycle, the 5G cycle. All of these cycles have had notable similarities: double-digit iPhone revenue growth, strong improvement in selling prices for the iPhone, and strong growth in gross margins. All 3 cycles have exhibited these characteristics. Our observation is, if we look at the 2 previous cycles, similar cycles, the 6 and the 10, was that the following year, the iPhone and Apple really struggled. In both cases, iPhone was down double digits. Average selling prices were flat to down. Gross margins were pressured. And perhaps most importantly, Apple's stock fell by 30% or more in both cases. And so we certainly don't know what next year's cycle is going to be, but our observation is when Apple has had strong cycles, it's typically because you have their most enthusiastic users upgrading, particularly in China and other areas of Asia. And that's exactly what we're seeing again this time.
I guess, Tony, the question would be what's different this time, whether it's the degree to which services make up a larger part of their business, whether or not the multiple was any different distance away from a market multiple. Are there any things that might ameliorate that if, in fact, this were to repeat?
Sure. So services is definitely a larger portion of Apple's revenues today, and that would mitigate fall-offs in iPhone. I think, on the other hand, though, the Mac and iPad businesses have been doing extremely well this year. They were both up over 70% last quarter. These are businesses that have struggled to grow over the last 5 or 6 years. So while we think services will continue to be strong next year, the challenge is not only about iPhone, it's also about the Mac and iPad businesses, which have had explosive years this year, in part because of COVID and work from home and learn from home. And so that's sort of the double challenge that Apple faces looking into fiscal 22.
It's David. When was the last time you were positive on Apple, had a buy rating on the stock?
So we had a buy rating on Apple for about 9 years, and we downgraded the stock about 2.5 years ago.
Okay. And what would be an appropriate multiple then on your fiscal year 22 estimate to get you to sort of a point where you would think it warranted an overweight?
Yeah, I think that's a great question and one that we struggle with. The multiple has come in a lot since the beginning of the year and since September of last year. Apple's earnings have actually improved and the stock price has gone down. So the multiple, which was closer to 30, is closer to 23 now on 22 numbers. And so that actually makes us, all else being equal, more positive. And so I think we have less concerns about valuation. Apple's trading at about 10% premium to the market today. Historically, it traded at slightly below a market multiple. So the valuation is really not of principal concern. I think where we struggle a little bit is just timing. If there's a risk that numbers could go down next year, it's hard to see the stock being a notable outperformer. I think if ultimately estimates come down or the street becomes more aware of the possibility of a weak next year, then I think the risk reward on Apple becomes more favorable.
Okay, Tony, let's talk Tesla. Given the role that it played in its most recent earnings results, what does the Bitcoin backtrack do to Tesla?
You know, look, there are different forces at work here. What we heard loud and clear from investors was many of them like Tesla because it's an ESG play. And buying and owning Bitcoin was antithetical to that. And so I think, you know, to its credit, Tesla realized this discrepancy between, you know, there being a company that's looking to save the planet and yet holding a currency and accepting a currency that requires, you know, tremendous electricity and has a negative carbon footprint impact. And so I think they've done the right thing by acknowledging this discrepancy. I think for the company itself, we could argue that's, you know, that's a positive in terms of ESG investors' eyes. I don't think a lot of people were buying cars with Bitcoin. So I think from a business perspective, there's not really likely to be any material impact on Tesla.
Tony, wish we had more time. There's obviously a little more wood to chop on both Apple and Bitcoin. We'll save it for next time. Thanks so much. Good to see you again.
Thanks for having me.
We are keeping an eye on shares of Vroom. This up after a beat on the top and bottom line, driven by strong demand for used cars as the global chip shortage continues to impact production of new vehicles. So what do? You buy a car that's used. We'll be right back.
It's time to get defensive in tech, says one longtime investor. Get his strategy for trading the pullback on tradingnation.cnbc.com. More Squawk in the Street coming up.
Yeah, look at AMC. I might actually get to sell that today. I thought this dip was going to take it back into the 11s, but right back up to 12.29. Again, I got that sell order in there at 12.99. Man, was not expecting to get there today, but if it does, I will absolutely take it and get that.
It is time now for our ETF Spotlight, and we are taking a look at Cathie Wood's ARK Innovation ETF. The ticker symbol there is ARKK. Of course, it is down more than 17% since January. Many of the names that it owns, including high-flying technology stocks, well, they're getting a bit of a boost today. You can see it. The fund itself is up 0.27%. Wood making headlines this week after she added more than 3 million shares of Palantir to the fund. That just over the last 3 days. Of course, a longtime Wall Street Bets favorite. It is down about 20% since April, but as you see, a bit of a gain as well today, though both below the market's overall gain, Morgan.
That's right. Well, checking in on shares of Lowe's, meantime, Oppenheimer upgrading it to outperform with a price target of $235. That stock's up 3% right now. The firm saying shares are at a discount despite a strong business model. So buy now. And after the break, Silvergate Capital's CEO is going to join us to talk crypto volatility, their new partnership on Facebook's backed stablecoin, and so much more. Stay with us. Welcome back. Silvergate Capital announcing a partnership with DM Networks, the Facebook-backed digital currency project initially known as Libra, to be the exclusive issuer of its U.S.-backed stablecoins. Silvergate Capital Corporation CEO Alan Lane joins us now in a CNBC exclusive interview. Alan, welcome to the show. It's great to have you.
Thank you, Morgan. It's great to be here.
So much to get to, but let's start with this news of the day, the fact that you are partnering with Diem. We've seen the aspirations of Diem paired somewhat and abandoning the approval process in Switzerland, focusing more exclusively on the U.S. market now. Tell us about how this partnership came about, how far you are in the regulatory approval process, and what this ultimately means for business for your company.
Sure, happy to do that. So we've actually been working with Diem for the last several months, initially when they were in fact working on the FINMA license. And we just could not be more excited to be where we are today. We worked together with Diem and with the our various regulatory agencies that we deal with as a California state chartered bank and a member of the Federal Reserve. And you know, we've brought this to the point where we felt comfortable making the announcement. As we said in the press release, we do still have a little bit of work to do, but we've chopped a lot of wood and we're almost there.
So at Silvergate, I mean, you're one of the first banks, if not the first in the U.S. to start to work with the cryptocurrency community almost a decade ago now. Silvergate Exchange Network certainly seems to be a big focus and a big draw to your cryptocurrency clients. I assume that is what Diem is going to be operating on. What does that specifically look like? And in general, how does it speak to the growth of what has essentially, at least according to some of the reports I've seen, become something of a clearinghouse, 24/7 clearinghouse type service?
Yeah, I appreciate the opportunity to talk about what our customers call the SEN, which is the acronym for the Silvergate Exchange Network, which is, as you pointed out, it is a network. Importantly, it's not an exchange, but rather it's a network of exchanges where we connect the digital currency exchanges such as Coinbase and Gemini and Bitstamp, and we connect them to several hundred institutional investors who are trading Bitcoin and other digital currencies as an asset class. And I believe you're right that we were the first bank in the world to bring the legacy financial system that only operates during normal business hours, Monday through Friday, and to bring the banking system into the 24/7 digital currency market that trades around the clock, around the world. It never sleeps, and neither does the SEN. So we are the regulated on-ramp and off-ramp to move US dollars into the digital currency ecosystem and then to move it back out into dollars. And it is API enabled 24/7, as I mentioned. And I think it was that technology and the duration of time that we've been working with our regulators in this industry that was really attractive to Diem. And you're absolutely right. That is what we will be doing, is using the SEN and our API capabilities to mint and burn the Diem US dollar token.
Alan, I hate to throw the Bitcoin environmental impact hot potato in your lap, but I wonder, because our viewers are hearing very disparate opinions, one, that the emissions are comparable to, say, the federal government. On the other side, this idea that over time the net impact on fossil fuel consumption is actually negative, all things considered. I mean, where do you come down on it? How do you advise a viewer to try to understand that?
Yeah, Carl, I appreciate the question, and you wouldn't be doing your job if you didn't ask. And you know, we are very aware of the concerns regarding the environmental impact, and I think you know, we focus a lot on how are our customers using the digital currencies, the various digital currencies. Obviously, Bitcoin is taking a lot of heat right now. I would point out, you know, Elon's tweet last night and the fact that he said they're no longer going to be accepting Bitcoin to buy a Tesla. However, they're not selling their Bitcoin, at least not yet. And so, you know, at the end of the day, the Diem token, which is the big news, you know, as Morgan indicated that we announced yesterday, that is a separate, it is absolutely a dollar on a blockchain, but it is a permissioned blockchain that is essentially a payment system that will enable users around the world to transact in this digital ecosystem. And the jury will ultimately judge on the Bitcoin front whether or not Bitcoin is whether the usage of energy for to support and secure the Bitcoin network is an appropriate use of energy. We certainly believe it is, but I'm as worried about the environment as anybody. I've got 5 kids and a whole bunch of grandkids, and I want to leave them, with not only with a healthy planet, but also with a healthy financial system. And that's what we're trying to do at Silvergate.
Yeah. Alan, I mean, what you said about Diem, I think is so crucial, because when you think about recent comments from the Fed chair, who basically called these cryptocurrencies vehicles for speculation, said they're not really actively used as payments. We heard similar comments in recent months from the Treasury Secretary, Janet Yellen, as well. This value proposition around Diem as exactly that, a vehicle for payments. Does it happen? Is this a monumental moment in terms of the broader use case and adoption of cryptocurrencies and stablecoins?
Morgan, we believe that it absolutely is. And it's, as you mentioned, we've been doing this. We've been intentionally banking businesses in this digital currency ecosystem for the past 8 years. Our customers, as I mentioned, include clients such as Coinbase, who Coinbase is a member of the Diem Association, as is Kiva, who's also a customer of ours, Shopify, Andreessen Horowitz, Lyft, Uber. These are platforms that have millions and in some cases billions of customers who will ultimately have access to this form of being able to pay for things. And I think it's going to really bring the bring the barriers to adoption for a digital currency down and ultimately make it equal access for all.
Alan Lane, thanks for joining us today.
Thank you for having me.
Coming up on Tech Check in a few moments, do not miss Bumble's founder and CEO, Whitney Wolfe Herd. The company swinging to a surprise profit, but at $43.85, that's a long way from the opening day trade of 76. Plus, that Bitcoin move, AppLovin's CEO, and a lot more starts at the top of the hour. We'll be right back.
Markets are rebounding, to say the least, after the sell-off we've seen the last few days. Let's break down the action with senior markets commentator Mike Santoli. Mike, look at that S&P up by 1.6%.
Yeah, in fact, all three major indexes up about the same percentage across the board. Maybe suggests a little bit what we have here to start is a pretty mechanical bounce. The NASDAQ in particular, very, very oversold short-term technically. It should have bounced. We have bounced right now. The S&P now back up to a level where a couple of days ago, everyone was saying, oh, we hope we hold above that level. And so now it's just a little bit of the typical testing back and forth. I think that one of the key things is in the sell-off in the last couple of days, there was no real indication it was anything bigger than an equity repositioning shock. In other words, it wasn't credit stress. It wasn't things going on in macro that really seemed to feed into economic fears. It was mostly a what are we going to pay for earnings in this environment, maybe when crowded positioning and inflation is on an uptick.
What's the VIX telling us right now, Mike?
Well, there was actually a little bit of agitation evident yesterday. It was probably up a little more than you might expect, up into the high 20s. And the fact that it's coming down in a relatively pronounced way could mean that we basically have a little bit more of stability returning to the market. This is the fourth 3 to 5% pullback in the S&P 500 so far this year. So essentially, almost once a month, we have seen the VIX go up into the mid to high 20s or even above 30 each time. So it's kind of acting the way you would expect. There was a little bit of concern, though, about some of the dynamics yesterday with very, very, very hedging demand. That could be a contrary indicator, or it could say people are positioning for maybe more of a choppy phase. After all, we were up 90% in 13 months in the S&P.
And Mike, as this day moves along, any group in particular that you're paying closer attention to see if this is sustainable?
I would still keep an eye on semiconductors because they've led both directions, on the way up, on the way down. They are also very oversold. In other words, they kind of should be bouncing and maybe outperforming today. So that might be one area to keep an eye. Also, the bond market's not really telling us much right now. The yields are kind of stable, and so that's giving the equity market time to sort things out.
Yeah, that was exactly where I was going with my next question to you, Mike, is what the bond market is signaling or not signaling right now, and just in terms of what key technical levels could be there. I realized we had another hot inflation report this morning, specifically on the producer side of things. But
yeah, hot but not unexpectedly so.
Exactly.
Really, I guess that's kind of the key.
All right, Mike Santoli, thank you. That's going to do it for us here on Squawk on the Street. Tech Check starts right now.
Happy Thursday. Welcome to Tech Check. I'm John Fort with Carl Quintanilla and Deirdre Bosa. Ahead this hour, Elon Musk slashes Bitcoin's tires. Does the crypto trade ride on one man's tweets? Then, tech bounces back in another volatile day for stocks. We're to look for safety and opportunity in today's session next. And finally, Whitney Wolfe Herd, the Bumble co-founder and CEO, joins us later this hour, post-earnings. Carl?
John, as you said, stocks are rebounding this morning in a somewhat volatile session. Large cap tech stocks back in the green as investors find reasons to buy the dip. Three big gainers this morning on the QQQ. Today on your screen, D. We're going to watch all of that.
We will, but we have to start, Carl, with Bitcoin and the speculative tech trade we've been discussing. The split between big cap, FANG names, and the smaller speculative, call them Cathy Wood, ARK stocks. Bitcoin, crypto, has been soaring while stocks like Peloton, high growth cloud names, recent IPOs and SPACs all have seen their valuations plummet. Bitcoin still up more than 70% year to date. Look at ARK's main fund, down 17%. But today, this is all inverting. Bitcoin is actually crashing while Peloton is right, the best performer in the NASDAQ. The culprit, one man, Elon Musk, turning on Bitcoin, calling the environmental impact, quote, insane, and says Tesla will stop accepting it as a form of currency. Bitcoin diving by as much as 17% overnight. And UBS, guys, writing in a note to investors, if one person can dramatically alter spending power, the stable store of value criteria of a currency is not met. But I don't know, Carl and John, maybe that is overstating it. I remember when Tesla bought Bitcoin and started accepting it, it was thought that this was this big mainstream moment when we'd see other corporations follow. Yes, we've seen more institutions get involved, but we didn't see companies buy in a huge way. So perhaps his backtracking isn't the big moment that it is feeling like it is today. And perhaps this is just something that happens when you have a transformative technology, 2 steps forward, 1 step back, or 2 forward, 1 back.
Well, forgive me for being a Sunday school nerd here, but this reminds me, Elon and crypto of Moses and the Amalekites. It's like when he raises his hands for DOGECOIN, right? It goes way up, over weeks. And then when he puts his arms down, oh boy, on SNL, it's a bit of a hustle, then it goes down. Tesla buys up. Tesla's, not into it anymore. It goes down. It does raise questions about this, but, about the environmental impact is an interesting piece in Harvard Business Review last week by Nick Carter, VC, not the Backstreet Boy, that dives into this. We can get to that later in the show, but his reasoning might not hold up, Carl.
It's going to be interesting in terms of the institutional acceptance deed that you're pointing to. We should point out Mark Cuban. We at Mavs.com will continue to accept Bitcoin, Ethereum, Doge, because we know that replacing gold as a store of value will help the environment. So it's a very sort of circular argument that some are making that, the emissions that you're doing by mining end up as a net neutral in the long run. But again, this is putting all kinds of communities within the crypto at odds with one another, Dee.
Yeah, of course, you have Cuban and the other bulls coming out and defending Bitcoin and cryptocurrencies. It's the ones who are on the fence in the middle, thinking about perhaps adding Bitcoin to their reserves. What does this do for them? Maybe nothing ultimately, right? We don't want to overstate this at the same time. But of course, Elon Musk, Carl, has been the most vocal. So that's certainly playing out in the crypto markets, not just Bitcoin today.
Yeah. In the meantime, Apple is helping the markets. You can see the Dow's up 500 this morning after closing below the 200-day for the first time in more than a year. Paul Hickey's the founder of Bespoke Investment Group and actually was one of the first to point out that historical marker. Paul, welcome back. It's good to see you.
Hey, Carl. Good to see you, too.
So you had a great table looking at what happens when Apple falls below the 200-day for the first time in a year or more. And I guess, is it fair to say that forward returns are mixed historically?
Yeah, so I mean, Apple was over its 200-day moving average for more than a year, which is not the longest streak by any stretch in the stock's history, but it's one of the longest. There's only been about 8 other times where the stock has traded that high above the 200-day for that long of a period. Looking forward, short-term returns in the stock were mixed over the next 1 week and month, but over the next 3 months, actually, the stock was higher every single time. So in the short to intermediate term here, you may see a little bit of weakness, but I think this is an area, and if we were to see much more weakness in Apple at these levels or a little below here, we'd add a position in the stock.
Yeah. I mean, the action in Apple is obviously hugely significant, but I do wonder the blanket that is FANG and the huge percentage that it makes up of the S&P is almost disguising the incredible amount of pain that we've seen in non-profitable tech. Stanley Druckenmiller yesterday called them stale longs. I just wonder how you sort of perceive overall sentiment, given that there's been a lot of pain that the indices don't actually reflect at the headline.
No, I think you hit the nail on the head, Carl. I mean, we can't address what's going on in the tech sector without looking at the elephant in the room, and that's the inflation and higher interest rates. And what we've seen is that tech, I mean, has had a horrible week this week, but tech has been underperforming the S&P 500 since September 1st when it peaked. Not surprisingly, that coincides within a month of the low close in the 10-year yield. So as interest rates have risen, tech has been hurt. It's definitely hurt the highly valued or no earnings stocks much more than the mega cap stocks, but it's hurt the overall sector. What's really interesting to note, though, is that the tech sector, unlike prior periods in the past, whenever we talk about the tech being at lofty levels and selling off, we immediately go back to 2000 and say, oh my God, here we go again. But the thing is that the tech sector has relatively, it's only slightly higher than the broader market right now. So it trades at about 30 times trailing earnings for the S&P for 29 times trailing earnings. So if you're going to see interest rates hurting the overall market, tech is not necessarily going to get hurt much more than the broader market and should perform in line. And that's a big if. We're at very low interest rates.
And Paul, that's what makes Apple particularly interesting to me, because it's the big techiest of the big techs, right? It's got that big cash hoard. It's got the biggest luxury product in iPhone on the planet. It's got arguably the strongest ecosystem in tech when you consider the profitability of that ecosystem. And I think one could argue that right now, from a product perspective, it's got one of the strongest advantages it has in a decade with the M1, its homegrown chip actually working. The iPhone lineup has managed to expand and remain strong and protect margins. And you've had stable leadership despite, over the past decade, Steve Jobs not being there, Johnny Ive stepping away, which a lot of people thought would be horrible for it, Angela Arendt no longer running retail. I mean, do we look at Apple as representative not just for big tech, but for the markets right here because of all of that strength?
Yeah, I mean, look at the strength. And I mean, Apple, you consider it the biggest tech stock and the growth stock, but the most famous value investor in history, it's his largest holding. So, and that gets to the valuation of the stock. Of the 5 mega cap stocks, only Amazon trades at an above market multiple. And what we've seen in Amazon in the last few quarters is they seem to be able to turn on the earnings faucet however high they want lately. So, I mean, who knows what if they really wanted to maximize earnings over investment, what their earnings would look like. So I think these mega caps tech stocks provide, an interesting opportunity. And I think they do provide some level of safety and cushion for the overall tech sector.
Paul, where do you stand on regulatory threat? Goldman raising it as a fundamental threat to some of the big cap names just this past week. But then you have Amazon with that victory on that tax charge in Europe. What should investors be looking at right now in terms of that? Should they still be brushing it off, or is it becoming more of a threat?
Yeah, Deirdre, great point. Anytime you brush anything off, that's when it becomes a problem. I think regulatory risk is a threat for some of these big cap tech stocks. But if the regulators are going to come in and, hamper or try and, break up or hurt the United States' largest companies and biggest assets, I think it would be shooting ourselves in the foot. So, I mean, I think there's going to be a lot of rhetoric over regulatory risk, but I think the bark is going to be worse than the bite.
Hey, finally, Paul, I mean, only because it does relate to tech and to such a large degree, where's Bespoke's head right now on the transitory effect of the bottlenecks, the base effects, and the outright inflation that we're having to wrestle with this week?
Yeah, so, I mean, inflation is obviously going to play a large part on what happens with the tech sector here. And I think a lot of it is, as scary as the headline yesterday in CPI were, a lot of it is these bottlenecks. Just look at last Friday's employment report. You saw low job creation, yet at the same time, we have record job openings. So there's this big mismatch. On the one hand, employers have crazy demand and can't fill positions to meet that demand. And on the other side, you have consumers who have more money in their pockets than they've had in decades, and in some cases, more time on their hands because they're not going to work, whether it's because they can't go to work because of issues at home, safety reasons, or they don't need to go to work because of stimulus. But once that's a temporary effect. Once the stimulus wears off, we saw the teachers' unions talking about returning schools to full capacity in September. Once the fall comes around, I think you're going to see some of these pressures really start to ease off a little bit. Whereas, these high levels of inflation are going to start to subside a bit.
All right. Paul, thank you.
Thank you.
Bumble CEO Whitney Wolfe Herd, an Alibaba breakdown, and the tech stocks to watch for safety. We got a big hour tech check. It's continuing next.
The NASDAQ is rebounding today, but turmoil in tech the last few days making it difficult to find safe plays amid all the volatility. Josh Lipton has more on the tech stocks that you can hide out in, right, Josh?
So, Deirdre, let's start with the CLOU. That, of course, is the ETF that tracks those cloud names, what you guys have been talking about so much, trying to avoid its 9th day of losses here in just the last 11 sessions. It's now down nearly 20% from its all-time high that it hit back in February. Steve Koenig at SMBC says the cloud names have been under pressure as valuations got stretched in the context of a rising interest rate environment. And earnings reports have actually been good, he says, but expectations have also been high. Having said that, Steve is still a fan, he tells me, of platform SaaS names that are foundational for the enterprise with what he describes as reasonable valuations like Salesforce. He also likes what he describes as underfollowed names that are important next-generation vendors like Mimecast, which focuses on email security. Another area to watch, the semis, higher here right now, but on pace for its worst week since March of 2020. Bernstein's Stacy Rasgon says valuations became stretched after some remarkable runs. And during earnings season, there was certainly a lot of talk about continued shortages and supply constraints. Still, Stacy likes the companies that make the equipment used to manufacture chips, such as Applied Materials and Lam Research. And finally, take a look at the Hero. That's the ETF that tracks the video game industry, trying to avoid its 11th day of losses in the last 13 sessions. Earnings reports we know have been generally strong for this sector, but Zynga, Take-Two, Activision, EA, all now underperforming the market over the past 12 months. Andrew Urquhart at Jefferies counters that these game makers will keep growing on the back of strong content and solid pipelines. Valuations, he argues, look attractive at these levels. Andrew's top picks, Zynga, Activision, and EA. Back to you all.
All right, Josh, thanks. And that's a good segue, talking about gaming at the end there, to talk about a recent IPO. AppLovin reporting its first results as a public company following a stretch since its IPO. That's been tough on the stock, like a lot of recent IPOs. That said, a lot on the street call it a buy, particularly at the levels where it is now. Joining us now is AppLovin founder and CEO Adam Foroughi. Adam, good to see you. So revenue, EPS doubled year over year. You said on the call that a lot of that over the past couple of quarters was attributable to Axon, your machine learning engine. Raises the question for me, in 6 months, does that mean your comps get tough, or is there enough momentum there to go for some time?
No, we're super excited about our growth prospects. We put the machine learning software in place 6 months ago, and these types of softwares really improve themselves over time as we continue to grow our first-party data from the games that we build, and then also bring more clients onto the platform. There's a huge opportunity that we see to enable us to grow for years to come. We did post a shareholder letter on the website too that I'd urge investors to read. It really enumerates these opportunities well, and we're excited about what lays ahead for us.
You mentioned first-party data, and we were just talking to Unity's John Riccitello yesterday about the environment around iOS and the impact on companies that operate on their platform around whether they have access to data. Is your position affected at all by Apple's sort of closing down some of that third-party data access? Is it perhaps strengthened by the fact that you have your own network that you're trying to grow out with first-party data?
Look, iOS has rolled out 14.5 that changes the rules for a month now. Over 10% of the audience is on there. So we can already address the impact and assess it. We're not seeing any material impact in our business, and we're seeing a big opportunity there because we do have this first-party data advantage. We've got 200 million people playing our games every single month that give our software platform a data advantage. There's some misinformation too in the market around what consumers are willing to share and not. Across our games, we're seeing 30 to 40% of consumers sharing information. And that's a much bigger number than that's been reported.
Hey, Adam, good morning. It's Deirdre. I know that AppLovin games serve a quick sort of on-the-go mobile purpose first, but I wonder if you're thinking about the metaverse and how your games might eventually integrate or benefit from this shift that a lot of folks think is going to come fast.
The metaverse shift has happened, right? COVID really accelerated it. Those types of games are these alternative realities, these worlds that people can get immersed in, but they do take many hours a day to engage with. Our games are casual, they're on the go. we actually didn't even see much of an impact in terms of increased usage of our games over the COVID era. So as we look forward, we're excited about the world becoming more excited about gaming. And we think as people go back to normal life, they're going to engage even more with the types of games that we power.
Right, and your games do have a social element. So are you thinking ahead in creating sort of something that will work within a metaverse or your own metaverse? Where will it end up beyond Fortnite and Roblox?
We're more interested in the casual aspect of gaming. We want the whole world to be able to play our games and not have to spend hours on end doing so. So our games, a game like Wordscapes, a game like Project Makeover, they're tailored to people who are on the go, who want to play for 30, 45 minutes a day. We're certainly building some of those characteristics into the game. Project Makeover has an avatar system, so people can build themselves into the game, but our games are not constructed to have people to play hours on end.
Adam, what are you seeing as economies begin to open up locally in demand for advertising? What's happening to rates based on inventory? Are there businesses that really are trying to attract people back, and is that affecting the revenue in your ecosystem?
We grew our software platform, the advertising part of our business, 90% in Q1. So it's accelerating. It's seeing quite a lot of growth. And our business is actually constructed a little bit differently. Everything we do is performance-based. We work with the app developers to help them grow. And what we're seeing is as mobile devices improve, connectivity improves, and developers get better, the content is just getting better, which enables developers to give better experiences to the consumer and also effectively spend more on marketing, which is a trend we've seen over the last decade, and it continues to accelerate.
Well, we'll continue to watch your stock and your performance. AppLovin CEO Adam Foroughi, thanks.
Thanks for having me.
Bumble's chief Whitney Wolfe Herd's going to join us on the other side of this break. You got to stick around for that. In the meantime, watch Poshmark getting hit hard this morning despite pretty good Q1 results. Revenue up 42, active buyers up 18. The guidance in line, but that's down from more than $100 a share on IPO day back in January. Tech Check is back in 3 minutes. Let's reset here near the bottom of the hour. Welcome back to Tech Check. I'm Carl Quintanilla with John Ford, Deirdre Bosa, and Julia Borston. Stocks are finally back in the green today, up for the first time in 4 days. Tech is leading after 3 days of heavy losses. Dow and S&P still on track for the worst week since January, NASDAQ since February, although the Dow has gone green for the month, and the session high was up 553. Let's get a news update. Morgan Brennan has that for us. Hey, Morgan.
Hello. Long time no see, Carl. Operators of the Colonial Pipeline saying they've made substantial progress in restarting the system that was shut down by a ransomware cyber attack. They say that in the next few hours, all the areas the pipeline serves will be getting some fuel. As Wall Street debates whether inflation is a threat, a surprisingly large increase in wholesale prices, a big jump for food helped send the government's producer price index up 0.6% in April. That is double the consensus forecast. New claims for unemployment, meantime, fell last week to 473,000. That is a new pandemic low. And it comes as some states with Republican governors are moving to cut off extra benefits, claiming they discourage recipients from taking jobs that are available. Speaking of jobs, Amazon is trying to hire another 75,000 new workers by offering an average starting pay of over $17 an hour. That's up from its usual $15. In some places, it's also paying out sign-up bonuses of up to $1,000, and vaccinated hires get an extra $100. John, it's pretty incredible to hear that news, given the fact that Amazon did hire 500,000 workers just last year alone.
It's good old supply and demand in the labor market, it looks like, Morgan. Thank you. And now let's come back to Bitcoin for a bit. The focus is on energy use, dominating headlines this morning because Elon Musk said Tesla backing away from accepting Bitcoin as payment because of energy use. But you know, Deirdre, this is odd to me. I'm not sure this argument holds up for this reason. There's this great piece in Harvard Business Review, as I mentioned, just last week. It turns out you can put Bitcoin mines in locations where power is greener. And that's increasingly being done. Places like Southwest China, where a lot of the hydro wouldn't otherwise be used. It's isolated, but you can actually put Bitcoin mines there. And this reminds me in a way of what we see happening with cloud. I mean, you could argue that the mobile and cloud era has increased demand for data, increased demand for data centers. Data centers are energy hogs that cloud and mobile is bad for the environment. And yet, we've seen with mega scale providers that they're also able to place data centers in more energy efficient locations near hydropower where it's colder and data centers don't require as much energy to power. And that, Amazon, Google, Microsoft have the money to invest in these technologies to actually improve the efficiency of data centers. Maybe the same of Bitcoin mining, Deirdre. And so I'm not sure this argument from Elon Musk is actually going to hold up over time. Maybe Bitcoin is, in a way, good for the environment because it's bringing more market forces to bear in energy generation like few other things have.
I think that's what ARC argued as well, John, and that is a great point relating it to data consumption and efficiencies around that have improved over time. And it's a reminder that this is just really the early stages. Things could get a whole lot more efficient. I spoke to Grayscale's Michael Sonnenschein earlier this morning. I said, all of this action, though, and sort of the concerns around the environmental impact, does that have the potential to push corporations, institutional investors towards another cryptocurrency like Ether? And Carl, he said that it's likely going to look like the precious metal spaces over the long term. There could be Bitcoin, Ether, other cryptocurrencies that have different use cases and different addressable markets. I asked him if Doge might be part of that. He said that was unlikely, though, but a good argument that there may not just be one dominant cryptocurrency, as we're already seeing right now, and that efficiencies can certainly improve and use cases can change.
That's interesting. Yeah, and certainly the focus of that white paper out of ARC a while ago, as John points out. We'll keep our eye on all of that. It's a fascinating push and pull. In the meantime, we got the surprise profit out of Bumble today. Not enough to keep shares in the green, though. Investors have their eye on the guidance. Our Julia Borston joins us now with a very special guest. Hey, JB.
Thanks so much, Carl. I'm joined now by Whitney Wolfe Herd, the CEO and founder of Bumble. Thank you for joining us this morning.
Hi, Julia. Good morning.
So, Whitney, your results beat expectations for the first quarter. Your guidance for the second quarter was very strong. Seems like a lot of different points here that are showing better than expected results. But the guidance for the second quarter raising a lot of concerns for investors. It seems to be that's what's pushing the stock down this morning. Tell us what your outlook is for the second half of the year.
Yeah, of course. So it's worth noting the business is continuing to do great. The fundamentals are strong. We're seeing really great signs of pent-up demand. And as I've said to you before, Julia, this is the business of love, friendship, and community. There's never going to not be demand for this. We are being cautiously conservative due to the nature of the pandemic. None of us, not you, not I, can predict what happens later this year around the globe. And so, this is certainly not signaling that we don't believe in the strength of our business. It is really just taking a cautious approach given the complexities of the pandemic.
And Whitney, as you look at the results in the first quarter, early indications you're seeing from the second quarter, how much of the better than expected results are tied directly to economies reopening?
We have a great product. And as I said, we're in the business of helping people find love, friendship, community. A lot of this is just the nature of the demand that this business supplies. And these economies are starting to reopen. But what's fascinating about Bumble, Julia, is that this is really a business that works on either side of the coin. If we are kept away from one another, we still need connection and community, which is why we invested in Night In, the gamified in-app date night. And then as we see the UK easing lockdowns, the US with the stimulus checks, we are noticing re-engagement. That is such a strong sign that people are ready to get back out there and to see each other in real life. And so again, we really feel that we benefit on both sides of this coin.
Now, Whitney, of course, there's engagement, and then there's also the question of converting people to being paying subscribers. What's your roadmap for that? And how do you see some of these smaller a la carte payments playing into this idea of converting people from not paying to being, really committed subscribers to the platform?
Of course, we're very excited about the roadmap for consumables. As you know, around 90% of our paying customers right now are subscribers, but the dating economy is massive. You think about the wallet that folks spend out in the real world as they date, on drinks, on gifts, on getting ready, on going out. There's such an opportunity to add consumables into this product. And we recognize that people are willing to spend on that dating journey. And so we're very excited about these early tests that we're doing and the product roadmap that we have ahead, where people can add on to the pre-existing subscription, but also the pre-existing offering as far as the freemium model goes right now too. So we really believe that this is going to be great in emerging markets, but then also in our core markets. And this serves a wide range of daters looking for all sorts of things. And another thing we're so excited about is this vast nature of who's using our product. We really see this generational use, women coming out of divorces in their 50s, 60s, and otherwise. This product is not just for Gen Z, and it's not just for boomers. And that's what's so exciting about our TAM and our opportunity.
Hey, Whitney, good morning. It's Deirdre. Good to see you. You talk about the massive opportunity in terms of dating, but some of your other features like Biz and BFF have been bright spots, seeing good engagement. Why aren't you monetizing those yet? Why wait, or are those already in the works?
Good morning. Great to see you. So just like we did with dating, when we launched Bumble for dating, we didn't monetize right out the gate. We are obsessed with the customer experience. We want to make sure that we are delivering them the product and the experience that they truly want. And once we feel that the product, which is being relaunched this year, is at a place that is serving the audience the way they want to be catered to, then we can start to explore monetization opportunity. But that is certainly not going to come before the user experience.
Whitney, a while ago, Reed Hastings was asked about who his competition was outside of his peer group, and he said sleep, which has become almost a mythical answer. I wonder, when you think about your competition, is it going out and hoping to connect with people at random in a bar, the way I think a lot of us did when we were younger, or is it something else?
So what's interesting is that was once perceived as competition, but people have really, through this pandemic, come to realize that walking into a coffee shop or a bar and seeing a stranger, you have no information on that person. There is zero context. So what we're seeing is people are actually using Bumble in the bar, in the coffee shop, to see who is around them and to garner some information. People do not want to just connect at random. They want information. They want to have people that they're interested in. And so I think that this is going to be an out-of-home tool as well, not just a stay-at-home tool, in the sense that as you go out and people start to bar hop or go out to restaurants or socialize, they're going to use this as a vehicle to meet people while they are out. And so I think you're going to see the behavior really take on a new life of its own as we all go back into the real world. And as we think about competition, we serve such a unique offering in the sense that we are putting women in control. And for so long, the dating equation has really been dominated by the male choice. And when you think about it, ladies' night has been one of the most popular frameworks for almost every social bar, restaurant, or otherwise. And this is really about putting safety and control into women's hands. And that is needed more now than ever coming out of this pandemic.
Yeah, I get what you're saying about information, sort of like Wall Street research. Don't just buy. Figure out what it is that you're getting yourself into. Whitney, I noticed that Bumble app paying users, it looked like, were up 44% overall. And I'm wondering what's driving demand for that premium end service during this economy and as things open up. Is it a desire for more time to sort of cull the options and be more targeted? Is it a desire for what, something else?
I think coming out of this pandemic, people have really realized what they're looking for. Some folks are now looking for very serious relationships, and some are very particular about wanting something casual. Having our premium offering is you can be more curated, more tailored about what you're looking for. And this is what people want. We are giving them more control over their experience. We are giving them more control over who they see and who they want to meet. And the inherent nature of this is people want to meet people. This is not going anywhere. And as you've seen with our international growth, we're so excited. Germany's growing into our third biggest market in such a rapid amount of time because this is a global need. People, women, men, otherwise, all genders, they need love, they need friendship, they need connection, and they don't want to meet just anybody. They want to meet who they want to meet. We all have our preferences, and that's what Bumble offers you.
Whitney, you've talked a lot today about how Bumble plays into the reopening of the economy. But over the past year, Bumble's video platform, the ability to date digitally, was really what drove your success during the pandemic. I'm wondering, as we emerge from the pandemic, how you see this balance of virtual dating and Bumble driving people to in-person, real-life dating. How does that play out? And also, do you make more money when people decide to meet for dates on your platform virtually than when they meet on Bumble and then go meet up in person?
So there's something really interesting here that is likely going to stay. I cannot tell you, Julia, how many people just that we've seen through feedback loops and even anecdotally that have said, I will never go on another first date without videoing this person first, even for 5 minutes. I want to see who this person is on the other side of the photo. I want to see how they speak. I want to see if we have any connection. And so this video first before meeting in real life, this is not just a pandemic trend. This is safety. This is taking control over your life. If you could save yourself 2 hours of an awkward date because you just didn't click with someone, why would you not do that? And women are recognizing this. Men are recognizing this. And so this is absolutely paramount and critical to the future of dating, even in a post-COVID world. We don't want to waste our time. And COVID certainly has shown us that more than ever before. And to your second point, the ancillary opportunities for this dating wallet are quite literally endless. When you think about the revenue opportunity down the road for this dating life cycle, you meet someone on Bumble, you video them, you choose the coffee shop. As we said, we're launching our first Bumble coffee shop in Soho this June. You go to that coffee shop and Bumble is this brand that stays with you. And that's something that's very exciting to us. When we think about our competitive set doesn't really have that opportunity and that brand trust and loyalty. And so we really continuously reinvest in our brand, reinvest in that life cycle opportunity. We hear of people meeting and falling falling in love on Bumble, then finding all their friends on Bumble, then they're getting a puppy and they're naming their puppy Bumble. There's something special here, and we're really excited about the future.
Like the puppies named Bumble. What an interesting time of transition for this company, going from the virtual world back into the physical one. Whitney Wolf, thank you for talking to us this morning.
Thanks so much. Great to see you as always.
Carl, back
and
over to
Julia,
you.
our thanks to you with a reminder to our viewers that we're going to see a lot more of her. Another great interview with Julia tonight. Disney's Bob Chapek, post-earnings. That's coming up 5 p.m. Eastern time tonight on Fast Money, John.
Yeah, I'd keep a close eye on that puppy named Bumble out of the neighborhood. Okay, a breakdown of BABA earnings is coming up and why Masa-san says not to worry about Jack Ma. Meantime, watch Sonos spiking after reporting better than expected Q2 results. The first Q2 in the company's history where they've been net income positive. Speaker makers raising guidance for the full year, saying revenue could rise as much as 29%. CEO Patrick Spence on Mad Money tonight. And Tech Check back at 2.
Get a gut check on Coupang. It's not just Masa-san who's bullish on the name. Deutsche calls it a buy at this point. Takes the price target up to 46. Says the company's outgrowing the online market 3-1. You can see shares here at 33D, but back in March, IPO day hit 69. We'll watch that.
Yeah, we will. And meanwhile, take a look at Chinese tech giant Alibaba shares. They are falling this morning after reporting earnings. The company delivering, they're down more than 5%. The company delivering better than expected revenue, but swinging to a net loss for the quarter for the first time in nearly a decade. That $2.8 billion antitrust fine that the Chinese government slapped on the company, weighing on the bottom line. Since the Ant Group IPO was pulled last, remember that this is an Alibaba affiliate. $240 billion has been wiped off Alibaba's stock price. But guys, if it is time to move past the regulatory threat. If you think it's done and dusted and regulators are moving on to other companies, then investors can perhaps focus on what the Alibaba business is doing well. Kramer mentioned this morning, Carl, making money. It's also embracing live streaming, better discovery. And that is something that someone else in this space, Mark Laurie, said will be key to the next era of e-commerce.
20 years from now, the idea of like going to a search engine and typing in toaster and getting 10,000 responses and having to figure out which one to buy, that's going to be something we're going to laugh at in 20 years. So it's going to take time. We're sort of early stages now, but I think conversational commerce is today where e-commerce was back in sort of the late 90s.
John, you have to wonder if he's throwing a little bit of shade at Amazon there that some could argue has been a little bit slow on the conversational commerce side. At its core, its e-commerce core, still really a search engine and not super good at discovery still.
Well, I don't know. They do a lot of things. I mean, you think about the Ghost stores, they got that, what, they're doing blowouts. You know, they got hair going on in London. I mean, omni-channel is a big part of the story. And I think, Carl, the question is, how do you get there depending on industry? How do you leverage data not just for a digital transaction on a mobile phone or on a PC, but also when somebody's in store, and get that attribution piece right too, so that you have a full sense with first-party data, if possible, of the customer.
Yeah, I mean, on the Amazon side, guys, I noticed this morning that Ford is going to be integrating Alexa more into some new models, which we're going to learn about in the days to come. But a big part of that, adding to the conversation part, D, is going to be embedding your technology deeper and deeper in industries throughout the economy, for sure.
Yeah, and you bring up Alexa, right? Yes, Alexa. I almost said Siri. That was supposed to be the next big shift. We're supposed to order things through our Echo devices. I remember about a year ago, he was 3 years old at the time, ordering something by mistake on one of our Echo devices. So, John, clearly still not quite there, but this is a big opportunity if the technology, is improving every day.
Yeah, I don't know if you heard about the 4-year-old who ordered boxes of popsicles, SpongeBob popsicles on Amazon. Oh, yes. Gotta watch out for that. All right. Meanwhile, trending on CNBC.com right now, the world's most crowded trade. Check that out on our pro page. Plus, keep your eye on the cybersecurity sector. Tech bouncing back with these names not participating in the rally today. In 2021, all the names on your screen except Palo Alto Networks down more than 10%. We're back in a moment.
Big cap tech making a comeback today after a volatile few days to the downside. Dominic Chu has more on the names that are well off their 52-week highs, Dom, and there are plenty to choose from.
Oh, there certainly are, and you wonder whether or not the bounce will have staying power, but there's a reason why some traders are at least dipping their toes in to buy some of these dips here. Because the NASDAQ right now is currently just about, we'll call it 8% below where it was at the record high level. So the reason why it's important is because over the last year, we have seen dips of around, say, 9% there, around maybe like 9 or 10% there, and about another maybe 9 to 12% there in terms of the overall move. So this is around the range where in the past year, folks have started to at least step in a little bit to buy. It wasn't the dead low, but still. That's the reason why you're seeing maybe some of that sentiment change in the NASDAQ. I mean, we'll see what happens here. But with regard to some of the mega cap names that are really in focus here, having come off their highs, we focus on Apple because it bounced off its 200-day average price. You can see their Apple shares are just down about 13% from their record high levels. NVIDIA, major semiconductor company, big run there. It's down about 15% from its recent highs. And then Tesla, obviously not a technology stock, but still we treat it as such, is down roughly 36% or so from its high that we saw over the course of the last several months here. So those are some of the big cap tech names to watch. As for the ones that have maybe fallen the most with regard to mega cap technology names, those with market caps of $100 billion or more, these are the ones that some traders are focusing on. Salesforce is down roughly 25% from its highs that we saw over the course of the past 52 weeks. Then you have Qualcomm, also down about 25% from its highs as well. And then PayPal, a big run higher there, but it's down about 22% there overall. So as you take a look at some of the names that traders are focusing on, are there values that are coming in some of these mega cap tech names? They're specifically looking at places like Apple, Microsoft, Amazon, Tesla, and others. But still, some of these names like Salesforce, Qualcomm, and PayPal, a key focus for sure, Deirdre.
Dom, thanks for that. And coming up next, we have some funding news for Masterclass this morning. Meantime, take a look at Match Group, down more than 3% this morning, the second biggest laggard on the NDX, down almost 10% on the year. We're back in just 2 minutes. Despite the sell-off in public tech companies, we have not seen any slowdown yet in private markets. Masterclass, the latest startup to raise money, I can report that it will announce its latest round today. Sources tell me that its valuation tripled to $2.7 billion. Now, its popularity has surged amid the pandemic, but like some of the other darlings, we have to ask, is it sustainable? So I caught up with CEO David Rogier, who says that growth was strong before the pandemic, and he expects it to remain so. They're doing things like adding more offerings from the likes of Wayne Gretzky, the great one, and they're also launching an enterprise offering. So, you know, Carl John, this really speaks to record deal flow and valuations in private markets. The question going forward, though, how long can it last if public market volatility continues? And some of the biggest players like SoftBank, Tiger Global, they play in both spaces. Carl?
Yeah, it's well said, Dee. Volatility is definitely claiming some victims. We do have a couple of upgrades to mention, though, before the break. First is Microsoft. Rosenblatt is bullish, says it's the most important software company on the planet. They initiate buy, price target 301. And then MKM, like Cisco, calls it best in class management team. Price target 61. They like it as a buy, 20% upside. Tech Check is back after one more quick break.
Before we go, looking ahead to earnings tonight, we're going to get Coinbase reporting its first earnings as a public company. DoorDash, Airbnb, and Disney. Julia Borston's going to have Disney CEO Bob Chapek on our air later today, joining Fast Money. And tomorrow, right here on Tech Check, Airbnb co-founder and CEO Brian Chesky. Do not miss that.
Yep, John, Airbnb once again below the opening day, IPO day opening trade of 146, currently 134. A lot to talk about with Brian. The halftime starts now.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour, the question on every investor's mind.
Are we nearing the end of the sell-off? Several big names bouncing today, so we're debating the state of your money with our investment committee. And joining me for the hour today, Brenda Vingello is the CIO of Sandhill Global Advisors, Josh Brown, John Najarian, Kevin O'Leary is the chairman of O-Shares ETFs, along with us today, too. Good to see everybody. Take you to the wall. Stocks, I said, they're bouncing. Dow's good for better than 400. NASDAQ off the best levels of the day. Nonetheless, given what's happened lately, I guess we'll take the 68 points to the upside. Kevin O'Leary, big question. Are we nearing the end of the sell-off? Can you trust what we're witnessing today with this bounce?
Yes, you can. I think we're in a classic garden variety correction, healthy. You know, people forget volatility. It's back. And as a result, we're going to have days like we've had in the last week or two. Obviously, tech sector really took it on the chin, but the thing that really matters is earnings and growth. And so, you know, I look at the earnings numbers and they're just blowing them out of the water. We're having a spectacular comeback here. The economy's on fire. I think we're getting growth in the back end of this year like we haven't seen since the 50s. And so, you know, I have to look at this as a buying opportunity, particularly in tech, where I look at the quarter over quarter growth in some of these names like Zoom that got slaughtered and say to myself, wait a second, nothing's changed. They're still growing like crazy. And all of those companies that, you know, people said, oh, the PE is too high, their growth hasn't slowed. The earnings are terrific. I think this is just a buying opportunity, and I think we're going to keep moving forward. What kills a market is real inflation, which we haven't seen yet, and slowing of earnings, which we definitely are not seeing. So I'm still full steam ahead. Equities rule, fixed income, nowhere to go. I think we're going to have a spectacular back end of this year.
So you gave me a lot to work with there, and I want to be clear here. You bought Zoom and DocuSign and Tencent and some of these other stocks that have gotten obliterated lately. Nobody is questioning the lack of growth. It's the question, Kevin, of too much growth. And the fact that inflation is picking up, that's undeniable. Look at all of the figures and the facts and what's happening in some commodities markets. Inflation is undoubtedly picking up. Isn't that a problem?
Well, this kind of reminds me, particularly on those names like a Zoom, the comments I used to get in the days of Amazon when it would correct 38%. It did it every 18 months. And people say, oh, it's over. There's no more growth, yada, 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 yada. When there's a secular trend occurring, like what's going on as we speak to each other right now on Zoom, and all these technologies that empower digitization, direct to consumer, which is growing margins and growing a brand new Digital America 2.0, that hasn't changed. We're in the third inning of that. So if you've got to be able to stomach a little volatility. We haven't had much lately. This is classic volatility. But I really go back to just looking at the quarter over quarter growth. Pick any growth stock. You know, I've given you three that I've doubled down on recently. But basically, nothing's changed. And so at the end of the day, if the market wants to value it differently by 40% and goes on sale, okay, I'll buy a little bit more. But tell me when the world stops growing. That's not the case right now.
Okay, so Josh Brown, I want to know from you whether you think that we can trust what we're seeing in the market today. But I want you to listen to what JP Morgan's Marko Kolanovic told us yesterday, a man who many people listen to, has been known to move the market in the past. Here's what he told us about the sell-off, and then we can react on the other side. Here's Marko.
I think we're probably at the end of this upset. Again, you know, if you look at the Russell 2000, look at the Nasdaq, you know, they're now trading sort of below January levels, you know, and just think where we were in January. We didn't know about earnings, we didn't know about COVID, you know, and you know, why were nobody screaming back in January then? Like, so I think we're at the end of this upset. I think market is going to go higher here. That said, we do still, again, prefer sort of reflationary themes.
Okay. TRB, O'Leary's buying some of these hardest hit stocks. Kolanovic says it's overdone. We're probably at the end. Are they right?
Well, I would just say that if we think about this as there being two different markets, I would say that the punishment in the expensive / negative earnings group is not over yet. But what Marko is saying might be right for the areas of the market that have already been working. So I think, like, if you think about, I've been calling this environment grandpa's revenge. All of the stuff that the youths were involved with and posting things on Twitter like stay poor or kill yourself if you don't own Airbnb or whatever. Like, that's the stuff where I don't think the selling's over. And I think it's long overdue. And it's not because somebody should be punished for being bullish or anything like that, because I own a couple of these names that are in that cohort. I just feel as though the shareholder base for things like SPACs trading at premiums and all of these other type of high multiple names, the shareholder base is not a seasoned shareholder base. This is their first rodeo, literally. And there's nothing wrong with that. My first rodeo was getting demolished in the dot-com bubble 21 years ago. But I don't think that there's been as much punishment there as there could be. So I'm looking at some of the worst stuff. Like, let's take SPCE. This is the space ETF. It's 75% off its high. Everything you think about the holdings in that ETF could be true. All of your wildest dreams and all the things that you're imagining about Mars and colonizing the galaxy, all of those things could be real, and this 75% sell-off could still make sense and be justified. And that is the difference between the stock market and the real economy. So I think when you look at ARK, opened up 1.5%, now it's down 1.5%. Tesla opened up 2%, now it's down 2%. You cannot trust these opening bounces when you're in a downtrend. So I would put those stocks in one category. Now look at the banks. They got back everything they lost yesterday. That's Grandpa's revenge. Grandpa he's not fired up about space, but XLI gained back everything it lost yesterday. Materials, everything, transports. Look at the IYT. So that's what's happening in this market, and I think that this trend can persist for a while. And so that's the way I would want to think about it.
Let me ask you this, okay? Because if you look beneath the surface, right, there are a lot of stocks below their 200-day moving averages. If you look at areas of the market, Josh, where you have pointed out areas of strength to, sort of hang your hat on in the past, are weak as well beyond the kinds of stocks you're talking about. I'm looking at the IT. Hang on a sec. I'm looking at the ITB, the XHB, right? The home builders down 7-8% declines this week. The stocks within those are getting obliterated. Right? An area of strength that you've said, hey, look at what's happening. You were talking real economy here, right? Housing and the boom that we've seen. Look at what's happening in this area. These stocks are performing so incredibly well. Now they're falling apart a little bit, at least this week. Is that a worrying sign?
Well, they're all still technically in uptrends, but these are stocks that have gone up 100%. So having them in an 8% drawdown from their recent peak, to me, I wouldn't consider that to be obliterated. Obliterated is DraftKings, okay? Obliterated is ARKK. I would not consider the home builders quite obliterated, but it's been a tough week because these stocks are extremely sensitive to sudden and severe changes in interest rates or interest rate expectations, let's call it. So that move makes sense to me, even as somebody that's still bullish on the housing trend, and I will be for probably the foreseeable future. But for every XHB you throw at me, Judge, I'll throw right back at you. Look at the bounces in Walmart, Target, Costco. Unbelievable bounces today, and those bounces seem to be sticking. So I think we can always find areas of strength or weakness at the margin, but big picture, I would be all in on days like yesterday where the selling gets indiscriminate. I would be all in on the strong economy names, specifically be looking for experiential stocks, companies where they have pricing power and they benefit from people getting vaccinated. I think that is an enduring theme for 21.
So Doc, one person does not a trend make, but I've got Kalanovic telling me that this is overdone, that the bulk of the selling is over. I've got Kevin O'Leary buying some of the hardest hit stocks, Josh Brown telling you where to look for opportunity. And oh, by the way, I spoke with a really big fund manager last night who has taken up his exposure dramatically at the end of the day yesterday. Now, underscores the fact that it's a trading market and that could change depending on a few different factors, and that maybe the landscape looks pretty darn good for stocks between now and the summer period of August, at least when you get Jackson Hole and then you get Fed commentary, and then all bets are off because nobody knows really what's going to be the situation then. But that's what, four voices now, and a prominent one whose name I can't reveal, who are buying and buying handsomely.
Well, and Scott, knock on wood, I'll join that chorus. As we talk about all the time, volatility and volume, we got both signals on this move. So volatility, a week ago Friday, we were at 1650-ish for the VIX, right? We hit 29 on this move. That's a 73% jump in volatility. Now, when volatility is cheap, just as I said last week, what I like to do is I get out of my stocks and I get into call options primarily. And as the volatility made that big spike, I get out of those calls, buy stocks, and then sell fat premiums into it. I know Mr. O'Leary loves money, and that's one of the great ways to generate cash flow. So I did exactly what
are the
Josh
taxes like
and
on that?
Kevin and well, it depends. I'm trading in tax deferred, Josh, so I don't worry about that. But what would the taxes be? You'd be short-term capital gains, and so. But the premiums and the swing, when you go from a 16 VIX up to a 29, you're talking about a doubling in the premium. It'd be like, you know, a Super Bowl week and you have a condo right next to the stadium. Obviously, you're getting huge premiums then. You want to rent that thing out. That's what I did when the vol popped that 73%. Now, it's pulled back to half of that move today alone, guys. So dead cat bounce, maybe for some of those stocks. You talked about a couple, Scott, like Tesla and a couple others that had gone positive and then kind of rolled back over. But as far as Apple, just chugging along, and a lot of these others, I think the rest of Q2 is going to be more or less like this. We're going to see little pullbacks like that are kind of scary. A 3-day pullback of 1,100 points in the Dow, yeah, that's scary. But when that volume and volatility tell you that the panic has hit, that's when I like to buy. Like Buffett says, be greedy when they're fearful.
I hear
That's
you.
what we did yesterday.
I hear you, Brenda, but, you know, things can change rather quickly. You know, my source focusing on the bond auction today at 1 o'clock. And again, you know, trying to get a handle on whether this becomes a more investable market for the next few months, or it simply remains a more volatile trading environment where you're in and out of positions based on where you think rates may be going in the near term versus the longer period of time. So I've given you, you know, some prominent voices, and you've heard from the committee here too. What's your sense on where we are and where we're going from here?
Yeah, I mean, I think if we look at where else are you going to invest in this market, the equity market is really one of the only places to be outside of real assets if you believe that inflation is going to continue to rise. And so I think even though we're likely to see more volatility, which I absolutely think we'll see over the coming months, especially as this inflation debate rages on here, we're really not going to have any true resolution about whether things are transitory or not for quite some time. So I think we could see a lot of volatility in that time frame. But I think I think it's wise to use dips to either establish positions or add to positions during that period of time, because we just don't see a lot of other alternatives in places where assets can go. Now, I say that, and then we look at something like the tech group, where I think that, you know, things have changed over the last year. They're growing like crazy, so that piece hasn't changed. But what has changed is that now we're seeing this environment where a lot of economically sensitive groups are going to be able to grow pretty significantly for the first time in a decade. So that does change the dynamics. And especially if we look at something like the second quarter, which we're in right now, where there's a very tough year-over-year growth comparison for the technology group, and that isn't the case for a lot of other sectors. There's a big question of, will growth start to decelerate within that group? And I think that has weighed on multiples. It could continue to weigh on multiples here in this environment. We don't think that you abandon that group for that reason, because I still think there's a reason to hold on. It's a safety group, if you will, where if growth doesn't play out the way we all expect, we think that, you know, people will rotate back into that group. The names like Apple, the Microsofts of the world with tons of cash on their balance sheet. So, you know, that's our view kind of in a nutshell there.
Okay, let's bring in Brian Belsky now. BMO's chief investment strategist joins us once again. Mr. Belsky, it's good to see you.
Mr. Wapner, how are you?
I'm good, thanks. We have a rather uncertain market, and I look here and I see Belsky's all bulled up. You're all bulled up. You raise your S&P target to 4,500 from 42 for the end of the year.
You know, we did, Scott, and we did that on a down day. That's kind of how we roll, quote unquote. We're not going to chase the market like many of our competitors. You know, we've been doing this for a long time, and it's my 23rd official forecast as the lead strategist on a piece of paper. And, you know, the market, you've done a wonderful job, by the way, this week, talking about the ebbs and flows I think you talked about and the fits and starts of the market. This has been a fits and start momentum on and off type of market. I don't think anybody knows how to buy and hold stocks anymore. I think we're in a big, giant secular bull market that started in 2009, 2010, and I think it's going to go on for a while. But the makeup of this bull market, Scott, is much different than the last 10 years. This is a stock-driven, theme-driven market, and it's never more omnipresent than this year. I think it's incredibly wrong and actually difficult to be painting technology with one broad brush. You got the Cathie Wood stocks, and then you've got Apple. They're very, very different. And so I think you want to use days like today to buy. I think everybody on the committee is right today in bits and pieces. Josh Brown did an excellent job talking about how you really, really want to be a longer-term investor and think about what you want to pay for things. Mr. O'Leary, my friend from Canada, as he knows, I also cover Canada. I think Canada's coming along for the ride on this with respect to North American stocks. So, and Brenda talking about TINA, there is no alternative. I just think that equities in general, and especially U.S. equities, are the best asset in the world. Now it's a matter of what you're paying for. We don't want to pay for the high-flying tech. We want to pay for consumer staples, consistent cash flow, steady tech, and that's why we're market weight this year, but over the next 3 to 5 years, technology, communication services, and discretionary by far our favorite names.
Okay, so you mentioned this sort of, you know, you've got these tale of two markets within tech, right? There's the Cathie Wood stocks, the ARK stocks, and then there's Apple. Well, what do you make of the fact that Apple can't get out of its own way, right? It's getting a little bit of a bounce today, but the stock has been stuck where it is or declining. So what's the message there?
The message there is that it's correct to be market weight tech, and you want to have a core position in Apple, Scott, and you want to have a core position in names like Microsoft, and in communication services, same thing with Google and Netflix, and in discretionary, Amazon. And I think what's happening in Apple is clearly the stock is growing into itself, which is not too uncharacteristic of what has to happen in a lot of these tech stocks. I mean, quite frankly, some of these high-flying tech stocks are not going to be around in 5 years, but Apple's going to be around in 5 years. And what's happened in some of these Cathie Wood stocks is reminiscent of what I went through as a strategist in the late 90s and early 2000s, and buy the dip craze in some of these high-flying stocks. It's just not going to work, but it is going to work in real companies with real assets and real cash flow and real balance sheets. And Apple, by the way, is one of the best dividend growth stocks in the world.
Hang on a second.
So guess what?
Hang on a second.
Go
Apple's
ahead.
growing into itself? Well, what does that mean, right? This is a mature company. What does that mean?
Well, they're going to continue to come out with great products. They're going to continue to grow their dividend. Their cash flow continues to expand. This company is a cash flow machine, Scott. So with respect to the multiple, I think earnings are going to continue to go up and the multiple is going to go down in Apple.
That's interesting. Okay. Dr. J, is Belsky right to be as bullish as he is? 45. I'm looking at it right now. I had to do like a double take. But then I realized it was Belsky. I'm just kidding. 4,500. 4,500, Doc. Is he right? Or is he just way ahead of himself? Way over his Canadian skis.
Right over those Canadian skis, yeah. I think Brian is smart to be putting out a number like that, Scott, because the second half, like I say, I think the rest of this quarter, the second quarter, is going to be more or less like we've seen. Sideways, up, down. The Dow keeps hitting new highs. The S&P pushes right up against them and pulls back. And the FANGs have been sort of weaker than the rest of the market. I think as we get through the second quarter, that's when Mr. Belsky really starts to catch the wind at his back, because I think the second half of this year, they're going to start meeting the demand, which is out there and real. They'll start meeting it because more and more people will go back to work. Right now, it's a hard time getting people to go to work. That's why you heard from McDonald's today moving up to $11 to $17 an hour, the band that they're going to be paying new starters over at McDonald's, depending on the state and so forth. So I think as more people are drawn back into the workforce, then the demand that we know is already there will be satisfied, because we'll have supply to meet it. I believe the same will be true in crude oil and so forth. By the way, gasoline prices, according to that report yesterday, Scott, up 49% in the last year. That's without Colonial, 49%. Now, Colonial will pull back. That jump out of Colonial to the East Coast where you are, Scott, will pull back, mitigate as this as the refined product gets to market.
Right.
But nonetheless, that inflation is real. So the demand is there, evidenced everywhere. I think Brian's going to be right.
Belsky, how about that, right? These concerns about inflation in the market, are you just completely dismissive of them? Because in some respects, I mean, you know, you got 4,500, so you don't think inflation is going to be a problem. You don't think the Fed's going to talk taper or anything like that anytime soon. You must not if you think 4,500 is the number.
Well, if you go back and look at our sectors, we're overweight financials, industrials, consumer discretionary, and materials. Those sectors have worked aside from consumer discretionary this year with Amazon kind of underperforming. But the three sectors that really reek of inflation and a higher yield curve and higher rates are the ones that we're overweight. I think financials for the next 12 to 18 months. Still think my institutional clients around the world are underweight financials in the U.S. And I think that's going to be the big play, Scott. But I'm not going to doubt the Fed. I mean, the Fed saying transitory, I'm going to believe it. We've had a 39-year secular bull market in bonds, Scott. I've been in the business 31, and all the money's there. We have a lot of money to unwind still from bond positions into equity positions. I'm not saying the Fed's not going to taper at some point, but people forget what happened in August. It was monumental. The Fed changed its focus away from inflation into employment. To get sub 4% employment, we need massive wage inflation and massive job growth. This is not going to happen overnight. We're several quarters, if not several years away from that. So we continue to believe that the Fed's gas is going to be on the pedal, weight on the pedal, and monetary policy and fiscal policy is going to be driving things. But more than anything, Scott, just because you have a bag of money doesn't mean you buy everything. You buy the best assets, and I can't go back to it more than I can. American U.S. stocks are the best stocks in the world, and that's why they're going up, and that's why they're leading.
All right, Kevin O'Leary, your Canadian compadres seems to be making a lot of sense to me, right? Is he the voice of reason in a room of worry, concern, and oh my God, you know, inflation's going to go crazy and the stock market's going to fall out of bed? Is this the voice of reason that we need to hear?
It is, and I'll tell you why. Inflation, go back in history and look. When inflation comes back, and it definitely is coming back in wage inflation. I'm living that nightmare right now, just trying to hire people in the private companies I own. It is really brutal. You know who I'm fighting? The government. They're paying people. Anyway, I don't want to get into policy, but I'm really unhappy that people are already employed or getting checks from the government, and I have to compete against them. It's crazy. However, inflation drives performance of corporations that have pricing power in inflation. And the canary in the coal mine you have to watch for is the 10-year. If we had hyperinflation concerns, it wouldn't be a 1/6 handle on the 10-year. It would get blown apart. You'd get killed there. And we're not getting that. So
not yet.
We have, you know,
not yet.
Well, I get it, but you get a lot of different indicators you have to work with. I'm like everybody else on the panel. I have to put money to work. What is the best asset class? I can either buy another watch or I can buy stocks. Right now, I think stocks can outperform my watch collection, so I'm going into equities.
Knowing you like I do, you're probably buying both.
It's true. But, you know, at the end of the day, I think equities in the beginning of an inflationary cycle are really a good place to park yourself because you know you're going to get slaughtered on fixed income. And bond prices, even BBB credits, are way overpriced.
You're not going to get slaughtered on fixed income. You're not going to get slaughtered on fixed income.
I think you are.
Based on what?
You're going to get killed. That's what makes a market. Why am I buying BBB 5-year paper for 2.4, Josh? Are you kidding? If there is any inkling of inflation, you're going to get slaughtered there.
Well, okay, triple B paper. I don't think that's the bond market. The bond market, the Barclays Ag. I don't think you get slaughtered with run-of-the-mill inflation. Hyperinflation.
I am a fixed income guy. I tell you what fixed income is. It's everything from factoring to corporates. It's also the government bond ladder, if you want that, but also prefs and converts. Those are markets that have been stellar for a very long time, that have never faced inflation in a decade.
Hey, Josh, what
happens?
I want Josh to opine on Belsky's view here, this 4,500 target, raising it up, and all the things that he just told us. Belsky, you're still with us, right? You still with us?
I'm here.
Sorry,
I will.
Go ahead, Josh. I will, but I have to weigh in on that last comment. Investment grade bonds. You had interest rates rise. You had a secular higher interest rate environment from 1941 to 1981. We all agree. Average interest rates rose by like 1,200 points during that period of time. Just a huge cycle up in rates. The bond market only fell during 12 of those years, and the worst annual return was negative 3%. So I don't want
negative anything. Why do I want negative
normalize.
returns? Why do I want negative returns?
I'm not saying you'll get negative returns. I'm saying that's in a massive upcycle for rates where they go from almost zero up to 20%. The worst annual return out of 12 down years from 40 years was less than a 5% drop. If that's slaughtered to you, then I don't know what to tell you. That's
let me do this, guys. Let me do this. Belsky, why don't you give me the last word here? I've got about a minute or so before I go to the White House. The president is going to update us on the Colonial Pipeline and getting it 100% back online. So why don't you finish this out, Brian, if you would, please.
Thank you. We have to remember that the stock market is a market of stocks. I think this is less about growth and value and cyclicals versus all that. Remember, when growth is scarce, growth outperforms. That's why it did in 2019 and 2020. We are seeing a broadening out of fundamentals, which is very positive. That's why you want to be more value. And remember, value cycles are longer. But if I was starting a portfolio from scratch today, I would 100% be an all cap. Equal weight, small, mid, and large, by big companies as your base and by emerging companies in terms of themes as your go growth stocks. And I think that's what's going to outperform for the next 5 to 10 years.
Yeah, I always enjoy the conversation, Brian. Thanks for coming on. That's Brian Belsky joining us today on what is a nice bounce back for the market. Let's show you the major averages again as we wait for the president at the White House. Going to be speaking in the Roosevelt Room, updating the situation on the Colonial Pipeline. You've got the Dow Jones Industrial Average, good for 450 points for 1.33%. That's a nice bounce back there. Nasdaq's been teetering a bit. It was off the best levels of the day. It's still good, though, for better than 100 points, at least right now. That's 0.75%. And obviously, there's a lot of attention being paid all the way on the right-hand side of your screen. The 10-year note yield is at 165. So a pretty decent bounce back. Apple has really been a point of concern in the market of late. Had been going sideways, then it was going lower. If we can show you shares of Apple too, that's a nice bounce back. There's been some notes out on it today. There's been some notes, by the way, defending some of the other big mega cap tech stocks like Microsoft, some resumption of coverage from some various firms that have taken a pretty good look at Microsoft, and they continue to like that as well. But as I mentioned to you, a lot of damage underneath the surface right now, which I'll talk to you in a second. Let's go to the White House and the president.
Update everyone on the ransomware cyber attack that impacted on the Colonial Pipeline over this past week. As of yesterday evening, Colonial has begun restarting the flow of refined products in their pipeline. This morning, Colonial reported that fuel is beginning to flow to a majority of the markets that they service, and they should be reaching full operational capacity as we speak, as I speak to you right now. That is good news. But I want to be clear, we'll not feel the effects at the pump immediately. This is not like flicking on a light switch. This pipeline is 5,500 miles long. It had never been fully shut down its entire history, and so fully, and they have to safely and fully return to normal operations, and it's going to take some time, and there may be some hiccups like I just had along the way here. Still, we expect to see a region-by-region return to normalcy beginning this weekend and continuing into next week. In the meantime, I want to update you on what our administration is doing to accelerate this process, to mitigate shortages, and to protect you from price gouging, protect the American people from price gouging, all those along the line. First, we relaxed rules for pipeline operators to provide flexibility for emergency personnel to help manually get portions of the pipeline up and running earlier this week. Secondly, over the weekend, we reviewed and worked with the company to get a portion of the pipeline system from North Carolina to Maryland to operate under manual control and deliver its existing inventory. In addition, we put in place emergency orders that lifts the hours restrictions and allowed states to lift weight restrictions for tank truck drivers to be on the road. This allows those drivers to work more and carry more fuel to the affected regions. Third, the Environmental Protection Agency issued a targeted 20-day waiver of standards in several states to give fuel suppliers more flexibility to use available fuels where they're needed, which will boost the fuel supply. And those last two actions have made tens of millions of gallons of additional fuel available each day to be able to be distributed. Put another way, the extraordinary measures the administration has taken, we estimate, sent enough gas to stations to fill the tanks of over 5 million vehicles in the last few days. Fourthly, as part of an effort to use every possible means to accelerate fuel deliveries, last night I granted a waiver of the Jones Act to fuel suppliers. This allows non-U.S. flagged vessels to transport refined fuel products from the Gulf of Mexico to affected areas, and we'll grant additional waivers if necessary. These steps are temporary, but they will remain in place until full service is fully restored. This is a whole of government response to get more fuel more quickly to where it's needed and to limit the pain being felt by American customers. Now, here's what drives the driver in the states that are affected. Here's what you can do, the drivers. Don't panic, number one. I know seeing lines at the pumps or gas stations with no gas can be extremely stressful, but this is a temporary situation. Do not get more gas than you need in the next few days. As I said, we expect the situation to begin to improve by the weekend and into early next week, and gasoline supply is coming back online, and panic buying will only slow the process. And I also want to say something to the gas stations. Do not, I repeat, do not try to take advantage of consumers during this time. I'm going to work with governors in the affected states to put a stop to price gouging wherever it arises. And I'm asking our federal agencies to stand ready to provide assistance to state-level efforts to monitor and address any price gouging at the pump. Nobody should be using this situation for financial gain. That's what the hackers are trying to do. That's what they're about, not us. That's not who we are. And as for the people who carried out this attack, the FBI has released details on the attack so others can take steps to prevent from being victimized like Colonial has been. We do not believe, I emphasize, we do not believe the Russian government was involved in this attack. But we do have strong reason to believe that the criminals who did the attack are living in Russia. That's where it came from. We're from Russia. We have been in direct communications with Moscow about the imperative for responsible countries to take decisive action against these ransomware networks. We're also going to pursue a measure to disrupt their ability to operate. And our Justice Department has launched a new task force dedicated to prosecuting ransomware hackers to the full extent of the law. And finally, let me say that this event is providing an urgent reminder of why we need to harden our infrastructure and make it more resilient against all threats, natural and man-made. My administration is continuing to safeguard our critical infrastructure, the majority of which is privately owned and managed, like Colonial Pipeline. Private entities are in charge of their own cybersecurity, and we know what they need. They need greater private sector investment in cybersecurity. And that's why we launched a new public-private initiative in April that is focusing on strengthening cybersecurity in the electric sector for natural gas, for pipelines, as well as water systems and other lifeline sectors. And last night, I signed an executive order to improve the nation's cybersecurity. It calls for federal agencies to work more closely with the private sector to share information, strengthen cybersecurity practices, and deploy technologies that increase reliance against cyber attacks. It outlines innovative ways the government will drive to deliver security and software. using federal buying power to jumpstart the market and improve the products that all Americans use. To assist in this urgent work of protecting our nation against cyber attacks, I'm calling on the United States Senate to move quickly to confirm Chris Inglis as our National Cyber Director and Jen Easterly to be the Director of Cybersecurity and Infrastructure Security Agency at the Department of Homeland Security. In America, we've seen critical infrastructure taken offline by floods, fires, storms, and criminal hackers. In Texas last month, we saw what happens when storms hit power systems that aren't fully modernized or ready for the threats of extreme weather with tragic results. Now we're seeing the effect of criminal hackers with gas lines throughout the the Southeast. And we're in a competition with China and the rest of the world to win the 21st century economically. And we're not going to win it in competing with an infrastructure that is out of the 20th century. We need a modern infrastructure. My American Jobs Plan includes transformative investments in modernizing and securing our critical infrastructure. Later this afternoon, I'll be meeting with Republican senators to discuss ways we can move forward on modernizing the infrastructure we have today and building the infrastructure we need for tomorrow. I'm willing to negotiate, as I've indicated yesterday to the House members and to the leadership. But it's clearer than ever that doing nothing is not an option. Again, we expect things to return to normal over the next several days. I will be monitoring Colonial's progress and the federal government's support every step of the way. So stay strong. Help is on the way. We're going to get through this as we always do as Americans, and we're going to do it together. And it's going to be quick. God bless you all, and may God protect our troops.
Mr. President, you said that the hackers are believed to be living in Russia. At what point does the U.S. start to try to inflict pain on governments who allow this sort of thing to happen in their territory?
We are working to try to get to the place where we have sort of an international standard that governments, knowing that criminal activities are happening from their territory, that we all move on those criminal enterprises, and that I expect that's one of the topics I'll be talking about with President Putin.
Are you confident that Putin was not involved? Are you confident that Putin was not involved?
I am confident that I've read the report of the FBI accurately, and they say they were not. He was not. The government was not.
What would you Mr. President, Wednesday's executive order mentions the Colonial Pipeline directly, but the press release says it only encourages private sector companies to follow the federal government's lead, which encouragement is good, but in the face of profit, it's kind of sketchy. So what concrete steps is the administration taking to ensure that companies are prepared and held accountable for their cybersecurity issues?
You've asked three different questions in that one thing, I think, as I understand it. The bottom line is that I cannot dictate that the private companies do certain things relative to cybersecurity. A lot of you are very seasoned reporters. You've been covering this debate up on the Capitol Hill before I became president, and unrelated to President Trump, just a debate internally among senators as to whether or not the government should be insisting, and it gets into privacy issues and a whole range of things. So that's going to be an ongoing negotiation. But I think it's becoming clear to everyone that we have to do more than being done now, and the federal government can be significant value added in having that happen. Yes.
Are you will you consider doing any kind of retaliatory cyber attacks to shut down these criminals? Are you ruling that out?
No.
Is Prime Minister Netanyahu doing enough to stop this violence there from escalating?
I had a brief conversation with him yesterday, and I have my intelligence community, the Defense Department, as well as the State Department, have been in contact with all of their counterparts not only in Israel, but in the region. And one of the things that I have seen thus far is that there has not been a significant overreaction. The question is how we get to a point where they get to a point where there is a significant reduction in the attacks, particularly the rocket attacks that are indiscriminately fired into population centers. But I expect I'll be having some more discussions. And we haven't just spoken with the Israelis, with the Egyptians, the Saudi, and others. So it's a work in progress right now. So thank you all so very much.
Mr. President, we can take one more on the ransom. Were you briefed on the fact that the company did pay the ransom?
I have no comment on that. Thank you.
Thank you, sir.
Okay, that's the president with an update on the Colonial Pipeline situation. President Biden saying the flow has restarted. Not going to happen overnight to get it at full capacity, saying, quote, it's not like flicking on a light switch. Hope it happens soon in the next couple of days. White House is also taking steps to mitigate the fuel shortages. You've seen those lines of cars at the gas stations, certainly throughout the South, and prices are elevated really all along or in most parts of where that pipeline runs. And importantly as well, the president also saying the White House does not believe the Russian government or President Putin are involved, but that the perpetrators, the dark side members, are living in Russia. There was a report as well, unconfirmed by us at this point, that Colonial had paid $5 million to the hackers. You heard the president ask specifically about those reports, and as you heard there, he would not comment. President Biden would not. We'll be right back.
So not a whole lot of like actual financially impacting news from President Biden, but mostly just about Colonial Pipeline, and they're back up and running, but it's going to take a while to catch up. I think if anything that it'll do for the financial market is just, provide some reassurance and possibly stabilization. He's not coming on here saying, oh my God, the world is coming to an end and everything's on fire. And yet, so in a way, yeah, that'll help. It looks like crude's falling. It's not like it's falling a lot just since he talked, but it's just down today. 63.60. It was up a little bit to 67 about a month ago, no, 2 weeks ago, and then hit 66 again just earlier this week. So it's down a little bit from then. 10-year Treasury is dropping today. I don't completely know why. Now, don't get me wrong, I'm happy for that, but I don't know. Again, it's the chicken or the egg situation. Is everyone talking about the this dip being over today, which I've heard from a lot of people today? Which, hey, if that's happening, fantastic. But it's a dip over today because the Treasury yield's down, or is the Treasury yield down because stocks are going up? I don't really know. But it is dropping relatively significantly today, which is fantastic. Down 2.24% to 1.657. But then again, I would say that's the lowest in a while, but it's not, because yesterday it went up like 7% or something stupid. So it wasn't. Yesterday was a bad day for I guess it was like 4%, 4.5% maybe. But giving back 2.5% is nothing great there. Zoom is down 3%. Man, I just can't win with Zoom. I think that if it gets back up to 400 something, I might sell off part of my Zoom stock because it's just not in a good place. Peloton's making a comeback very slowly off of its just disastrous last couple of weeks. If I had capital available, I definitely would have bought it in the 80s though, because I think it absolutely will make a comeback. Let's see what else is not doing too hot. ARI is up, which is fantastic. I love ARI.
Welcome back. The activist firm Value Act taking a new position in the owner of the 7-Eleven convenience store, saying it wants the Japanese.
44% in 6 months, and it has its 97%. Bumble down Not only is it below post IPO price, it's below the actual IPO price. I thought I was going to get into it in the 60s, and I was happy about that. Not so much. AMC still slowly teetering up. I'm happy to see that, obviously. Needs to get back up to those in March where it was over 14. Ooh, lumber is down and now it's spiking back up here just in the last hour, but it's generally down. It's great. It's down to 14.52 this morning, which from its high just earlier this week, that's down 16%. That's exciting. Yeah, I don't know. Good day overall. Market's bouncing back. It's still just a not perfect day. A lot of these others still like Zoom and Twilio, Teladoc, and Ultimate Bat. Sometimes Ultimate Bat, sometimes actually doing good, but they're still down overall. And then Bitcoin is hurting. Let's go Bitcoin Trust down underwater, which is absolutely sexy. Down 10% today. And EMC the same day. The one for AMC, I before the pretty low. All right, let's get back to these guys.
Page number of directors being put on board. Starboard has certainly been number one. Right now, as you might know, they're in the middle of a proxy fight with Box, which is an interesting situation. The board of Box, in the midst of this proxy fight, just sold $500 million of convertible preferred stock to KKR with the provision that KKR has to use their 11% to support the board. In the proxy fight. Also, they can't sell their shares to an activist shareholder, however that's defined. And what makes this even more interesting is that the company, which has $600 million of cash on the balance sheet, so doesn't need the $500 million, is using the $500 million to buy back shares. So they're essentially replacing shareholders that have free will and can vote however they want with one shareholder who has to support the board. I think this is going to backfire for them, and I think ISS and Vanguard and BlackRock are going to see through this and support Starboard where they may not have if this didn't happen.
Yeah, and I'm sure if Icon's watching, somewhere, he's saying, "Wait a minute, I've been in the news too," and from following your 13D monitor and your emails every day, Carl Icon's been as active as anybody as well. Worth noting. I've had that breaking news. I appreciate your time. I'll make it up to you next time. A little shorter today than normal. Ken Squire, thank you very much. We have Doc's Unusual Activity. We'll do it next. All right, Dr. J, unusual. What do you got for us today?
Well, Scott, Pulte, PHM, this one, along with Lennar, both hit today for unusual activity, and we both know why. It's a combination of low interest rates and extreme demand for housing. Pulte, they're buying the 60 calls out in July, Scott. That's with the stock at right around $57 a share. I love the trade. I'm in this one. Probably be in there about 2 months, Scott. Second trade, take a look at Las Vegas Sands, 17,500 of the June expiration on the 4th of June expiration, 57 calls. This stock at 56 bucks. I bought those calls, Scott. I'll be in this trade probably 2 weeks.
Okay, good stuff. Doc, thank you. Another break, then final trades. All right, Disney reports after the bell. We'll do that before we do final trades. Brenda, 178. This stock has had a magical ride.
It has, and I think that, you know, all eyes are going to be on the subscriber number for Disney Plus, especially given Netflix's disappointment here. So wanting to see that subscribers are still coming to Disney Plus and are still engaged, I think that's going to be important. And also, obviously, the reopening of the parks and understanding how that's going. So those two data points, I think, are the ones that are going to be probably the most relevant here.
Doc, you got some options action in this thing. You own Disney Calls, so you must be paying attention to it.
Yeah, and I'm heavily writing upside calls against the calls that I own, Scott. The straddle, the combination of the call and put, trading at $7. That means they're expecting a relatively small 3.5% move up or down. So that's why I'm heavily selling upside calls against it.
I mean, the stock has had an obviously good run. However, I mean, it is in question over the last
big correction since then.
I mean, the most recent period. You know, as you think about how much is already in the name, right, Doc?
Yeah, exactly. I mean, it's down from 201 to 178 right now, Scott, basically in the last 2 months. So it's show me time for Disney.
Yeah. Well, you'll hear from the CEO, Bob Chapek. He'll be on Fast Money tonight, 5:30 Eastern. It's a first on CNBC interview. He's going to react to the numbers and take questions from the gang as well. We'll look forward to that, see where Disney shares end up trading after the bell. Mr. Wonderful, the big buyer today. What's your final trade for us?
I'm going with Apple. Apple's only fault is that everybody owns it already. But I think it's going to show some amazing performance in services, which is really a very profitable business.
Yeah. I mean, that's really such an important stock to watch, maybe to really figure out whether the correction has run its course. If you can get some traction, Kevin, in Apple at $125 finally, maybe that will be the best sign yet that the NASDAQ is going to stop going down and the overall market can get some pace to it as well.
It's correct. The trouble is I have a 5% weighting. I'm right at my limits like many other investors. That's the problem.
Yeah, I hear you. Brenda, final trade, please.
Affirm Holdings, so this is a newly public company, just reported their second quarter where growth metrics beat expectations. It's a pure play in the buy now, pay later space, which we think is only going to grow from here.
Okay, thank you for that. The reformed broker, otherwise known as Josh Brown.
Hey, Judge, I'm going to go with Uber. This is a stock that just a few weeks ago was at 61. Now it's at 43. And the only thing that's changed fundamentally is that things have gotten better and brighter. We are going to see the rides business explode in the second half of this year. In the short term, there's a focus on some labor issues. I do not think that those will linger for very much longer, and this stock will work.
All right, good stuff. Doc, I need a quick name.
EHang, it's autonomous aerial vehicles. Right. Bought it during the show.
Good to see everybody. The exchange is now.
Thank you, Scott. I'm John Fortin. Here is what's ahead. Despite another inflation gauge coming in hot, markets don't seem to be bothered by it. So what's different today? Plus, do small names equal big gains? A 5-star small cap fund manager joins us with 5 names to buy now. His fund is up more than 80% in a year, twice the returns of the overall market. And show me the money. Coinbase set to release its first report since going public. We'll take a look at what to expect following its recent roller coaster ride along with the crypto market. But we begin with today's rebound. Dom Chu with those numbers.
It's losing just a little bit of steam, but not a whole heck of a lot. It's still predominantly green across the board. You can see here the Dow Industrial is up by 400 points, 1.25% gains there. The S&P 500 now above 4,100, about a 1% gain there. And the NASDAQ has resumed the kind of underperformance spot. It's only up about 1/3 of 1% at this stage here, but the NASDAQ composite still above that 13,000 level. We'll continue to watch that trade play out. Now, the mega cap technology / consumer discretionary / communication services trade continues to be a focus. Who's buying what dips and where are they doing it? In mega cap stocks, Apple, Microsoft, and Amazon. These stocks are getting a bid in today's trade. Amazon a bit more, less so, about 1/4% to the upside today. But Apple is still about 14% off of its record highs. Microsoft is about 8% below its record highs. And then Amazon is roughly 11% below it. So watch those names. They continue to be on shopping lists at various parts of the street. And then it's Bitcoin. Again, Elon Musk saying that Tesla will no longer accept Bitcoin as payment for its vehicles. That sends shockwaves through the entire crypto industry and the crypto markets. Bitcoin continues to be down about 10% right now, according to Coin Metrics, now below 49,000 per token. Some of the names in that ecosystem with regard to having Bitcoin in their balance sheets or trafficking in it, or maybe not so much. Tesla down 3.5%, Square off by 5%, and MicroStrategy down by 9% as well. So we'll keep an eye on those Bitcoin and other cryptocurrency related names in today's trading. They are not catching a bid, John. Back over to you.
Elon giveth and Elon taketh away. Dom, thanks. Now, what a difference a day makes. Yesterday's CPI number for April, the biggest inflation jump in more than a decade, sent investors running for the hills. So while the averages are shrugging off today's hot PPI data with their biggest gains in over a month. So are investors ignoring the data or simply bottom fishing here? For more, let's bring in David Leibowitz, global market strategist for JP Morgan Asset Management, and Shi Chao, financial advisor at UBS Global Wealth Management. Good afternoon. So is it that this inflationary thing, I mean, we see the gas prices, we see the food stuff. We talked to Jane Wells about that yesterday. Is it just that it's a short-term thing? Is that why the market's shrugging it off?
Well, we believe inflation will continue and it's going to be transitory. So we're still very much interested in staying invested in the equity markets, and we believe that the equity rally has more room to continue here.
And David, do you agree here, or is there something that we should be paying more attention to, because it seems like these could be catalysts perhaps to really push inflation that would make sense structurally based on what's happening elsewhere?
So, I think what's most interesting about the CPI report yesterday and what we saw with inflation expectations was that you saw this big upside surprise in the actual inflation report, but you actually didn't see inflation expectations move around all that much. And so what that says to me is that investors are still very much of the view that this inflation will in fact prove to be transitory. But if this inflation is coming in hotter than a lot of people had originally expected, that could pull forward some Fed tightening. And I think that that's part of why, if you just look at today's action, the rebound in things like the Dow and the S&P, where you have a little bit more cyclicality relative to the NASDAQ, reflects this idea that we will see higher rates, we will see a bit more inflation, and that's obviously a challenge for tech, but a tailwind for those more value-oriented parts of the market.
Now, Shi, we just saw these really strong earnings from big tech companies, which would suggest that they're a safer place to be, at least because of their heft and their consistency. And we've seen some of the momentum names, some of the riskier tech names come down. So which do you go with? Do you go with the bargain hunting in some of the cheaper tech names, or do you go with the stability in the bigger tech names?
Tech has always been a long-term thing for us. So actually, at this point, we want to, with the strong earnings growth, and this is great for mega cap stocks, but we still want to avoid over concentration in the mega cap stocks and perhaps look into some of the earlier stage mid cap, small cap growth tech companies as well. And in general, as we still are positioning for this reflation trade, we think just outside of tech, small and mid caps and emerging markets are great things to look at overall, so investors can concentrate on a more diversified portfolio instead of focusing completely on tech at this point.
Okay. And David, so how much room do you think the reopening trade, if any, still has to go? Is all of that sort of priced in? How should an investor who's thinking about how the overall environment is shifting play that in equities?
Absolutely. So I think just on the tech point, we would agree, it should really be a secular and structural allocation within portfolios. We would gravitate towards those names that have more proven cash flows and more proven streams of earnings, given the expectation that rates will rise during the second half of this year. And we really want to complement that very high quality tech allocation with allocations to things like financials, industrials, and materials. I think the back half of this year is going to see an improvement in the pace of economic activity. You're going to see inflation expectations resume their upward trend. And all of that is very supportive of value relative to growth. And so it's really about owning growth and renting value right now when it comes to building the optimal equity allocation.
Okay, guys, stick with us. Let's pivot to the bond market right now. He teased it yesterday with the 10-year, but now we got the 30-year bonds up for auction. Rick Santelli tracking that action at the CME. What's the demand like, Rick? John, a lot different than yesterday's really good A-minus 10-year. This one goes all the way to the bottom of the class. We give it a D as in dog. And really, the main reason of that pricing, it was that pricing was so sloppy. So we had 27 billion 30-year bonds completing a trio package of 126 billion of 3s, 10s, and 30s. The yield at the Dutch auction, 2.395, just a whisker below 240. Now look at intraday chart. You see the way the rates are rising up? We're done with supply, and even with this big concession that we've seen rates rise, price go down, they stepped up for 10s. They're not stepping up for the longest maturity, which is very unusual, of course, because at 240 or just a whisker under, you're competing with inflation. You're getting a pretty good return. But many of the reasons why investors aren't stepping up may be due to some nervousness regarding the hotter CPI and hotter PPIs today. If I go through it, everything was about average, except for the bid to cover was a little bit light. There was actually some strength to this report. We saw the direct bidders, mutual funds, insurance companies, pensions, they were a bit above average at 20.1%. But none of those metrics could save the nasty pricing, meaning they had to scale back higher yield, lower price to move the paper. John Ford, back to you. Rick, thanks. And I know you said that you guys are taking a longer view, so maybe today's bond news doesn't make you shrug at all. But does this at all affect your outlook or your interpretation of what the markets have been doing this week?
No, we're still sticking with our long-term themes, and we want to stay with equity, especially in this environment with the rising inflation, and also look into just, again, not just technology, but diversifying the portfolios. And if you're going to focus on technology, not over-concentrate in mega caps and look into small and mid caps as well.
David, in the look at small and mid caps, are there themes in particular that you would emphasize heading into the back half of the year?
So I think that there are two really big themes coming out of, or three big themes coming out of small caps that investors should focus on during the second half. The first is going to be financials. You know, the composition of the financial sector within the Russell 2000 is far more weighted towards regional banks that will benefit from a steeper curve vis-a-vis an increase in net interest margins. So that's the first trend that we see in small caps playing out during the back half of this year. The industrial story is really a play not just on reopening in the United States, but reopening more broadly around the world. And I do think that you'll see industrial companies across the capitalization spectrum do quite well here over the course of the next 12 months. And then the third is kind of reminiscent of 2020. You know, we still see a lot of value in small cap healthcare, particularly the biotech space. It's commanded a lot of attention given everything that's gone on with the vaccines during the past 12 months, but we think that there's still a tremendous amount of room for those assets to run longer term.
All right. Some narratives there for investors to follow as well. Thank you, David Leibovitz and Shi Chow. Now, small cap names have not been immune to this recent sell-off. The Russell 2000 lost 5% since Monday, and the Russell 1000 is down 3%. So could the sell-off be creating buying opportunities in an area that hasn't gotten a lot of love? Joining me with some picks in the small cap space, Brian Smolik, the principal at Hood River Capital Management, portfolio manager of the Hood River Small Cap Growth Fund. Morningstar 5-star fund is up 81% over the past year, outperforming every major index. So, Brian, we want to hear your picks with that lead up. You got 5?
Thanks. Yeah, the pressure's on, I guess. So yeah, I did throw up 5 picks: Kinsale, Telos, Purple, Health Equity, and Lovesac. Talk about Telos first. They actually report on Monday. So one of the great things about small cap is that it's more inefficient than large cap. So there might be only 6 or 7 analysts that are covering it, and you can buy great companies at great valuation at the traded discount to either large cap comps or other small cap comps. Telos is a cybersecurity company. It trades around 5 times sales, 30 times earnings, and I expect on Monday, due to the activity and the bookings that they're seeing in the core business, to take up guidance for the full year. The Colonial Pipeline hack is good for their business. They've announced they've announced. So what Telos does is they help monitor all the cybersecurity infrastructure for the U.S. government and soon for corporations. They're rolling out 2 new products. So this Colonial Pipeline hack highlights the fact that more of their service offerings needs to be implemented. And so I would expect an acceleration in demand for their primary products due to the current cybersecurity environment. A couple of the other picks I have are Kinsale. It's an excess and surplus insurance company. They're benefiting from a lot of pricing. Pricing's up around 15% or so because capacity's been taken out of the industry. There's been some multiple compression over the last couple months here. There's been a rotation from value to growth, and this is a growth name I think you want to own. It's trading around 30 times earnings.
Now, what about Purple? I mean, isn't this one of those mattress companies that ships out the mattresses? I would think with reopening, there might be more people going to stores and wanting to bounce up and down on the mattress. So why would this be a pick now?
So the Smolix did just buy 3 Purple mattresses, so we're actually a fan of the product. It has a great polymer that allows you to sleep less hot. Foam mattresses. It's the only non-foam mattress that's really available. They actually have IP around it. They're selling both in stores and DTC. So really they benefit from bricks and mortar stores reopening. And they just reported a quarter that was great. They just pre-announced upside on revenues and on margins. I think it's going to continue for the rest of the year. It's trading around 30 times earnings next year. The street has 18% revenue growth. I think they're going to blow it out. And it's because they have great products. They have a new product coming at the end of the year, which I also think is going to be good.
Okay.
And they just have a differentiated offering versus other mattresses.
Now, give us the quick.
There's headroom in the market.
Give us the quick read on health equity and health savings accounts.
Yeah. So health equity we like because they're really the biggest player in HSAs, and they benefit from rates going up. So as short and midterm rates start to move up with inflation here and generally reopening of the economy, their margins, which have been under pressure, are going to really accelerate and will allow them to exceed estimates of trading at 20 times EBITDA. So we think the stock works nicely from here. So HSAs generally are growing.
How do you kind of keep your head in small caps in a market with this much volatility? What would you say to investors?
I would say small cap is always volatile. I've been doing this for 20 years. It's par for the course. It's always something different that's happening. You just got to stick to your process and what you do, and that's just knowing where the inefficiencies are and taking advantage of it, and trying to be agnostic to the macro market factors and not really try to time those things.
All right. Well, advice from a man who knows what he's talking about, with up 81% in a year, a lot better than the market. Brian, thank you.
Yep. Thanks.
Hood River Small Cap Growth Fund. Now, coming up, Apple, Amazon, and Google all hitting key technical levels. We will take a look at what the charts are telling us about where those stocks might be heading next. Plus, the sharing economy getting hit by the tech sell-off. Uber, Lyft, DoorDash, Airbnb, all down 20% or more in a month. But some of them are better positioned for gains than others. We will tell you who. That's coming up.
This is The Exchange on CNBC.
Welcome back. So is the recent dip in tech a buying opportunity or not? My next guest says the sector is tactically oversold for the first time since the pandemic started, but it might be wise to sell on any bounce from here. For more, let's welcome in Jeff DeGraff, founder and chairman of Renaissance Macro Research. Okay, Jeff, so let me get this straight. So if I'm already in tech, maybe don't get out right here. There's a bounce coming. But if you get in here, be prepared to get out real quick.
Yeah, I think it's tactical, right? So we've got an oversold condition, and that's really the first one that we've seen since the COVID crash a little over a year ago. But the problem is over the last 4 or 5 months, we've lost really relative strength leadership. And so that's the bigger concern. We always try to push into and make sure we're overweight leadership in the market. And really in the late January, early February, we lost that relative performance leadership out of tech. And so oversold condition, absolutely tactically probably get a bounce from here, but it's not a bounce that we'd be chasing. It's a bounce that we'd be fading.
So you're talking tech specifically. More broadly, there are people saying that this is healthy for the market if tech is not so much a leader. So this is in a way playing the other side of that, I take it.
It is, and I would agree with that supposition, which is 52-week highs generally are expanding, and that's a good sign, not a bad sign. It's very rare that you have 52-week highs on a net basis in the S&P 500 where they are today at a top. And so I think that money has moved out. It's gravitated to other areas, obviously more cyclicality, a little bit more of a value bias, but that tends to be more healthy than not for the overall and underlying equity markets.
Now, when you're talking about tech, are you talking about tech as a sector, or are you talking about tech like a lot of people think of tech as like Apple, Google, and Amazon being tech, even though they're in different sectors technically?
Yeah, so the relative performance that we talk about is specific to tech, though communication services has broken down. And you can see that in things like Netflix as an example, which is one of probably the weakest of the FANG names. The 50-day moving average is about to cross under the 200-day moving average. It's broken support levels. Once it breaks through 450 roughly, that would complete a pretty big top formation. This still could be a consolidation, so I want to be careful with that. But keep in mind that the relative performance of Netflix is really stagnated for about 9 months. It peaked last summer and really hasn't gone anywhere on a relative basis. So holding Netflix, you've actually been not keeping up with the equity markets, which is important.
Okay, so back to tech overall. What are the key levels that you're looking at now for the rest of the year to determine how this is playing out?
Well, look, I think, more than levels, we like to look at equal weight. And so that's not going to translate exactly with some of your viewers. But, keep in mind something like the 50-day versus the 200-day moving average, just some simple trend following technique. If that starts to roll over, and like we said, with Netflix, it's very close. With Apple, it's actually very close. With something like Google, Facebook, it's not close at all, right? So I think you want to look at it stock by stock. If the overall group says on an absolute basis starts to roll over, that becomes more problematic. It's already happened. If you use that same measure on a relative basis, that happened about 3 or 4 months ago now. So that's already happening. And we call ourselves incrementalists, right? That means as things start to deteriorate, we move out. We don't make big calls based on one indication. We just sort of, move in and out as we see fit. And that would be the next level on tech, would be that 50-day through the 200-day on an absolute basis. Would be more problematic overall.
So are you kind of saying that when we saw Apple dip, I think it was below the 200-day, earlier this week, might have been yesterday, that was just like one warning light on the dashboard?
Yeah, the penetration of the moving average isn't as important as some type of moving average cross. And what that does is it filters out some of the noise. What I really want to see is a good response to those oversold conditions, right? So if you get oversold and it's down there for maybe a day or 2 days and responds vigorously, that's a great sign. You're attracting buyers. What I worry about is when you have sort of persistent oversold conditions where the stocks can't react. That tells me then there's too much supply. It's probably under distribution, and at a minimum, it's going to be underperforming. Those become more problematic. We haven't seen that with Apple yet. We have seen it with Netflix, and that's why, on a stock by stock, case by case basis, there are a few things that we're concerned about in the NASDAQ and tech overall.
Okay, a nice look, a nice lesson. Jeff DeGraff from Renaissance Macro Research. Thank you.
Thanks for having us.
Coming up, the Colonial Pipeline hack having ripple effects on several industries. We'll tell you where and what it means for consumers. Plus, PayPal doubling down on e-commerce with product returns. But will that translate into actual returns for its bottom line? We will debate the exchange. Back in 2.
All right, guys, real quick, gut check here on cryptocurrencies. Looks like here in the last hour or two, things are starting to drop again. Bitcoin right now went from right around or just under 50 now to down below 30, down below 48. I just hit 47,995. Look at the Litecoin Trust over here is just tanking, and Ethereum tanking down to 36.22 from 39 here just about an hour ago. Really, really interesting to see. Wonder why exactly that's happening. Let's see if I can see anything in Bitcoin news. Let me go. Bitcoin news here on Thinkorswim kind of sucks. But let's see if I can find anything new here. And of course, I had a limit order for Bitcoin in at 48, and it just took. So, let's see if there's any news. That's a Bitcoin bomb show at the spotlight. So, crypto, just kind of this one. Price of Bitcoin Trust premium takes an all-time low of 20%. Yeah, I don't know, man. I think there might be very um, interesting risk right now of there being a bottom falling out of crypto. I don't know if it's necessarily going to fall to the crypto winter, but falling out of crypto is just going to lead to maybe a short to mid-term dip. Um, if the sustainability question is really what is leading the question, right? If that's really leading the way to why this is happening, then I think we might be in a situation where things might go south very quickly. So, and if it goes south, it might go south quite a bit. I mean, we may see a quick 20 to 40% dip on top of what we already see. So I could very easily, unfortunately, see that. Let's see where we're at here. Bitcoin is still dropping. Ethereum, we had it for a second and we're going to tick back up, but it's not. So we're seeing Bitcoin now 47,225 and continuing to drop down 13% today. And then we're seeing Ethereum down below level 36 for a moment. Litecoin Trust is just falling off a cliff over here. Look at Tesla itself is down nearly 4%, down to 466. It's the lowest we've seen Tesla in a very long time. You go back to the 180 day, and this goes back to January 12th. We'll go back a year. I mean, it had a nice dip right here, which got down to about 550. Other than that, it's the lowest it's been since November. So, yikes. Look at Bumble. Man, Bumble down to 50. They need to wish I could buy them there on Bumble too. I need to buy them. I just don't have the cash in my. I mean, I guess I do my Robin. Using my Robin account only for cryptos, which I know a lot of people want to criticize me for that, but they're going to talk something. They're going to go to commercial breaks. So, man, I don't know what's going on. It's crazy. The interesting thing is also yesterday when all that went down, SafeMoon tanked. I wouldn't say tanked, but SafeMoon went down, 10%. And when SafeMoon drops, the 10% of what is sold is recaptured and redistributed amongst holders. And I'm now at 30 million SafeMoons, and I only bought 29,500,000-ish, something like that. So I'm up nearly 1 million SafeMoons over the last month because of people selling them. So, 1 million, and if it goes up 0.00040 zeros and a 1, it's $10. So that's a free $10. I'm nearly at a free $10. I'm at a free maybe $5, $6, $7 right now. So it depends, of course, on the price of it. But yeah, I'm cool with that.
Are you stopping? We have our own lane.
And they're in the red for the year as they each face industry headwinds. Uber, Lyft, and DoorDash facing regulatory, supply, and labor shortages. Competition's heating up for Airbnb as the travel industry rebounds. D, we got earnings for Airbnb coming up. What is it that Chesky even could say to change the way people are thinking about this?
Well, I think that the way people should be thinking about this should be different from company to company anyways, right? You've got Uber, Lyft, and DoorDash facing a very certain kind of regulatory threat. And then you've got Airbnb, which has perhaps you could argue made a bit more progress with regulators over the years.
There's
But
any
I think
good
what
news.
Chesky has to do tonight is
to go up. It was chilling earlier, and then it just took another surge right there. I guess people are taking their money out of Ethereum and Bitcoin and riding the AMC wave. It may very easily get up to $12.99 and sell a bit. Actually, that would make my day. I mean, this part sucks, but that would make my day.
There is some evidence that that is working, but they're coming from a much lower base. So we have to distinguish between these sharing economy names. You're going to get much different stories from a DoorDash who doesn't know if demand for food delivery is going to hold up for the rest of the year versus an Airbnb, which has had more conviction when it comes to that rebound and their platform taking advantage of it.
Yeah, Ken, I wonder if this market is changing for Airbnb. Like there are these hotel listings that you see on it now in New York, and then the superhost, like there's competition for the superhost. It's not just sort of like an everyman thing anymore.
It seems like it. When you go on there, you see, right, things like hotels. I think it has added some liquidity to the housing market. If you think about owning a second home and the idea that you can rent it out, although I know in San Francisco in particular, there are some pretty strict restrictions on who can actually rent out their house. So I think that is something they could run into. You saw it in New York City. But one thing about the sharing economy that I've noticed and I've thought about recently as a lot of these companies go public, they have really been subsidizing some of the consumer costs. You know, if you haven't taken an Uber in a year, you all of a sudden go on to log on and prices have gone up. When that was a private company, they were able to sort of lower cost, acquire customers. I think a lot of us, even DoorDash, Airbnb, some of these companies that are now public and have had to raise prices, a lot of us are going to be surprised when we...
I did modify my order, changed my $12.99 order to 300 shares, and took rid of 79 and put it at 13, which would then give me at least a little bit more of a profit, not make.
So, John, I think the macro look for me is that you have to just understand what's going on here as you guys cover on a daily basis. There's this shift out of tech into value and out of that growthy areas of the economy. All of these names that we just discussed are in that tech/growth areas of the economy. So even though we are restarting the economy, things are, quote unquote, going a bit better. Blockbusters, people just tripping over themselves to do whatever service that they want. You're still going to have headwinds for these stocks because the valuation
My kid
is
just
off
screaming
the
out there. He knows
charts.
what's going on.
So to your point,
Man.
no, I wouldn't be dipping any
$12.95,
toe
just
in
barely.
those names. I
Now
do
it's
like
back off.
Airbnb's long-term strategy and prospects for everything that was just discussed, though.
Yeah. Okay. Well, now let's talk about some rough
See,
prospects.
turns back.
Bitcoin having a bad
It hit
day, at
peak
least. The
12.95.
cryptocurrency slipping nearly 8%, plunging yesterday in the wake of Elon Musk's announcement that Tesla is going to stop accepting
12.83.
Bitcoin for car purchases. Musk tweeting a statement expressing concern over Bitcoin's environmental impact, saying cryptocurrency is a good idea on many levels and we believe it has a promising future, but this cannot come at great cost to the environment. Other cryptos heading lower today too. This as Coinbase is set to report earnings after the bell. Kate, it's hard for me to believe that Elon Musk just sort of discovered the environmental impact, but boy, just in the past hour, Bitcoin is down 6%, shaving what, about $3,000 off?
That's one of the big takeaways is how did Elon Musk not realize this before? And one of the big highlights here we should focus on is he's not selling Tesla's stake. They own Bitcoin on their balance sheet. He's financially incentivized to help make this a greener proposition in the same way that Jack Dorsey from Square is. They put out a white paper and wanting to make it greener and more sustainable. One of the things within the crypto community that's popped up is sort of the debate here of if Bitcoin is not environmentally sustainable, will others pop up? There's something, I won't get into the weeds, but proof of work, which is the way that Bitcoin is mined right now, it's very energy intensive, versus proof of stake, which is another sort of more software-oriented version of doing Bitcoin mining. Ethereum, for example, is sort of moving towards that model. So it has kind of brought up this green debate that's been there the whole time. You know, you mentioned on Tech Check earlier, there are certain things there are good things that could come out of this that could incentivize some people to move towards sort of a greener model of Bitcoin mining. But
12.91. I just put another one.
And
little
shocking
over,
that
a
this
small
has
little
not
over
come out, or that
47,000
Tesla
for
has not
Bitcoin.
gotten more criticism for this early on.
We will see how things go. I'm
We're
not
keeping our eye
really
on the markets,
excited
of
about
course, as always. We're going to show you the NASDAQ,
bearing
which
down
has
past
lost its
36.
gains. I mentioned that it was right on the border. Now
7.
it is down about
Oh man, now we're seeing the
a tenth
Nasdaq
of
turn
a
negative.
percent, a little bit more than that. It was up 1.6% at
I mean,
highs.
my portfolio
Also,
obviously has been
let's
down a
see.
little bit all
Do
day.
you want to do that programming note
Some of the
now?
algorithm
Don't miss Jim
stocks
Cramer's interview with the Coinbase CFO on Mad Money tonight.
one
We're
of my
talking about crypto
Bitcoin
at 6
trusts.
p.m. Eastern. Now, let's keep it with money and talk about PayPal because it's making another
Right.
acquisition in the e-commerce space.
Bitcoin trust.
Digital payments company is buying startup
God
Happy
damn,
Returns, which lets
15%.
people
There it goes. There it
return
goes.
online
AMC.
purchases
Yes.
in person.
Oh,
This
it's
deal follows
somewhere.
PayPal's $4 billion
That's
acquisition
why.
of
So
Penny, the
I've
coupon browser
sold
extension, and its purchase of cryptocurrency security firm
some of
Curve for
it
$200 million.
some sort of
Happy
a
Returns brings the fintech giant into online
if they can
and
get
the
past
physical
13.
retail world.
There's going to be
So
so many,
this is
so many
PayPal
limited
continuing along that
$12.99
omni-channel
added
track
on that
that
number.
you
So
could argue
there
it's
goes
been on for a
13.
while with
Very
credit
briefly.
card swipe and whatnot, but this is definitely another
If it
touchstone.
pushes past to like 1302,
That's right.
1303,
Things like
I think
QR
we
codes.
might
Dan Schulman on the earnings
continue to
call
soar here.
last week mentioned online retail sort of merging with physical retail. This is sort of the
Of course,
maturation of
it
PayPal in terms
bounced
of
off
moving away from payments,
12.99 and
things
goes
like
down.
returns that don't
After that, it pulls them
logically
over
really
to
fit
6.
into PayPal as just a payments platform. They're really trying to become the one-stop shop for merchants. And they said, I talked to a couple executives who said, this deal in particular puts PayPal in a competitive position. A merchant
He's
that's maybe
bouncing off
deciding
13. It
between
hits
Square
13
and
and then it
PayPal
bounces
for
right
some of
back
these
up.
things
It's going to be
might say,
so
oh,
many.
well,
Oh, there it goes.
returns can be
Oh, crap.
sloppy. It's often
Oh,
a
man, it just
headache
passed
for them.
1313.
It's not necessarily a
1307 real
moneymaker for
quick.
PayPal, but it's another reason
Here we go.
for
Here we
someone to
go. Here we
choose
go.
PayPal over Square, for example, or some of the other
Let's do
options
it.
that are out there. But definitely a sign of PayPal sort of maturing into other markets. But yeah, happy
1315.
returns. I
Let's
keep
go.
wanting to call it healthy returns because we have a conference called Healthy Returns. But
Yeah, different thing.
interesting deal for sort of the future of PayPal.
Grasso, are we seeing a bit of a different strategic direction here between PayPal and the likes of Square? I mean, Jack Dorsey's kind of hanging out with Jay-Z doing the title thing, talking about cryptos, and Square is getting closer to brick and mortar retail in this omni-channel story. Should investors pay attention to that?
I was a shareholder in Square a long time ago. I actually bought it in the teens, and it was a very great. It was a great investment for me. I'm out of the name now, but John, I think the data processors are hitting headwinds right now for the aforementioned issues about tech and growth. But if you look at PayPal, they have over 21 billion in revenues that are coming from consumer finance. They're not changing their stripes. And I don't think Kate meant that. They're offering services to continue to hold on to what's been the behemoth in the space. So Square is really taking it a lot harder than PayPal. Both of them have headwinds, but PayPal seems to be the crowd favorite as of late.
All right. And finally, McDonald's and Amazon are trying to get competitive in this tight job market. McDonald's is raising the hourly wages by an average of 10% for its U.S. company-owned restaurants. This is the fast food chain looks to hire 10,000 workers. Meanwhile, Amazon going on a hiring spree, looking to bring 75,000 workers on across its warehouse and delivery networks in the U.S. and Canada. These jobs are going to offer an average starting pay of $17 per hour, reflecting its recent wage increases. Dee, I said Canada, so I'm going to come to you first on this. There's all this talk about how, businesses can't get workers to come to work. Amazon hired 500,000 people in 2020, either directly or as contractors, and now they seem to think they can hire even more people. Maybe benefits are part of the issue. Hold on. We got some breaking news out of the CDC. Let's bring in Meg Terrell for more. Meg?
Hey, John, our friends at NBC are reporting that the CDC is expected to issue new guidance today saying that fully vaccinated people don't have to wear masks indoors in many circumstances, saying that this guidance is expected to come at the 2 o'clock White House COVID briefing, that the CDC director, Dr. Rochelle Walensky, will say something like, this is the moment we've longed for. saying essentially that people should still follow guidance of businesses to wear masks indoors, but also in terms of outdoors, the CDC will now recommend that fully vaccinated people don't need to wear face coverings in crowds outside. So this is a change. They, of course, John, just updated their mask guidance for outdoors for fully vaccinated folks, now taking a step further, apparently going to cite the information about the efficacy of the vaccines in saying that in many circumstances inside, you also don't need to wear masks if you're fully vaccinated. John, back to you.
Meg, I want to talk about this for a moment because it's like we've got this culture war that's happening about masks lately, whether you wear them or not, even if you're vaccinated. Is it as a courtesy to other people, or are you just signaling in a way that's not healthy? Tell me how this has at least been working. The CDC gives guidance. Does that then tend to filter down to what states do and then what businesses end up doing?
Yeah, absolutely. I mean, the CDC is the chief public health agency of the country, and so many states do take their signals from the CDC guidance, and many businesses from states and from CDC as well. And so it's going to be really
Good
interesting, John,
information. I
especially
mean,
for the businesses
I
side. You know, when you don't
specific
have the
guidance there,
CDC saying that everybody
but
needs to wear a
it
mask
does sound
indoors
good.
right now, how do businesses prove that somebody is vaccinated? I mean, there are so many complexities to this, and it'll be very interesting to hear how the CDC director actually talks about it at 2 o'clock today, how they answer these questions, because you're right, there is such a huge culture war around masks, which essentially has been going on for the entire last year. The nature of the culture war has changed, but the culture war has been going on. And so many people may not even feel comfortable taking their masks off, whereas others have felt comfortable for a long period of time.
Now, and I guess the question is going to be, are you going to feel comfortable showing proof that you're vaccinated if you don't want to put your mask on? Meg Terrell, thank you. Important update. Now coming up, we've all seen electric vehicle charging stations, but what you might not realize is most have individual apps that drivers need to use to charge their cars. We'll talk to the founder of a company that is working to streamline the charging process next. And take a look at the NASDAQ once again turning negative into afternoon trading. Pinduoduo, Tesla, and Zoom are the biggest losers right now. We'll be right back. EV stocks having a draining month. Tesla and Blink down more than 20% and Workhorse down more than 40%. One thing holding them back is what The Verge is calling America's broken EV charging system. It's also the #1 reason why roughly 20% of EV owners in California switch back to gas-powered vehicles. That's according to a study by the University of California, Davis. Aaron Fisher decided to do something about this. He is the co-founder and CEO of EV Passport, building a no-app, open-to-anyone charging network. He was featured in that Verge article, joins me now. Aaron, how does this business work? I understand the need for it, but how much is this like gas stations? And I guess you want to be the trusted provider that makes it easy for people?
That's exactly right. So when it comes to getting gas right now, you can easily walk up as a driver and pay in order to obtain that and fill that into your vehicle. When it comes to filling an electric car right now, it's like imagine if when you went to a gas station, you had to have a separate application, a separate account, and a separate topped up balance for every single major gas network. And that's exactly what it's like charging an electric car in America with every network that's not EV Passport.
So the business model here, do you actually get the power from the landlord, build out the charging system, and then somehow the landlord gets a share of what's charged, or you're taking the risk that people are actually going to use it? How does that work?
So EV Passport is a hardware and software company. We sell to businesses of all shapes and sizes, whether they're hospitality, apartments, condominiums, universities, retail, or parking operators. And what we do is when we install the hardware and have the software on it, it allows them to engage and provide a better experience for their customers when they come to charge their vehicle. And then at the end of every month, the owner operator receives a direct deposit for their earnings.
Okay. Now, how much usage, what kind of volume do you need for this to be profitable?
To be profitable right now, it's really focused on getting them out there. You know, the average increase year over year for electric vehicle sales is 40 to 60%, and it only continues to climb, especially as the rate of gas continues to go up and carbon emission goals continue to get stricter. And so right now, it's really about creating infrastructure engagement. And you have, in my opinion, every space that doesn't have an EV charger is opportunity space for a business in order to create value, especially as we emerge from COVID.
So in a way, would you say you're a bet that the EV market is bigger than Tesla? I mean, because Tesla's got its own charging network, but if anybody else is going to really be able to grow, they're going to have to rely on a network like yours.
Right. And to be honest, when a Tesla driver goes anywhere else that doesn't have a supercharger, they also have to engage with those other networks.
Are there that many places like that? What do you think demand is really going to be like? How much of your demand is going to come from Tesla owners?
Right now, you know, it's pretty even because if you're a Tesla driver, if you're a Volkswagen driver, if you're a Ford Mustang Mach-E driver, and you stop off at a supermarket or you live in an apartment building where there are chargers, you know, you don't really have a choice on what you're using. It's really based around where you go. And we've actually seen a lot of users start to really create behavior change, and they're actually making decisions on where they go based off of if there's chargers and if there's not chargers and what the experience looks like for them.
How important are low interest rates to what you're trying to build out here? I mean, it sounds like you've got some real capital costs up front, and then you got to, you know, expect the volume to come as EVs scale up.
Well, what's important to highlight is we sell the chargers to the businesses. So once we sell the chargers to the business and it gets installed, it's all opportunity from there. Now, what is also important to highlight is that there are various government programs at the state level that will actually pay for not only the hardware, but also the installation. And so with our prices, we start at $999 for a revenue generating charger for a business, where ChargePoint, for example, starts at $4,000 for a business. So when New York State comes and says, we're going to give you a parking operator $4,000 with our hardware and software, that covers the hardware and the installation for the business.
Got it. Got it. Makes sense. Aaron Fisher, thank you.
Thank you.
And still ahead, the Colonial Pipeline might be back online, but consumers could be feeling the ripple effects of the shutdown for a while, and not just in gas prices. Our Frank Holland is in Georgia with that story.
Hey there, John. A lot of frustration with regular gas pumps today, especially here in Georgia, where nearly half of gas stations, they don't have any gas. That Colonial Pipeline hack causing gas prices to rise all around the country. Coming up, I'll tell you how it's going to cost you money in other ways. That and much more on The Exchange.
prices climbing by 8 cents in the past week as the Colonial Pipeline shutdown sparked fears of shortages throughout the Southeast. Frank Holland is live in Georgia with a look at the widespread impact. Frank?
John, nearly half the gas stations here in Georgia are without gas even after the reopening of the Colonial Pipeline. It's a situation that's continuing all throughout the southeastern states and now even beyond. North Carolina is still the hardest hit at 68%. Virginia, more than half of stations with outages. Tennessee, more than a third. And that spike on gas prices also continuing. Regular unleaded now more than a quarter higher than a month ago. Diesel fuel rising 71 cents over the last month. And it's fueling an increase in trucking rates. They were already at an all-time high. And it can really lead to an increase in price of things that we all buy at grocery stores and convenience stores because it's increasing the cost of shipping for stores like Walmart, Target, and Albertson.
So you're getting these products very quickly, even on a daily basis.
There goes, guys. That 1349 right there was my order.
If your freight costs are going up,
I've done that before. I did that with DoorDash, where my order was literally the peak. I've also done that, been close to doing that on
And trucking rates for just general goods, consumer items, electronics, etc., food and grocery and industrial
this
items were all on the
1349
rise last
order
week
took.
before
I
the
am
Colonial
proud
Pipeline hack,
on
and they're already again on pace to shatter their
share
all-time record that was set
of
just
AMC.
back in March.
I
John, back over to you.
wonder if
I'll
you're
be
hearing
honest,
anything about.
I'm
We're getting
excited.
these pictures from
Being
friends in the
proud owner
southeast
of
of
one share
people
of
with
AMC.
pickup trucks with barrels in the back
So
holding gas.
I
Is
have
that actually
now
happening?
officially
That's
year-to-date
100%
profit
happening. I
on
haven't seen an
AMC.
entire barrel, but like a lot of people have these red canisters you might use for your lawnmower and having in your garage. And I've seen somebody run into a store, buy 3 or 4 of them, and then run back to the gas pump when you actually find a station that has gas, which is pretty rare. This one behind us had gas last night, came back this morning, no gas at all.
I can't complain that much.
Gasoline is the new toilet paper.
I had issues
Frank
with
Holland,
things.
serious situation though. Thank you.
So
That'll do it for the exchange. Coming
I'm
up,
looking
the
at
power
it,
lunch.
it's not
Shares of thread up, sinking today on a wider than expected first
excited
quarter
just
loss.
from under that.
CEO James Reinhart joins us in an
And
exclusive
same
interview to
with
discuss.
same with
I'll
GameStop,
join Melissa Lee for
honestly.
Power Lunch after this quick break.
Do we need to replace our gutters? Great question. We folks are to be installed right on top of your existing gutters.
GameStop now up pretty good. You know, hit 164. It's up 11% today, so not as big as AMC. It's got it down there in the bottom left. Replaced Tesla because Tesla's doing crap today.
I went to the search bar and I searched on coronavirus. And what popped up were the old coronavirus from the CDC. That led me to.
So even though today's going to be a crappy day overall with both the cryptos and some of my growth stocks, I am incredibly excited to unload $2,300, $2,400 worth or so of AMC stock that was earning me nothing over the past 4 months.
much. I'm Melissa Lee along with John Fart. Markets bouncing back today, but the Nasdaq briefly turning negative as stocks are still staring at a wall of worry. Inflation, the big one, of course, but we're looking at the other issues facing stocks in several different sectors.
And we are talking to the CEO of ThredUp, that stock falling after its first report as a public company. Are the trends working against the secondhand retailers?
And Elon Musk putting his Tesla in reverse and backing up over Bitcoin. We'll put his comments on crypto under the microscope. Power Lunch starts right now.
Hi, everybody. I am John Fort. We begin this hour with the bounce back in stocks, which is fading. As Melissa mentioned, the Nasdaq had briefly dipped into negative territory. It's now barely in positive territory. Let's bring in Bob Pisani now. Bob?
John, we are up, as you mentioned, but well off of the highs. The real problem is there's selling pressure again in the thematic tech space that we love to cover. I'll show you that in a minute. Take a look at the sectors right now. We started off the morning with technology well in the lead. That's reversed a little bit now. The reopening stuff, materials, industrials, bank stocks, all leading now. Tech's still up, but off of the highs. Energy's lagging today, but remember, had a good day yesterday. Oil was near a new high. Mega cap tech's still up, but off of their highs, sort of either side of positive or negative. These stocks were all notably higher on the day. Semis were high right at the open and have essentially been sliding throughout most of the day. We want to keep an eye on that thematic tech. And remember what I mean when I say thematic tech. Kathy Wood's ARC funds, there's 4 or 5 of them. Clean energy funds, 3D printing, cloud computing, cybersecurity. That's thematic technology. It was a darling last year. It's had a tough time this year. And you see all these were up today after a big down move yesterday, and they have all now turned negative. Particularly want to watch things like cloud computing stocks. We've been talking about these for the last 2 weeks. Most of these names are 50% off of the 52-week highs that they hit back in February as interest rates started moving up. These all started the day up about 1.5%, 2%. As you see, they've all, by the middle of the day, moved to the downside. This is what I mean. There's still not a clear bottom. We've been debating about when there might be, but it's not there right now. So where are we right now with the technology stocks? The big debate is these thematic tech stocks, down 25 to 50%. How much is enough? We have obviously fundamental people, investors don't want to touch these, so the momentum people are trying to figure out when can you go back in. Obviously, today, still not quite the day. Major tax bill is unlikely has been a very big positive for the market recently. We had more confirmation of that yesterday. I still think that's a major theme. The big issue, of course, is the Federal Reserve and whether or not inflation really is sticky and whether the Fed is going to have to do something earlier. That is the major market risk right now, and that's the unresolved situation now. Who's right? Are the bond vigilantes right that the Fed's going to have to do something earlier, or is the Fed right and most of this that we're worried about, this inflation, is transitory? Guys, back to you.
All right, Bob, thank you. Let's ask Rick Santelli that very question. He's tracking the action at the CME, and bond yields today, at least, Rick, are down.
Yes, they are down, but the problem is they're down from 6-week high closing yields yesterday. Let's start at the beginning. Here's a 30-year bond chart. The auction was not pretty. I gave it a D. And as you see, we spiked at 1 Eastern when the auction ended. Here we sit now at 239, down 2 basis points. Right around 6:30 a.m., we had the high yield of 241, so it has slipped. Here's your 6-week chart I was referring to on 10-year note yields. Yes, at 166, we're down 3 because yesterday's close was a 6-week high. And if you open that chart up to year to date, we are up 0.75%, 74 plus basis points from beginning end of 2020 on a year to date. And if you look at a year to date on the gilts and a year to date on boons, both are basically at fresh 2-year high yields. The gilt is up 70 basis points on the year, and the boons are up 45 basis points on the year. So the global sovereign picture is definitely painting higher rates. But looking at today and yesterday's inflation data in the States, it certainly seems though Treasuries are digesting the news rather well. John Fort, back to you.
Rick Santelli, thank you. Stocks now still rebounding today, but trimming those gains. The Nasdaq briefly dipping negative, as we said, back in positive territory now. 10 of 11 S&P sectors higher today. Only energy is falling at the moment. So if you're looking to take advantage of this week's dip, what should you be buying? Our next guest says she is looking for mispriced stocks with idiosyncratic stories. Let's bring in Jana Barton. Jana Barton, manager of the Eaton Vance Focused Growth Opportunities Fund. There should be a Bumble for finding stocks like that. Such character, the way you phrase that. And I know you're not going to give us specific names because you're really active, but what do you look for to find something mispriced in this market where valuations have been so high?
That's a great question. I think for backdrop, first and foremost, well, we have seen a return in the volatility with VIX finally up above 20 level. I think it's important to say that the correlations within the market are still very low and declining, while the spread, meaning the dispersion of return, is very high. And the reason I mention that is this is the optimal time to be a stock picker and picking your spots when there are these sort of unforeseen market sell-offs. And we've seen a few of those, particularly within the growthier areas of the market, in healthcare, consumer, industrials, and actually, obviously, very much in IT as well.
Now, I see healthcare is one of these areas. You've got robotic surgery, genomic research, life science tools. Is the elective surgery, return part of that story? Why do you think some of those are mispriced?
That's exactly it. I think one of the themes that we learned during this earnings season, which was a record-beating earnings season for S&P 500 companies, is there's really this resurgence both in potential CapEx activity as it relates to these med devices and expensive equipment as it relates to robotic surgery, but also just increase in trends and surgeries. When you think about genomic sequencing, I think we just went through the biggest experiment of our lives, where within 2 days we sequenced a virus, and within 42 days we actually had the batch that became the vaccine that, by the way, was 95% effective. I think it has forever changed the landscape of drug development and therapies, particularly within the rare diseases that are 80% of which are genetic in nature.
Now, see, another one of these areas that you've got is consumer staples, select discretionary. We've seen so much disruption there, not only with the pipeline stuff that's causing people to hoard. We had the canal earlier. What's causing the dislocation there as far as where the value is?
Well, I think they're the ultimate reopening trade. As we look at the statistics, you've got approximately 46% of U.S. population that has received at least one shot of the vaccine, which means we're all eager and willing to get out there, which means it's good news for food distributors, restaurant operators, park, entertainment, and so forth. And particularly in a time where I think there's been a lot of disruption to the industry, meaning there's a lot of consolidation, which could lead to pricing power for those that have taken the cost they needed to because of COVID and can remain strong and have the scale to continue to operate in this sort of post-COVID world.
All right, Yana Barton, thank you. And now
Sure.
we've got a news alert on that Colonial Pipeline hack. Eamon Jabbers joins us. Eamon?
John, I can confirm that Colonial Pipeline did, in fact, pay a ransom. This, according to a source familiar with the situation. Colonial Pipeline paying a ransom to the criminal hackers who shut down their systems last week. Now, this source familiar with the situation not telling me how much Colonial Pipeline paid or when that payment specifically was made. There's some reporting out there from other outlets in conflicting directions on the date of this payment. One outlet reporting that happened on Friday, another outlet reporting that that happened on Monday. Other outlets are putting a specific dollar figure around that payment as well. My source familiar with the situation simply confirming here that Colonial Pipeline did, in fact, pay that ransom, but no dollar figure or date associated with it. Meanwhile, we saw the President of the United States ask today whether or not he had
Man, look
been
at
briefed
AMC
on the fact that Colonial
GameStop.
Pipeline
I mean,
paid
it's
a
back came
ransom.
out
The
of
President
nowhere.
declined to
See up
comment
to
to us to get some sense of
14.2,
the sensitivity around
up
this.
to
The question of whether or
164.
not a U.S. entity
I mean,
had to
yeah,
pay
it's that
to
on
Russia in order to get
$100 on
access
that,
back to
hanging
one
on
of the
to it
major
for
strategic pieces of
13.9%
infrastructure
back,
on
but
the east coast of
man,
the
I'm
United
excited to
States.
just
But
get it
that
off
said,
my
a
phone.
source familiar with the situation now
Right?
confirming that that ransom was
I
in
knew it
fact
could
paid.
get back up to 14. I
So we
wasn't
know
really
they
expecting
paid
it to
at this point, Eamon. Do
pay.
we know
It
how
opened
they
at like
paid? In what
10.8 or
currency?
something
What
like
form
that.
of currency
So
they
it's
paid? And if
crazy.
there's any thinking that they
37%
paid a ransom in
nearly.
order for that money to
GameStop
be
just in the
tracked?
last couple hours has taken off.
Well, that's a good
I
question.
really
We
wonder,
don't
is there
know
a
from our
correlation
sourcing
between
how they paid.
GameStop and
Traditionally,
AMC?
in these ransomware attacks, they do pay with
It's a lot of
cryptocurrency. Monero is usually the one that's most often requested by
started
criminal hackers because it's
better
said
than
to be
12
harder to track than Bitcoin.
was word
We don't know in this case
start to
how that transaction was handled, whether it was done all
but
in one
12
lump
is
sum
right there.
or in
When
pieces
it's
based on
16,
pieces of information
that's
returned from the hackers. That
the
information
fourth
is simply
one.
not available right now, but traditionally these things are done in
12 is
cryptocurrency
right
because the
here.
hackers believe that that is more
Kind of
easily obscured and more
could have
easy to
correlated when
abscond with
people are
than a cash
getting out
payment
of
where you
it,
have to risk an actual physical
getting out of
transaction.
Bitcoin
Eamon, was this
and
expected, or was
redeploying
there
that
an expectation
capital
or
over
hope
to
that they could get
GameStop.
around paying this or pay in a way where the perpetrators would actually be caught?
I don't know.
Well, there's been some real confusion around this point, right? I mean, Jen Psaki at the White House was asked several times yesterday whether or not the Colonial had paid, whether the White House was aware of their decision to pay or not pay, and she simply dodged the question, did not want to speak to it at all. There was also some reporting yesterday that suggested that Colonial Pipeline was in a position where it did not feel it had to pay a ransom as of that time. Now, not clear again on the timing of all this, but it's possible
Just
that
want to put in that
this payment was
level
made
one
well before
loan
the
per
reporting that
share
said that
for
Colonial felt it didn't have to make a payment.
payment.
So there are a lot of people saying a lot of things around this,
One on it,
and I think it's important to do the best we can to report with just the facts that we know as of right now. And the facts we've got are a payment was made, but no timing associated with that.
Eamon, thank you. Eamon Javers in Washington. Let's get to the White House now for the COVID briefing.
When you're winning, you press harder. We can do this. But if you haven't gotten vaccinated yet, now is the time. And with that, over to Dr. Walensky for an important update and what our progress means for Americans.
Thank you, Andy. Good afternoon. I'm pleased to be back with you today. Let's begin with an overview of the data. Yesterday, CDC reported more than 34,200 new cases of COVID-19. Our 7-day average is about 36,800 cases per day. This represents yet another decrease of about 23% from our prior 7-day average. And every day, with daily cases continuing to fall, we remain encouraged by these positive trends. The 7-day average of hospital admissions is 4,100. Again, another terrific sign with another back-to-back decrease of 12% from the previous 7-day period.
So the index is
And 7-day average daily deaths have also declined to 587 per day.
Good news.
Today, I have several exciting announcements to share with you.
So we're looking at a
First,
treasury
since
yield
becoming
is
CDC director,
still
I
down
have
a
seen
big spike in
firsthand the
the
current
dip
frail state of the
last hour
public health
here.
infrastructure in this country. I'm committed to upgrading the public health system so the nation is ready for whatever comes next. With this in mind, today we are announcing the upcoming release of $7.4 billion in funding from the American
These are
Rescue
the
Plan
GameStop's
to
popping.
hire, train, and
Cost
support
is
public health workers across the
collectively
country, reflective of the diversity within the communities they serve. Over half of the money being released, $4.4 billion, will support states and localities, creating tens of thousands of new jobs in communities across America, expanding our
still way
overstretched
underwater.
public health departments with new hires to support their COVID-19 efforts. And $3 billion will be focused on preparing these same jurisdictions for future pandemics and to build a public health workforce for the future. Though many threats have increased in complexity and scale in recent years, our nation's public health workforce has gotten smaller. This support will immediately add more staff in health departments across the country. It will add school nurses to K-12 schools to support safe reopening and operations and support vaccinations as vaccines are authorized for younger people. It will expand the number of CDC Epidemic Intelligence Service officers, our elite disease detectives, to respond to local outbreaks and help curb the pandemic. It will expand public health career paths, recruit and train a diverse group of future public health leaders, and launch a public health AmeriCorps to recruit a strong, diverse, and highly skilled workforce that is ready to respond. And it will create new programs intended to increase staffing at our nation's laboratories and build preparedness for the future. We are really excited about what this support will mean for our nation's public health capability now and into the future. Second, last night I endorsed the recommendations of CDC's Advisory Committee on Immunization Practices, making the Pfizer vaccine available to anyone who is 12 years and older. I want to thank the ACIP for reviewing the science and providing their recommendations on the safety and efficacy of the vaccines in adolescents. This is an important step forward in our efforts to vaccinate as many people as possible and to stop the pandemic. And finally, I want to provide you an update regarding CDC's guidance for fully vaccinated people. Over the course of the pandemic, we are continuously gathering data and evidence to inform our guidance and decision-making. We now have numerous reports in the literature that demonstrate the safety and real-world effectiveness of the authorized vaccines. On this slide, there are 3 recently published studies, one from Israel published in the Journal of the American Medical Association, or JAMA, on the top, and 2 from the United States, both published in CDC's Morbidity and Mortality Weekly Report, which all show that COVID-19 vaccines work. In Israel, there was a demonstrated 97% vaccine effectiveness against symptomatic and 86% effectiveness against asymptomatic infection in over 5,000 healthcare workers. In the United States, vaccines were 90% effective against any infection in nearly 4,000 healthcare workers and 94% effective against hospitalizations from COVID-19 in an evaluation across 24 hospitals in 14 states. Additionally, we are accumulating data that our authorized vaccines are effective against the variants that are circulating in this country. On this slide, you can see a study published just last week that demonstrates how effective the Pfizer vaccine is against the common circulating variants in the United States, B117, as well as other variants like B1351. Additional studies confirm that the Moderna and Johnson & Johnson vaccines are also effective against circulating variants. Finally, we know that in the rare event that people get infected after a vaccine, the resulting infection is more likely to have a lower viral load, be shorter in duration, and likely less risky of transmission to others. Considering all of these factors, the data on vaccine effectiveness, the science on their ability to protect against circulating variants, and our growing understanding of the low risk of transmission to others, combined with universal access to vaccines for those 12 and older, today, CDC is updating our guidance for fully vaccinated people. Anyone who is fully vaccinated can participate in indoor and outdoor activities, large or small, without wearing a mask or physical distancing. If you are fully vaccinated, you can start doing the things that you had stopped doing because of the pandemic. We have all longed for this moment when we can get back to some sense of normalcy. Based on the continuing downward trajectory of cases, the scientific data on the performance of our vaccines, and our understanding of how the virus spreads, that moment has come for those who are fully vaccinated. Now, if you are immune compromised, you will most definitely want to talk to your doctor before giving up your mask. Also, locations such as healthcare facilities will continue to follow their specific infection control recommendations. And lastly, this past year has shown us that this virus can be unpredictable. So if things get worse, there is always a chance we may need to make change to these recommendations. But we know that the more people are vaccinated, the less cases we will have and the less chance of a new spike or additional variants emerging. If you develop symptoms, you should put your mask back on and get tested right away. The science is also very clear about unvaccinated people. You remain at risk of mild or severe illness, of death, or of spreading the disease to others. You should still mask, and you should get vaccinated right away. This is an exciting and powerful moment. It could only happen because of the work of so many who made sure we had the rapid administration of 3 safe and effective vaccines. It could also only happen because we have an adequate supply of those vaccines for everyone 12 years and older in this country.
We've been listening to the White House COVID briefing and the CDC Director, Rochelle Walensky. We should mention that the markets are climbing back towards session highs with the Dow just about 100 points off of its intraday session high right now, up 1.4%, S&P 500 up 1.25%, and the NASDAQ composite also turning positive. It is higher by about 0.6%. Let's get to Meg Terrell for more on this and some elaboration, Meg, on some of the guideline changes that you brought to us earlier.
Melissa, this is a big moment. The CDC director saying essentially for people who are fully vaccinated, getting back to that sense of normalcy in a way that we haven't been able to since this pandemic began more than a year ago. No longer saying that inside or outside, fully vaccinated people need to wear masks. The size of the crowd doesn't matter. Where you are doesn't matter. If you're fully vaccinated, you don't need a mask. That is a really, really big step. It was only a couple weeks ago that the CDC came out with its updated guidance for wearing masks outside. And so I will be very interested when we get to the Q&A session of this briefing, which will happen in a few minutes. I am sure that the first question she will be asked is, how do you prove that somebody is vaccinated? How does a business feel comfortable that somebody not wearing a mask is fully vaccinated? I mean, this is going to be a huge question, but essentially the director saying because case counts are dropping in such encouraging ways, there is universal access to these vaccines and that real world evidence shows just how effective they are in preventing not just disease, but also asymptomatic spread of disease, that they are comfortable making this guidance that if you have your 2 shots of the Pfizer or Moderna or 1 shot of J&J and you're 2 weeks out from that, you don't have to mask up. Mel?
You know, Meg, it seems to me that this means potentially concerts are on, colleges can go back to having dorms full if students are fully vaccinated, restaurants open. And what it seems to be is that if the infection rates shift, if, you know, Lord forbid, the death rates change, then maybe they'll revisit. But otherwise, you're not going to know who's vaccinated or not. In those areas where local governments or businesses just want to throw the doors open, they're going to do that, right?
It seems that way, John. And, you know, of course, she did note that things could change. This is an unpredictable virus. And if things do change for the worse, they may need to step back on this guidance. But it's been fascinating to watch how businesses, schools, hospitals have dealt with requiring vaccines. We spoke with a hospital CEO this morning where they are requiring them, but that's not common for all hospitals. This is just for their employees. Colleges have been much more out there with saying they're going to require vaccinations among students coming back in the fall. And so we'll see how this guidance affects businesses. But they are saying, of course, in healthcare settings, they are still saying people need to abide by infection control recommendations in those settings. But otherwise, this is a very big step coming from the CDC.
All right, Meg, thanks so much for that. Meg Terrell and John, you had mentioned concerts. We're watching Live Nation up by about 3% right now, so really spiking on the back of this news. And one area to watch also, the cruise lines. They had been complaining about very, very strict requirements in order for them to restart sailings. And so you would think that with the easing of these guidelines that perhaps the cruise lines would have a better timetable in terms of when they can start operations once again. So we're watching this as well.
Yeah.
All right, coming up on Power Lunch, stocks facing a wall of worry. We'll take a look at the issues beyond just inflation that are affecting stocks. We're taking a look at big tech and retail, but first we'll check in on the home builders, which don't have the workers or the materials to keep up with demand. Stay with us.
Welcome back to Power Lunch. It has been a wild day for crypto after that announcement from Elon Musk that Tesla would stop allowing customers to make purchases with Bitcoin. Bitcoin now trading well below the $50,000 mark, closer to $48,500. And it's also taken another leg lower this afternoon as Bloomberg says that regulators are probing crypto exchange Binance over concerns related to illegal activity in the crypto market. Bitcoin again down more than 10% at this hour, about 10.5% at this hour. Guys, I'll send it back to you.
All right, Rahel, thank you. In the past few months, it seemed like this was an unstoppable rally. Stocks kept hitting new highs, and investors mostly overlooked any concerns in the distance. But that seems to be changing this month, with stocks now in shakier ground. In this hour, we're taking a look at 3 different sectors of the market and the potential headwinds they face, plus give you some names that could outperform. We're kicking off with the home builders. The sector has skyrocketed in the past year, but is starting to face big issues. Rising rates, lots of supply shortages. Joining us now is Buck Horn, Raymond James analyst. Buck, great to have you with us. You've got three major concerns that you're hearing from investors, like the impact of a spike in mortgage rates, the shortage of materials, as well as whether or not the suburban boom will continue. What is the biggest, most impactful concern that you have in the space?
The concern I have is really just how, we think it's actually going to be a very prolonged and multi-year cycle that we're seeing. So a lot of these challenges are really just near-term speed bumps, whether that's the lumber issues and lumber pricing, shortages in the supply chain. And really, I guess the biggest concern is maintaining an adequate supply of finished developed lots in front of the home builders. So we've continued to see a lot of builders meter out the sales. They're holding back the sales pace at these levels because they're running out of finished lots, and they have to get the approvals and the entitlements and the infrastructure in place. So the land is really probably the biggest limiting factor in the equation right now. I think more land is getting developed. It's going full speed ahead, but it's going to be hard to really materially increase the rate of single-family starts or new home sales much further without a lot more land being developed. So the whole supply chain is reordering itself and trying to ramp up to a higher level of production capacity, but it's going to take a little time to get there.
How much incremental demand did the suburban flight create? I'm trying to figure out if that reverses because of this reopening, which looks like it could be gaining speed, the reopening, because of all the lifting of the mask mandates, et cetera, that we just heard about. What does the landscape look like in terms of the supply-demand dynamic?
It has been a remarkable phenomenon, this population realignment throughout the country, the relocation buyer into Sunbelt markets, into the southwestern United States, and into other more inland areas, more affordable markets, has continued at just almost a record pace. And it's happened even with the idea of a reopening and vaccines on the horizon. It has not abated one bit. So even with this, back to normal, if you will, I think that does reopen some optimism for the cities, but people are voting with their feet. They're making lifestyle decisions on a more permanent basis. I think it's got lasting implications. I think it's part of a secular shift towards more affordable markets, towards better weather markets. People are taking stock of their lifestyle, how they want to live, where they want to live, and they're choosing to move away from higher cost, high tax, maybe tougher weather environments and looking for a more affordable and more beneficial lifestyle. So I think it continues.
Any chance that this CDC news actually makes things even tighter? Was there any sense that people were holding back from really going out? I know the market was hot and physically looking at homes before, and maybe that'll be more common now?
There was some of that, but I think for the most part, buyers had adjusted to shopping online. There's a lot more familiarity with the technology and going out and shopping online. So I'm not sure that it's going to change much, quite frankly. I think there's still a huge incentive for buyers to migrate into single-family homes. We're seeing that overwhelming demand. So maybe it makes it a little bit easier to walk into a community, into a model home, and pick out the carpet and the flooring you like. But probably very, very nominally on the margin does it change how strong the demand has been.
All right. Buck, thank you. Buck Horn from Raymond James. And now shares of ThredUp, an online resale platform for clothing, getting crushed today after its first report as a public company. Stock's down nearly 15%, way off its high from debut day when it topped $31 a share, even though the analysts are mostly positive about these results and guidance. Joining us now, Courtney Reagan and James Reinhart, CEO of ThredUp. Courtney?
Thank you very much, John, and thank you, James, for joining us here today. So let's start right there where John left off. You put up a pretty good first quarter as a public company. Some analysts like Wells Fargo say the guidance is a little conservative and the shares are selling off. Is the guidance too conservative? Are you setting yourselves up for a really big beat for your second quarter as a public company?
Yeah, hey Courtney, thanks for having me. I mean, look, we're 4 months into the year, so I didn't want to get ahead of ourselves. You know, we see the reopening happening. I think the news from the CDC today is great news, but I don't think we're at the point yet where we're willing to say where the pandemic is totally behind us. So I just think we're being thoughtful about how we think about Q2 and the rest of the year.
Processing time is a really important part of your business. When you get clothing that's been sent in the ThredUp bags, you were at 20 weeks, down to 8 weeks right now. You're hoping for 2 to 3 weeks. How do you do that? Speed up that process of inspecting the clothing and putting it on the platform without sacrificing the quality of the clothing that you're accepting?
Yeah, we did peak at 20 weeks. It's down more than 50%. So, you know, we love the trend on processing, and 2 to 3 weeks is the target. It's all about, you know, staffing up capacity. We brought on our largest facility in Atlanta, DCO6, which has huge capacity for inbound processing. And so we're scaling up that facility. And so we feel good about where we're headed for the rest of the year. And, you know, we have great supply in our business, and supply fuels that growth. And so I think as the economy reopens, we'll be well positioned to take that supply, put it online, and delight our buyers.
And speaking of supply, I know you have a number of partnerships with retailers, I think more than 20 at this point. It seems pretty obvious what ThredUp gets out of that, but what do the retailers get out of partnering with ThredUp?
I think retailers are thinking about resale as a new channel. I think the way they think about stores or e-commerce or outlet, off-price. And so I think where brands and retailers are headed is thinking about, you know, where's the consumer going? And the consumer is shopping secondhand at very high rates. And so I think what retailers and brands, you know, get out of the relationship is meeting the customer, you know, where they are and where they're headed. And we really want to help them get there because we feel like the resale opportunity is very big. You know, every year that we run the data on the market size, it gets bigger. And so I think retailers are starting to appreciate that.
And The RealReal, one of competitors in your space, albeit sort of in a different stratosphere when it comes to price point for what they accept and then resell, have experimented with physical stores. Is that something that ThredUp would consider in the future, a physical space to sell that secondhand merchandise?
You know, we've dabbled with some pop-ups over the years. At one point, we had a few pop-ups here in California. But I think the RealReal strategy for stores is to get supply. You know, and I think as we've said, you know, we've had no trouble acquiring suppliers. We've never spent any money acquiring suppliers. So I think we're really focused on building, you know, an online business that really meets, you know, where the consumer wants to shop resale over time, which we think is online or on their mobile phones. And so I wouldn't expect to see a huge store footprint in our future, but I think we'll continue to experiment. There's still lots of apparel bought, you know, in stores. And so I think it's something we'll continue to look at.
Speaking of apparel being bought, what trends are you seeing now as the economy is beginning to reopen? Folks are starting to go out now. Still selling a lot of sweatpants or moving into different categories at this point?
We're selling a lot of dresses these days. You know, I think we're seeing searches for dresses and sell-through on dresses really come back in full force. And, you know, I think definitely the leisure wear, lounge wear, active wear trends have subsided. We see them down about 10%, whereas dresses, you know, formal dresses, midi dresses, maxi dresses, you know, they're up 20%, you know, since the first quarter. So I think you're definitely seeing this rotation back to going out clothing. And I think it speaks well for the future of our business.
James Reinhart, CEO of ThredUp, thank you for joining us here right after reporting your first quarter as a public company. John, Melissa, back over to you.
If formal and mini dresses are bouncing that much, the economy is definitely fully reopened at this point. All right. After the break, the wall of worry for retail. Thank you, Courtney. As inflation brings higher costs and drains stimulus brings fewer customers, is the space at risk? Plus, Airbnb 30% off its recent highs. Will the vacation rental service trip up its earnings? Power Lunch is back right after this.
Welcome back. I'm Rahel Solomon, and here is your CNBC COVID update at this hour. One Indian state is asking COVAX to help get its people vaccinated. India's national leadership has struggled to accelerate inoculations, even as daily cases remain in the hundreds of thousands. COVAX is the United Nations-led program that helps distribute vaccine doses to smaller, poorer countries. And the COVID-19 pandemic could have been prevented. That's according to a new report commissioned by the World Health Organization. Overall, the findings suggest a lack of global preparedness. The report also says the WHO waited too long to declare the crisis a pandemic. And Pennsylvania will become the first state to test gubernatorial pandemic powers via ballot. On Tuesday, the state's Republican-led legislature will add two constitutional amendments on its primary ballots. The changes would give lawmakers, not the governor, more power over disaster declarations for future pandemics or natural disasters. You're now up to date. John, I'll send it back to you.
Rahel, thank you. Markets right now rallying quite a bit off the lows ever since around 145, I believe. They have been bouncing back. The Dow is now up more than 1.5%. The S&P up about 1.5%. The NASDAQ almost up 1%. Remember, when we started the show, the NASDAQ had just peaked into positive territory, and you can see the Russell there up 1.5% as well. Let's take a look at some of the reopening trades that have gone positive following the CDC announcement that vaccinated people do not have to wear masks outdoors or socially distance going forward. The airlines all in the green, near session highs, and the cruise lines, as Melissa mentioned, turning positive on the session as well. Hotel names like Marriott and Hilton moving higher, and the casino names, Las Vegas and MGM, now in the green as well. and the oil market closing for the day. Let's go to Dom Chu at the CNBC Commodities Desk. Dom?
John, it's not helping oil prices. They are trying to bounce right now off their lowest levels of the day. U.S. benchmark West Texas Intermediate or WTI crude futures currently $63.68, 3.5% declines there. World benchmark Brent crude futures right now $66.88, 3.5% declines there as well. Now, the downside snaps a 3-day winning streak for oil prices. These are also the biggest daily drops in over a month at this point. Now, for context, oil prices still hover near the highest levels in over a year, given optimism of more fuel consumption as the world emerges from the COVID pandemic, as we heard from the CDC right now. But continuing fears over infection hotspots like in India and Southeast Asia, keeping a lid somewhat on oil prices. We're also seeing an unwind of the upside prices given the cyber attack on the Colonial Pipeline here in the U.S., with the pipeline coming back online. Traders and consumers, John, Melissa, trying to see if those prices for gasoline especially will drift back to where they were before Friday of last week, Melissa.
Seems to always take longer for the prices to come down versus the price to go up, Tom. Thank you. Well, another area of the market sensitive to rising costs and spending habits, consumer staples and retail stores, manufacturers like Coca-Cola, P&G, Unilever, all expecting rising commodity inflation. Some retailers warning of decreased spending habits from the end of stimulus, and many in the sector are dealing with inventory issues. So how much worry should there be around the strength of the consumer? Joining us now is Nick Modi, Managing Director at RBC Capital Markets, and Michael Baker, Senior Retail Analyst at D.A. Davidson. Great to have you guys both. Nick, I'll start it off with you because from the consumer standpoint, what we are facing are price increases. Procter & Gamble, for one, announcing it's going to increase price on a number of products starting in September, and yet you say that companies are leaner and more efficient and they could deal with price increases. So why are we seeing prices being increased on us?
Yeah, thanks, Melissa, for having me. Yeah, there's multiple ways to get pricing, right? There's no question that these companies have to get pricing, but the way in which they do it, I think, is a lot more diversified than what we've been accustomed to the last few years. For instance, you can take pricing, but you can also reduce promotions or ineffective promotions, which there was a lot of across the world of consumer goods, but also premium innovation, right? When you think about a Coke with coffee as an example, or an Old Paso tortilla pocket, these are innovations that are charged at a higher price per ounce or price per product, and that also serves as pricing. And then on top of that, you have productivity, just general cost savings that can help these companies offset rising costs. So net, these companies don't have to rely on pure price increases to offset inflation. There are other mechanisms.
What are the chances, Nick, that even if these inflationary pressures abate, as the Fed says, they think it's transitory, that the pricing increases will be rolled back?
What we've seen historically is that has not been the case, right?
Yeah.
Now, there is situations where you see it dealt back through, promotions, but those are more temporary than structural. In some instances, when you have a private label product, you might see more permanent rollback. So all in all, we are not expecting to see broad-based rollbacks when things start to normalize. We do think, and that's why, profitability longer term has been building for these industries, has been based on pricing.
Michael, you cover the big box stores, so which are best equipped to handle this environment? I would imagine that some are able to demand that the supplier of the goods to them eat the cost as opposed to them paying more. But who is in that position?
Right. Well, certainly scale helps in retail, and the bigger you are, you do have a greater ability to push back the pricing onto the suppliers. But we do think that some of the retailers will absorb some of the price increase and then pass along to the consumer. So it's sort of a shared response, if you will, with the consumer absorbing some of the pain, the retailer some, and supplier some. Some areas in particular, though, that we think some names that are really well suited to pass on inflation. The home centers, Home Depot and Lowe's, we know that lumber costs have been up quite a bit. We think that will be passed on and has been passed on generally to consumers. But again, I think scale matters, and the bigger you are, the more able you are to push back on the suppliers.
Michael, I know we're talking about worry, but what about hope? Do you have any sense of whether this CDC news was expected across retail? And, if not, does this give potentially a boost to certain types of retailers that might see, better demand and maybe even pricing power than they had been expecting?
Sure. I think it's a little bit sooner and a little bit more positive than a lot of retailers were expecting. I think everyone generally expects the economies to open up, but to have a no mask mandate or the mask mandate lifted this quickly, I think probably is a little bit of a surprise When I think of no masks, I think of Ulta. Ulta Beauty, one of the names we're recommending. Lipstick sales should certainly benefit. Back to a previous guest on your show, when you think about selling more dresses, to me, dresses and makeup sort of go hand in hand. So in our mind, Ulta is probably one of the bigger beneficiaries of this kind of announcement.
Sounds like you don't expect men to be looking any better, at least for the most part. Michael Baker, Nick Modi, thank you.
Thanks for having us.
Still ahead, the wall of worry for tech. Will still high valuations and the potential for higher taxes put the squeeze on the sector? Plus Airbnb earnings after the bell. That stock's down 22% in just a month. But can it bounce back? Our traders will discuss.
Just bought one share of Coinbase, just a dollar cost average that using some of the capital I just got back from AMC. Bought it at just a market of 259. So yeah, to me it's just so cheap. I mean, down 9% today. So now that brought my dollar cost average down to 335, which is much lower than the 381 originally was, and then I think it came down to 360 or something when I bought one share, another share a couple weeks ago. Now I have 5 shares at an average of 335, so still quite a ways out of the money on that one, down an average of 22%. See, I need some more money in that account so I can redeploy it on these dips. Man. Jeez.
Welcome back to Power Lunch. I'm Seema Modi. Airbnb set to report earnings this afternoon after its blockbuster IPO in December. Shares have been on the decline, down 37% in the last 3 months as competition ramps up with travel giants Expedia, Booking Holding, and Marriott. The hotel giant now has 30,000 homes listed on its home platform. Analysts are forecasting Airbnb's growth in vacation rentals to improve quarter over quarter. For how to play the stock, let's bring in Todd Gordon of TradingAnalysis.com. Boris Sosnick of BK Asset Management. Boris, Expedia did recently disclose that booking trends for summer homes are pacing above 2019 levels. It's also been putting a lot of effort in poaching hosts. So would you rather own Expedia here, which has surged this year up 25%, or Airbnb, the incumbent?
I think the price action tells you all you need to know. Absolutely, Expedia is doing much better. I think VRBO is really giving Airbnb a run for its money, mainly because Airbnb has a much larger inventory in the urban core, and VRBO is much better positioned in the vacation rental property, which is where most of the people want to go. In addition to which, as you were saying, competition is really becoming a problem for Airbnb. I see a lot of comments where, for example, a room at Airbnb that lists at 109 is actually $200 after fees. That's a far less compelling competitive proposition to the end consumer than it used to be. So in many ways, I think what's happening with Airbnb, the swan dive in the price, is that it's lost the imagination of Wall Street. Wall Street has kind of lost faith in its model at this point. I think it's going to be very tough going for the company going forward.
Todd, looking at price action in Airbnb, it was down as much as 6% today, now down about 3.5%. Perhaps it has to do with the CDC easing mask guidance indoors. But what are some of the levels you're watching on the stock now at 134 a share?
Yeah, and Seema, it's only been trading for 6 months, so it certainly needs to hold this 130 area. Unless if we make new lows, it's never good. But look, keep in mind, VRBO and Airbnb are two different markets. When you do VRBO, you have to get an entire house. Airbnb is like the largest property company in the world. They have 20% of the entire U.S. lodging market. They're bigger than the top 5 hotel brands combined. So again, we really need to hold 138 and see.
Sure, they have their reasons.
Fulfill the demand as more guests are traveling as we reopen. And once this housing market loosens back up, pent-up demand is eased as supply chain issues come. More rooms will become available as investors are able to kind of let out that pent-up demand. Gross bookings decreased by about a third in 2020 due to COVID, but they were less impacted by hotels. I think those problems are transitory, and I think people will reemerge in this market. I'm bullish. I'd like to see technical support, a little evidence of reversal before getting in, but I won't give up on this yet.
Yeah, but with that demand comes higher prices. I think the average home right now is 30% more expensive than this time last year. Report we will watch after the bell, Airbnb. Todd and Boris, thank you for joining me. And the FANG trade recovering slightly today, but which of the tech titans could face more downside? Find out more on tradingnation.cnbc.com. Mel?
All right, Seema, thank you. Up next, the final brick in our wall of worry. Washington continues to take aim at big tech. Potential tax hikes, regulation, antitrust suits, and rising rates. Which names are most at risk? Paralunch is back in 2.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
For entries into breakouts, some traders use buy-stop limit orders placed above resistance levels. Unlike regular buy-stop limits turn into limit orders when the stop is triggered. Thus, if a stock closes below the stop price one day and opens far above the limit price the next, a trader will not buy the stock. I'm Lee Bohl, and Schwab is the better place for traders.
Remember Eeyore from Winnie the Pooh? Well, this hour we're looking at the various worries facing different sectors of the market. And now we turn our focus to big tech. High valuations, even after a few days of selling, and proposed corporate tax hikes both pose serious threats to the biggest names in the sector. Joining us now is Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. Paul, it seems like in a way it's not the big tech names that you're worried about so much as perhaps tech overall in this environment based on how far it's run?
Yeah, you think about the last couple of years, the tech sector is measured by the XLK Tech ETF has gone up 40% back-to-back years and was having a pretty nice rally before things caved in recently. And I think that even though the NASDAQ's down 7% in the last couple of sessions, the last time we had this nastiness, which was triggered by a threat of inflation and rising rates, was back in the fourth quarter of 2018. And in that particular quarter, tech stocks went down 24% on average before they rallied. So I'd like to be bullish about my sector, but I think it's too soon to do that.
But of the names that you're relatively feeling good about, I see Facebook and Alphabet on the list. So does that mean that we shouldn't worry so much about the regulatory stuff, maybe even in light of what we saw out of the EU this week, Vestiaire kind of getting told to back up a bit by the courts on some of those fines?
It's an excellent question. I do think we need to be concerned not only about regulatory action abroad, but here in the States. But as we saw with the last quarter and the outlook for both of those two companies, man, we have a real nice tailwind with digital advertising. And I think that'll trump all. And of the FANGs, those two are my favorites. The other ones, I'd probably stay away from.
You mentioned that some of the other tech stalwarts you say you could probably hide out in include PayPal and Square, Paul. And I'm curious about those two names because they are considered high valuation names. If you take a look at PayPal, for instance, it's 51 times forward earnings, and it's already off 22% from its 52-week highs. And so what about it says to you this is the stock where you can be in this environment?
Yeah, I don't think those are necessarily hiding stocks, but I think what we saw in their most recent quarterly reports that they are nice indirect ways to play crypto. And I know since Elon Musk was on Saturday Night Live last weekend and what his comments were following that, crypto has been in a swan dive the last couple of sessions, but it'll return and these will be nice ways to play. And I think Square is particularly attractive. Square's down 4 or 5% today. And unfortunately, it's broken 200-day moving average support, so it could go down more. But Square and PayPal, those nouveau pay processing companies, I think will be good investments almost regardless of valuation.
And quickly, Paul, if reopening is happening a bit quicker than some expected with the CDC, are there tech names that might benefit?
I think so. Most of them are not necessarily your pure tech names that you and I know and love, but some of them are more communication services and telecom bent. Think companies like Crown Castle with the telco REITs, Akamai, TE Connectivity, Corning. These are some kind of modest tech companies, not aggressive tech companies, definitely not cloud computing companies, but should do well and be reasonable place to hide as techish names versus pure tech names.
Paul, great to speak with you as always. Paul Meeks.
Thank you.
And going to be an interesting close here, John. We're just about 8 points off of session highs for the S&P 500 at this point.
Yeah.
So good to be with you, John.
Good to be with you.
All right. Thanks for watching Power out there. Closing bell starts right now.
Thank you, Melissa and John, and welcome to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost at the New York Stock Exchange. It's a Thursday thriller on Wall Street with the Dow and the S&P 500 gaining back a chunk of this week's losses. The Nasdaq's in the green as well, but off its highs. Let's look at what's driving the action. The Dow is up a little more than 500 points right now following its worst session since January. The Nasdaq had given up a 200-point gain, briefly going negative, though it's now marching higher again. On the data front, the producer price index jumping 6.2% from last year, another sign of rising inflation following yesterday's consumer price surge. And Bitcoin is getting clobbered today after Elon Musk tweeted that Tesla has suspended vehicle purchases using the cryptocurrency, citing the environmental cost of mining. 59 minutes left to go in the session. We'll definitely be talking about that one.
We certainly will. Up a healthy 1.4% on the S&P 500. Coming up on the show, value investor Scott Black will weigh in on the wild day and week for the market. market and tell us which names he is looking to buy right now. Plus, shares of Poshmark are plunging despite strong results, currently down 22%. We'll speak with the company's CEO about their numbers and what he's seeing from the consumer. And we've got a blockbuster afternoon of earnings ahead with reports from Disney, Coinbase, Airbnb, and DoorDash. We'll bring you all of the results as they cross an instant analysis. Let's focus, though, first of all, on the big stories we're watching today. Mike Santoni's tracking another volatile session for stocks, and joining us to talk tech, Mark Mahaney from Evercore ISI. But Mike, let's start with you. This broad market action, NASDAQ briefly went negative, but up almost 4% now.
Yeah, well, if I'd call it a respectable but somewhat mechanical bounce, you know, this is the fourth pullback in the S&P 500 year to date of about 3 to 6%. This one right in the middle, we were about 4.4% high to low. So pretty much we've been here before. Usually it doesn't just kind of turn around immediately in a V and go back to the old highs. We've regained about a third of those losses. Also, I would point out this area that was the high for the day in the 4120s. Remember a couple days ago, that was the area that everyone was hoping was going to hold on the downside, and we were above there. So that was considered to be the former floor. We'll see if it serves as a bit of a ceiling. Also, as of right now, all of today's action from high to low in the S&P has taken place within yesterday's range. So today's high was below yesterday's high. Today's low is above yesterday's low. So a little inconclusive, but certainly better than not bouncing when we're a little bit oversold. The NASDAQ, you know, should have had the makings for a better bounce. We're getting a little bit of one here. You see this has a different shape to it, right? It looks a little more like we've kind of surrendered a leadership position here starting in February in the mega cap growth names, and a little more to prove, I would say. Although still, it's not as if this is some kind of a desperate situation. You still have this, you know, uptrend line, even though it's kind of shallow, and even though you probably would want to hold above those lows from February, March. So it seems like that's why it's the tired area of the market. And of course, smaller cap growth tech like cloud and the ARC names are still struggling today. This is the S&P 500 from 2008 to 2015, a 5-year span. This was your major market low. I pointed out because there's a lot of parallels with what we've seen now. This huge, about 80% ramp off the bottom into 2010. This is the equivalent of the phase we're in now in terms of after that 80-90% run off of last year's low. It wouldn't be surprising to kind of be in this sort of range where we have to chop around. It doesn't mean it's the script that we have to follow, but it should just sort of not be very surprising after one of these huge gains over multiple months like that, that you do have a little more of a give and take type market with some downside chop, guys.
Mike, I guess some discussion throughout the session of what hasn't bounced, the likes of cloud stocks, ARC, Complex, and Tesla.
Right. They seem just a little bit more broken. It almost seems like there's kind of a little more determined selling there, too. In other words, they trade as a group. The cloud software trades right alongside all the other sort of high multiple to revenue, early stage growth names. So, yeah, they're still kind of guilty until proven innocent in this market. There will be probably some very, very violent bounces in them from time to time, but it seems like the market's getting bifurcated between mega cap tech, which is really just kind of, do you want to harness those cash flows and those very long-term platform growth stories, and the more kind of speculative aggressive names.
Mike, thanks so much. We did just hit a session high, by the way. The Dow was up just more than 560 points moments ago. The NASDAQ, as we've been discussing, having a volatile day. It was up 1.6%, then fell all the way into negative territory briefly, now climbing once again up 0.9%. The index remains on pace for its worst week since February 26th. It is down 4.4% week to date as we stand. Mark Mahaney joins us now from Evercore ISI. Mark, good to see you. Thanks so much for joining us. What do you make of the pullback that we've seen this week? Was it a bit overdone, or did it make sense given the inflation print and the pressure on yields?
I think it made sense. I think Michael set it up pretty well. There's kind of two camps here. There's spec tech, so speculative valuation tech. Those are the stocks that trade at those high price to sales multiples because they don't have near-term substantial profitability in that sector. Even in an up day like today on the NASDAQ tape, those still modestly move up. They sort of underperform. And then you have your kind of gold standard tech. I got to come up with a better phrase than that, but I'm talking about Microsoft, Apple, Facebook, Amazon, Google, and those hold up pretty well in this market. And those, I think, when the tape turns, when the market comes back to growth, those will be the first to, I think, outperform.
Of the gold standard tech, Mark, which is your top pick on this pullback?
If you're going to give me Amazon at a discount to its average forward multiple with a very strong print they just put out, but more importantly, guidance that suggests that their growth is elevated post-COVID than pre-COVID, I'll suggest Amazon as the top pick. Single broadest winner, if you will, off of the COVID crisis, very broad, diverse revenue streams, tons of cash flow coming in, very attractive valuation.
Do you change your estimates at some point, Mark, on this rethink of how we value growth in a world of higher inflation and higher rates?
Yes, I do. I have to seriously think about that. We're going through what I think is the great D-rating. I'm exaggerating, but the point is there. You know, we're seeing two of the names that are reporting tonight, DoorDash and Airbnb, in the last 2 months have had their forward multiples cut in half. Any stocks that re-rated materially during the COVID crisis, their multiples, you're seeing a lot of those. One example is Trade Desk. Another one is Wix that reported yesterday. Their multiples are coming back to those pre-COVID levels. You have to justify, if you're gonna have re-rated during COVID, you're gonna have to justify that by proving that your growth outlook is stronger post-COVID than it was pre-COVID. I think a few companies can do that. I think Google can. I think Facebook can. I think Amazon can. But a lot of companies can't. And if they can't, they're going to keep re-rating or de-rating.
So Mark, to that point for the spec tech, as you put it, I mean, are you worried that there is a lot of momentum to unwind to the downside, given that there was so much to the upside last year? Could this go on for quite a lot longer?
I don't know if it goes on for a lot longer. I think there's a lot of macro factors involved. As somebody just recently pointed out on your show, I mean, NASDAQ's off 8%, 9%. That's not a huge correction. You know, we could see 20% in an environment where we really get dramatic fears about rising inflation rates. So, you know, there could still be we could still see a further correction in NASDAQ. We shouldn't be surprised if that happens. Whether that happens or not, I don't know. That's in the macro God's hands.
Airbnb and DoorDash reporting after the bell, as you mentioned, two stocks that you covered. The general thread here is that Airbnb is a reopening play and DoorDash is a stay-at-home play. Is it that simple? What will you be looking for?
Yeah, I think it's sort of that simple. And they're very different setups here, but they have two things in common. They're both very high multiple stocks that have had that 50% fall off because of their multiples coming down. And secondly, they both have lockup expirations coming up, and that's usually a selling event. They both have lockup expirations in the next 48 to 72 hours post their earnings. So you'll see continued pressure. It's kind of hard to see them clearly aggressively trading up when you have those lockup expirations. Then the real trade is going to be, or the investment decision is going to be post those lockup expirations next week. Do you want to use this as the entry point? It'll depend on the print really quickly. Can Airbnb recover to 2019 bookings levels in the back half of the year? That's what the market expects. If they can do it, I think it's a great setup on any weakness to buy the stock. DoorDash now is going to go into its toughest comp. So I think we're on the sidelines on that stock. We're going to wait and see what kind of growth rate we can have as you go against those peak COVID multiples, peak COVID comps, I mean.
It's going to be a fun after-hour session in Coinbase. Mark Mahaney, thank you for joining us to help preview it. Appreciate it. Near session highs, the Dow's still up more than 500 points, 520. Only Dow stock lower right now is Chevron. Up next, the market is clearly seeing a rebound, but shares of secondhand retailer Poshmark are plummeting today after showing a widening net loss in the first quarter. Stock is now down more than 65% from its peak. We'll talk to the company's CEO about earnings and what he is seeing in terms of consumer demand. You're watching Closing Bell on CNBC. Poshmark are plunging today after reporting widening net losses for the first quarter, despite very strong sales. The stock is down more than 20%. And joining us now for an exclusive interview is Poshmark CEO Manish Chandra. Thank you so much for joining us, Manish.
Thank you for having me.
So it does appear that those wider losses is a part of the problem here, wider than expected, and also coming off a brief period of profitability that you saw during the COVID pandemic. The world has changed, and there is more scrutiny and a microscope under some of these hot growth new companies like yours. What is the path to profitability?
So for us, we're focused on operating profitability, and we posted a $4.2 million adjusted EBITDA with 5% adjusted profitability. So we continue to focus on operating profitability and our long-term strategies, which are focused on really expanding internationally, expanding categories, and continue focus on technology and product innovation, including launch of video on the platform last quarter.
The sales growth was impressive, and guidance, you still expect growth, but it did come in a little bit lighter. Just talk to us a little bit about the momentum you're seeing from the consumer as we enter this reopening period where everything doesn't have to be online.
No, it's really exciting to see people actually going out and engaging with the real world, which gives them more occasions to wear fashion, more occasions to rotate out fashion. So as a social marketplace where we have over 4.5 million sellers selling over 150 million plus items, it gives more turn for both buying and selling. So we're pretty excited about the reopening. One of the things we talk about is how the consumers are getting ready for reopening. And in March, we saw the sales of crop tops jump over 100%. Bikinis jump over 86%, and jean shorts jump over 85%.
Manish, do you think there's correlation between where we are in the economic cycle and how much people go to buying things brand new versus resale?
Yes. So resale is actually really interesting because it gives you both a hedge against fluctuating prices on the one side, on the demand side, but then on the sales side, it actually gives you a hedge against the inflation as well, because everything in your closet is appreciating as the goods are appreciating. And on the flip side, you're not subject to the supply chain vagaries because you're working with pieces that have already been manufactured and are sitting in people's closets.
There was a lot of hype when you went public about secondhand, also ThredUp going public around the same time and reporting around the same time. Is that still a hot, trendy place, especially for the younger Gen Z generation?
Yeah, we continue to see the interest in resale sort of continue to explode, not just in Gen Z, but across all generations. You're seeing brands jump into the game, etc. So we think resale is not just a trend that's here to stay. It's great for the wallet, great for the economy, and also a bet against inflation.
Were you surprised when we saw the inflation print, or have you been seeing similar trends already on your website?
We actually have not seen major inflation on our website overall. I'm not surprised by inflation, given the amount of money we've been pumping in. But we actually think that inflation can be actually hedged with using your clothing and using resale clothing. And that's been very powerful as people continue to realize that their closets have value and it's sitting in front of them.
Do you think the market understands your story, Manish? The stock has more than halved since going public. As I said, there was a lot of excitement around IPO, but since then, it's really fallen off.
Well, when we think of our story, I think there's parts of story that people understand. People understand that we are about resale, but I think when people start to sort of club us with high asset models, with warehousing, a lot of processing cost, versus sort of asset light models like Etsy and Amazon, partly Amazon's model, but partly also Facebook, etc. That's where a social marketplace is quite distinct. So I agree with you that market understands half our story, but is sort of misunderstanding the other half of the story, which is reflected in our 80+% gross margin, continuous adjusted EBITDA profitability, and over $19 million of positive free cash flow in the last quarter.
And international expansion, which you said is a big priority. How are the test cases going, I think, in Australia?
Yeah, Australia has really launched, and just to give you a sense of the asset-light model, we launched Australia entirely in the COVID timeframe. The team has never met us, we've never met the team, and we've launched that country with a small team, and that gives you a sense of how fast and easy it is for our model to launch into new countries.
Manish, thanks so much for joining us. Much appreciated.
Thank you for having me.
We have what, 42 minutes left of the session, and we are up 533 points on the Dow, not far from the session highs. We got to about 570 moments ago. Coming up, the tweet that tanked Bitcoin. We'll talk about Elon Musk's change of heart regarding the digital token and the wide-ranging impact that's having on the crypto world. As we had to break, check out some of today's top search tickers on CNBC.com. 10-year yield on top, followed by Tesla, Apple, DOGECOIN, and Bitcoin. We're back in a couple.
Minutes left to go. Here's a check on the markets. We are seeing a rebound after yesterday's big sell-off, the worst for the Dow since January, worst since February for the S&P 500, which is up 1.44%. A check on some individual market movers for you right now. Chip stocks are also seeing a rebound after this week's declines. The SMH index up more than 1%, led by gains for Lam Research, Applied Materials, and KLA Corp. And on the flip side, shares of Alibaba are lower today on the back of earnings, posting its first operating loss as a public company. Results, though, were hurt by a huge $2.8 billion anti-monopoly fine that it received from China over the quarter, especially positive for the bulls on the chip stocks, because that was what I was watching into today. It's been a leadership group for the market, for the economy, but also for the tech sector in particular, and was flirting with some lower levels. We were watching to see if it would take out March lows. For now, though, things look set for a rebound. Apple, Microsoft, Google, AMAT, a lot of these chip names and mega cap growth tech are up. Tesla, though, an interesting decliner.
Alibaba missing out on the intraday bounce, though, of course, Asian stocks did already close and lock in some of those losses. Might have something to do with it, but down
correction
6%
mode
or so. Up next, Elon's coin flip. The world's second richest man says Tesla's suspending vehicle purchases using Bitcoin, citing environmental concerns. And that's creating a whirlwind of activity around cryptocurrencies. We'll discuss that next. And later, Disney's gearing up to report earnings after the bell, with shares in the red so far on the year. We'll preview the key metric that investors should be watching. As we had to break, here's a check on bonds. Yields pulling back a little bit today. The 10-year, as we stand, is 166.
35 minutes left of trading. Dow's up a little more than 500 points. Time now for a CNBC News update with Leslie Picker. Leslie.
Hey, Sarah. Hi, everybody. I'm Leslie Picker, and here's your CNBC News update at this hour. First Lady Jill Biden and Democratic Senator Joe Manchin quickly adopted that new CDC guidance, announcing just 90 minutes ago that fully vaccinated people generally don't need to wear a mask indoors. They were maskless as they visited a West Virginia school where teens are getting the COVID vaccine. And as both Israel and Gaza deal with the damage caused by the continuing exchange of aerial assaults, there's another expansion of the violence. Israel's military says at least 3 rockets were fired from Lebanon toward Israel. No injuries reported there, and there are also reports Israel is hitting Gaza with artillery and tank shells as 9,000 reservists are called up in what could be preparations for a ground invasion. CNBC now reporting Colonial Pipeline did pay a ransom after being hit by a cyber attack that has caused fuel shortages in the Southeast. At her weekly briefing with reporters today, House Speaker Nancy Pelosi said she thinks it's a mistake for ransomware victims to pay up.
The point is that we don't want people to think that there's money in it for them to threaten the security of a critical infrastructure in our country.
Very complicated situation. Back over to you, Wilf.
Leslie, thanks so much. Bitcoin taking a major hit today. Elon Musk tweeted last night that Tesla is suspending vehicle purchases using Bitcoin due to environmental concerns. Bank of America's Savita Submaranian has highlighted that mining $1 billion worth of Bitcoin is the equivalent of 1.2 million cars being driven over the course of a year. On the flip side, just last month, ARK Invest put out a white paper making the case for Bitcoin as an ESG play and could lead to more renewable usage. Here's analyst Yassine El-Mandra on our show a few weeks back.
Let's dive right into how Bitcoin can actually accelerate renewables and how the energy consumption, again, does not necessarily equate to pollution or CO2 emissions. So when you look at kind of solar today and some of the limitations, we see that the sun shines during the day, but not at night. So the energy supply is either abundant or non-existent. And so in the case of solar, there's often a mismatch between the demand for that energy.
I just think you're completely ignoring the questions that we put to you, and you're going back to your original point. I get that energy consumption doesn't necessarily lead to pollution, but what is happening at the moment is not that the only energy used for Bitcoin mining is renewable. And if that was the case, fine, but that's not what's happening. So you're pushing back to say that energy consumption isn't necessarily polluting in the environment, but it is if at the moment the mix of energy consumption includes all sorts of fossil fuels, which is the case, is it not?
So it's not actually the case. If you look at the overall energy mix of Bitcoin mining, while I agree that it's not by no means exclusively renewables based, there actually is a significant portion of the mix that's attributable to renewables.
What percentage?
So in hydroelectric, so 40% of Bitcoin's energy outlay actually derives from renewables, and 76% of miners are using renewables in some capacity.
Great. Capacity, great. I mean, it's just a massive leap. Meanwhile, billionaire investor Mark Cuban replied to Musk's tweet saying the Dallas Mavericks will continue to accept cryptocurrencies and that, quote, shrinking big bank and coin usage will benefit society and the environment, end quote. And guys, I mean, the interesting thing is I don't actually think the green aspect is necessarily key to the argument of Bitcoin as a currency in the future or as a store of value. The issue with the likes of Tesla and ARK is that in other parts of their business, they profess to be green, they profess to be ESG investors, and also had a position in Bitcoin. Clearly, Tesla and Elon Musk admitting now that that was wrong. ARK just felt disingenuous when that note came out, and we'll see how long they stick to that messaging to say that it is indeed green or not. But it doesn't necessarily have to totally alter the value of Bitcoin or its argument of whether it can be a store of value or a currency in the future.
No, I would agree that it certainly is not necessarily core to the proposition for why Bitcoin exists and people have chosen to adopt it, except that Bitcoin is based on this kind of idealized future, this engineered idealized future, which presumably would include a more efficient and less polluting form of energy. So I think that's why it runs counter to a lot of the sensibilities, why there are sensitivities around it. But to your point, I mean, if the mission of Tesla in large part has been to free the world from fossil fuels, it's just dissonant to be involved with Bitcoin. Also, I'm sure taking payment in Bitcoin for Tesla was always a little bit of a marketing stunt, and it's inefficient. You probably don't have any real desire to do that long term, except to profess support for Bitcoin as an idea.
So you think Musk is really not accepting Bitcoin for Teslas because of the environmental concerns? I mean, these concerns were not new, and in fact, Musk himself tweeted true to the ARC innovation research that we just put out, and Jack Dorsey retweeting it. I think there's a lot of other theories out there for why Musk may be doing this. New York Times made a good point. SpaceX rockets are massive carbon emitters. And they also had all sorts of speculation as to what could be the real reason why he's made this decision. Potentially regulation around accounting for accepting Bitcoin and the returns around that, where you have to give dollars if Bitcoin is worth more than at the purchase price.
Yeah, that's what I'm saying. It's a totally inefficient way to take payment, and therefore, what's the cost? You know, it was again a marketing stunt. It was not the way you would ever want to transact in real goods, and so this perhaps is the cover story for why it doesn't make sense right now to continue to do it at retail in this way.
Cover story.
Either way, I just think it was so disingenuous in the first place for someone like ARC to come out and try and claim that it was positively green, that it was pro-ESG and the like, when we all know that it's not. Maybe it will be one day in the future. Maybe we'll get there, but it isn't the case now, and it's just very interesting to see one of the most high-profile advocates for both ESG and Bitcoin changes tune on it, and it'll be interesting to see if ARC follows suit.
The ARC Elon Musk split is interesting because Tesla is the biggest holding in the ARC funds, and they're usually pretty simpatico here when it comes to these things. Now the entire Bitcoin community is up in arms against Elon Musk, which is also an interesting sort of split. Who would have thought he was the one to sink Bitcoin here? We'll see where that price goes. We've got just less than 30 minutes to go before the bell, 28 minutes or so. Here's where we stand in the markets. Big comeback we're seeing. The Nasdaq's now up 1%. It actually went negative briefly at one point, giving up some of its earlier gains. The S&P's up 1.6%. Every sector is positive right now except for energy, which was the outperformer yesterday. And the Dow is near session highs again, up 570 points. We're still on track, though, for deep declines for the week. So the question is, should you be looking to buy the pullback? We're going to discuss with Citigroup Chief U.S. Equity Strategist Tobias Lefkovich next on Closing Bell.
bouncing back after a big sell-off on Wall Street yesterday. Major averages are higher for the first time in 4 sessions. The Nasdaq continues to underperform, though, slightly today. It's up 1%. Joining us now is Tobias Lefkovich, Citigroup's chief U.S. equity strategist. And Tobias, you had put out a new target, which was lower than where we are in the S&P 500 right now, I think around 4,000 or so. So do you see more pain ahead, that this correction continuing?
Unfortunately, I think we're still not going to have an answer on issues around inflation, for example, for several more months. I think we're going to have this kind of chop. We have the answer, and we're in the view of stickier inflation than the kind of transitory commentary of the Fed or some of the bulls. In that issues like solving some of the supply chain factors. Think about you can't put up a fab in 3 months to resolve that. You can't get lumber and trees growing overnight. So some of these things, labor costs, these are company after company are talking about these things as being real issues that aren't going to just get resolved quickly. And that's, I suspect you're going to probably want to sit on the side of bond yields, probably edging a bit higher, inflation expectations higher. And that ends up being more of a financials versus technology call. And your comment about NASDAQ being much more of an index.
Your connection is a little shaky. So you like banks over tech. Shouldn't industrials be doing better if this really is a more lasting inflationary story? They're not doing too hot this week.
No, I think, look, a lot of investors are worried about some of the cyclical names they may have run too far. They have the same idea when they think about kind of the travel hospitality perspective. But on the other side of that, what you'd also suggest is that the amount of recovery is going to be probably greater than what we've seen in the past. For example, with consumers with $2 trillion plus of incremental savings, they're going to go out and want to party a little bit. If you think about the need for capital spending, if we are going to get things like infrastructure policies kicked in, you're going to need more equipment that's just sitting around available to you. So I would argue you're going to continue to see some of the better stories out of the CapEx opportunity. Now, technology is a CapEx beneficiary. The problem is that they have been substantial winners over the past year. And in some cases, the stocks ran a bit too far as people got overly excited.
Do you fear that can now unwind and that there's more downside, or do you think we found a little bit of a bottom today?
Well, we may have found a bit of a bottom today, but again, I think the kind of proof of the pudding is going to be what does inflation look like, not over the next month, not going to get resolved the next week either. It's more over the next 4 or 5 months. And as you get closer to August, September, think about the things that you've got to address. You have to address the inflation potential issues and higher bond yields. You have to address what will the Fed be saying around Jackson Hole, what's with the budget and taxation, what's going to happen with debt ceilings. All these things are going to coalesce around August and September, and they're kind of challenges for the market to resolve. So could you get a little bit of bounce because people overshot, in a day or two? Yeah, but I'm an investor. I'm not a trader.
Is there any part of tech you like, Tobias? Because you've got the semis with their own sort of secular growth story, and they're having a nice move today. You've got the mega caps, which are seen as a little bit more defensive, like the FANG stocks, and then of course more the hyper growth momentum names. Or are you just staying away from all of it?
So look, we like large cap over small cap in this sense, and your point about maybe they're higher quality in the bigger cap names, they have the ability maybe to buy back their own stock and things like that when things pull back. So they're probably a little bit better place to kind of, if you want to hide out in tech. And I'm not saying hide out, but I'm trying to suggest on a relative basis they look more interesting. I think in the hyper growth area, that's where you have the real problem around bond yields potentially moving higher and really hurting the terminal value, the kind of long-term value of the company as discount rates move higher. So they were the ones kind of almost in the sniper scope. And as there's attitude change towards potential inflation lasting a little bit longer, those probably are not going to kind of delve into this. They're not cheap when lead times revenues. And that's the kind of stuff you got to worry about.
Tobias, thanks so much for joining us. Much appreciated. Coinbase is gearing up for its first earnings report as a public company, and it comes on a wild day for crypto. We'll preview what to expect next in the market zone. As a reminder, you can always watch or listen to us live on the go on the CNBC app. Closing bell back in a couple. We are right near session highs.
Still seeing the markets here kind of grind into the end of the day. Positivity across the board, which is fantastic. The Dow up significantly, up 555 points. I think it down 600 or so yesterday, so it's bouncing back full force. The NASDAQ, good day, not completely bouncing back from yesterday and still very far off from its for the week and from its all-time high that was set 2 weeks ago. Still 6.5% off of that, but we're seeing crude continue to drop. 10-year treasury yields continue to drop. So a few just, cost of living type things, I suppose, are dropping. Lumber, yes, is down right now again to $14.53, down 13-14% from its high. So overall good day, but a highly volatile week. I think that's going to go without saying. Highly volatile week. Some of the meme stocks did really well. AMC, of course, I got out from under and sold today, which I'm super excited about. GameStop had a good day. Express, Naked Brands, a lot of the others had a good day as well. Some of the others didn't have as hot of days. BlackBerry, Bed Bath & Beyond, Nokia didn't really do as well today as some of the other meme stocks. Let's see. Hey, Zoom. Yeah, Zoom.
Just over 15 minutes left in the trading day. We're now in the closing bell market zone. Commercial free coverage on all of the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've got Hightower Chief Investment Strategist Stephanie Link with us as well. Let's kick things off with the broader market. Stocks at session highs, major averages higher for the first time in 4 sessions. The Dow on track for its best day since March 5th. We are up 1.7 on the S&P, still down 2.3% on the week as a whole. Mike, great little intraday bounce and close to the session highs. Talk us through some of the key levels and where we stand.
Yeah, it often happens after we get a little bit of a flurry of volatility that the market trades a little bit technically and has these sort of high sensitivity areas. I think today was, as soon as we got the sort of reflex bounce in the morning in the S&P 500, you went up toward yesterday's opening level, which was the high. Didn't quite get there. Now we have to go back down below. Didn't get to the opening low. It's that kind of ping pong. And right now, it looks like the market's on target to close just about where it started the day yesterday. So take back yesterday's loss, leave it at a kind of level of maximum indecision because you don't know if it was just the reflex bounce. So I think all of it is a healthy process. Bigger picture, for weeks, you've had people the correction below the surface. You've had people doing a little more hedging. Exposures from very high levels have perhaps come in a little bit, and parts of the market got oversold, and that's what we're working through today.
Down 2.5% or so for the week on the S&P. Steph, are you spooked by inflation? Are you making any adjustments in your portfolio?
No, I think it's kind of funny that everyone is so obsessed with inflation and is it transitory, is it not transitory? I mean, obviously parts of it are transitory. I totally understand that, mainly on the commodity side, I believe, other than lumber and copper. I think those are still in very strong demand trends. But I think that the biggest issue on inflation is wages, and I'm just watching it right now, right? I mean, it started with the non-farm payroll numbers, average hourly earnings of 0.7%, expectations for negative 1.1%. So big upside surprise there. But I'm just like anecdotally talking to companies and talking to business owners. Wages are going up. People and companies have to spend more to get the workers in the door. And that's not going to change anytime soon, right? So we heard from McDonald's, we heard from Chipotle, we heard from Marriott. And then again, I've talked to a lot of small and medium-sized business companies, and they're saying the exact same thing. So that, to me, I'm not worried about it so much because we do have the productivity piece of the economy. We have the technology part of the economy that will be a governor on it. But I think it is actually going higher. And it's not going to be runaway inflation, but it's going higher. And so, yeah, I've been focusing more on the financials for that reason, for cyclicals for that reason, because I do think the reason that inflation is going up is because growth is better, and that's a good thing.
So, Steph, do you think we can now kind of forget about inflation? Is that what today's action is showing, at least for another month until we get to the next print? Or if there are little signs, little flickers of it coming out of earnings calls or wherever else, will that start to spook people again?
I think it probably will, Wilf. I mean, the more we hear about it, the more we observe it, the more we experience it. So this week, I think people will start to get a little bit more worried about it. But you're right. We have another month of like kind of easy comps, if you will. And then let's see what happens in the summer months, right? And as the base effect kind of normalizes a little bit. But that's when you're going to get the real tell. But again, wages are 70% of inflation, right? And that is the biggest piece and the biggest concerning piece. So that's why we have to worry about it. Unit labor costs are zero, but they are going to go higher. How much higher? I don't know. That's why we're watching it. But that's why that's exactly why the euro-dollar futures are now pricing 80% chance of the Fed tightening in the second half of 2022, up from 60% just earlier this week alone, right? Because they obviously see better growth, a little more inflation.
Well, it certainly has hit technology. The NASDAQ slightly underperforming today, even with the gains for the major averages. In fact, earlier briefly dipped into the red as high-growth tech stocks remain beaten down. SoftBank CEO Masa Son joining CNBC earlier this morning and weighing in on the pressure in tech.
I think it's just a volatility based on the people's view on long-term interest. And some inflation and interest rate may go up. It's not the change in the company's performance. The fundamentals is very strong. Our companies are all growing. Tech companies are all growing. They have a record high profitability and so on.
Mike, spoken like someone who has large investments in a lot of these technology companies, obviously, but he does make a point, and that is it has more to do with the interest rate outlook than necessarily anything changing in the fundamentals of those companies. So the question is, how do you value them now, especially the ones that are seeing high growth that we've seen over this earnings season and sold off sharply?
Yeah, the real high growth names that are these younger companies attacking huge markets that got capitalized at high levels, that came public. There was a massive supply of these new names, whether it was through IPOs or direct listings or SPACs. And they are now, I think, being revalued. I mean, I was joking earlier, if you look at a lot of the consumer kind of growth tech names from just a few months ago, they've gone from 20 times revenue to 10 times revenue. That was Bumble today. That's DoorDash. All those in those categories. And, you know, that's not to say 10 times revenue is cheap, but it was just a matter of kind of resetting the level a little bit here. One interesting piece of the SoftBank style approach. First of all, it's venture type. I mean, they have these massive, huge winners that pay for a lot of losers, even if they're in public companies. But the idea that you could capitalize a company that could spend so much in marketing and just get more consumers before the other guys can, and just like use your losses to your advantage, that's under test right now, because a lot of those types of companies are not really being loved by the market right now.
Steph, clearly, as we've been discussing, tech has pulled back. Have you topped up in a meaningful way any of your favorite names in that space?
I actually have, well, I have a barbell, right? So I have liked semiconductors and semi-cap equipment for a really long time. They're still attractive on valuations, but they're actually very crowded. It's a very consensus long. So on the margin, I've been actually trimming some of my semi-cap equipment names. Still own a lot of them, still overweight that part of technology. The other part of technology that I think is interesting is kind of like the value tech, like the IBMs and the Ciscos of the world. They're fairly new positions for me in the last month and a half or so. But I think the valuations are really attractive. I think IBM, I mean, I love their cloud strategy, and it's totally unappreciated. It trades at 12 times earnings and gets you over 4% dividend yield. Cisco, I think as we reopen, enterprise spending is going to recover. They're going to generate a ton of free cash flow. I bet you next week when they report, they're going to increase their buyback program. So I like that one too, and you get a 2.74 yield. It's a little more expensive at 16 times, but certainly not as expensive as some of the semi-cap equipment names or any of the real high flyer expensive growth stocks.
You've been trimming Google, though, as well. Is that right?
Yes, I did. I did because, and it really was only because last week it was up 37% year to date. I mean, it's a phenomenal company. I'm still overweight the name, but I'm underweight FANG, by the way. And by the way, I'm also underweight tech in general. But I think that with Google, they just did a great job the last couple of quarters on operating leverage, and digital advertising is certainly on their side right now and recovering quite nicely. But I'm kind of looking at some other names within like that FANG complex, even in the expensive tech side of things. If they continue to pull back more substantially from here, that's where I think consensus is, people are very much involved in emerging and expensive tech. But I think everyone's saying, okay, quality tech is going to outperform expensive tech. And when those expensive techs get less expensive, they kind of get interesting to me. So I have a little bit of dry powder to be looking at some of these other names.
Coinbase is set to report quarterly results for the first time since going public, and it's coming on a wild day for Bitcoin and for Coinbase. Coinbase's shares are down 20% since its market debut back in April, of which 9% of that's coming today. The street expecting earnings of $3.09 a share and revenue of $1.81 billion. And Mike, I mean, clearly it's not coming on a good day for it. The first quarter's numbers sort of already out there, or relatively speaking, clearly guided to, and it'll be guidance going forward, but also given Elon Musk's comments last night, no doubt people will be eager to hear any comments on the earnings call about Bitcoin, about its green nature and whatnot.
Right. I mean, the stock has traded terribly since the direct listing, on almost straight down. It was a ton of preliminary excitement, both in crypto themselves as well as in Coinbase, because the business was just running so hot and looked so great in terms of the numbers. So I think it will just continue to be largely about sentiment toward Bitcoin. I would be on alert for anything that Coinbase might say about whether regulators, or if they get any questions about whether regulators have taken a closer look at crypto exchanges and tried to figure out more rules of the road there, because you are seeing some reports in that general direction, not specifically about Coinbase. So all those things, I think, are in the mix right now. But, you know, you never know. It could be a great quarter that reminds people the business itself is really good, even if it's crazy expensive based on, you know, current revenues.
Well, will that matter, Steph? I mean, clearly there's a ton of enthusiasm for Bitcoin on both sides, and that's good for a company that makes money with transaction fees. But do those fundamentals matter when Bitcoin is down because of an Elon Musk decision?
I think it does matter, but look, adoption in general is just increasing, right? I mean, we not only have you know, we've got FIS actually just announced a news, a partnership as well. Square, PayPal, MasterCard, really like real companies that are embracing this whole thing. So adoption is increasing. That's very good. Transaction fees, that's the problem I have with this story, because it's 96% of total revenue. I want to see that diversify. That being said, market share is almost 12% versus 5% just a couple of years ago. So they are certainly doing the right things. And again, as adoption increases over time and more broad-based, I think that they will benefit. I don't own it. I'm not involved. I don't have any Bitcoin exposure, but I do think this is a fascinating story. And this is the gold standard.
Gold standard, the Bitcoin standard. Disney earnings are also out after the bell today. Yeah, Julia Borston with a preview. Julia, what do we expect?
Well, Sarah, the question is whether Disney can continue to grow its streaming division, which thrived so much during the pandemic. Analysts are looking for the company to add more than 14 million Disney Plus subscribers for those revenues back to the pre-pandemic levels. Analysts do expect revenue to decline by 12% from the year-ago quarter, and earnings to drop by 55%, though earnings estimates range so widely because there is so much uncertainty here. Now, going into earnings, 71% of analysts have a buy rating, a quarter of analysts have a hold rating. Guys, back over to you.
All right, Julia, got most of that. Thank you. Julia Borston. Disney trading up, though it's flat to down for the year so far. Steph, what do you do with this name into earnings?
It's expensive for good reason, right? It's because it's a turnaround story, but it's also a stay-at-home story, and they're delevering, and they have, obviously, it's just high-quality company. So I own so many reopened names at this point. This is not one of them, but I think the whisper number of 110 million Disney Plus subscribers is the number, right? And then the other question we have is Netflix saw a pull forward, right, in their quarter. So it is the same thing happening on the OTT side for Disney as well, and they are playing catch up. They have they should have about 163 million total subs if you include Hulu and you include ESPN Plus. So let's watch to see if they saw some pull through. And then the second thing is parks. They opened up California at the end of April. What does that look like? What's that trajectory? So I think I know why it's expensive. I just own other reopened names that maybe are a little less loved, if you will.
Mike, less expensive than it was, as earnings should pick up, and it hasn't been soaring in the same way it was for much of the couple of years leading into this year.
For sure, but right now, if you look at a kind of an enterprise value to to cash flow, it's pretty much a Netflix valuation for the entire company. Remember, the company includes ABC Network, it includes parks, it includes selling T-shirts. It's not just a streaming business. It's kind of got valued that way because it's in this elite, American eternal brand type portfolio. Plus, they completely did figure out streaming, and everyone is justifiably excited about that. So I think that's why it's a little bit of a struggle on the valuation side. Yes, there's definitely leverage inside as parks open up to actually have earnings get back toward normal and better. But it's not like the overall company, based on this current valuation, is going to be swung that violently in that direction just by the parks.
Mike, 2 minutes left. What are the internals showing us?
A little bit less than meets the eye under the surface in terms of the market breadth relative to where the indexes are trading. Certainly positive on the New York Stock Exchange, 2.5 billion shares to 1.75 billion on the downside. But it's been kind of more mixed than you might expect. It's a very indexy move, people trading the indexes as opposed to shopping across the board for individual stocks. Take a look at new 52-week highs and lows on the NASDAQ. And there you see pretty lopsided to the downside, more than 200 new 52-week lows, just 58 new highs. So it's clearly still a churn and a struggle below the surface. The volatility index was a story yesterday and really all week. We do have a spike on this chart, not a completed one, but we did get up well above 25, now down a few points from the high. That tends to mean the market settling down and probably on firmer footing to come, but you'd want to see more of that premium drain away. As I mentioned yesterday, a tremendous amount of hedging going on this week. That's probably net bullish once we get out of this choppy period, but only know in retrospect when it's over, Sarah.
All right, 1 minute left to go before the close. Take a look at the markets. We are off the session highs, but still having a nice rally. There's the Dow. It's up 451 points. Every Dow stock is higher except for the energy stock, Chevron, which is lower. Home Depot adding to the Dow's gains the most, 55 points with a 3% gain. 3M, Honeywell, JP Morgan also doing quite well. If you look at the S&P 500, it's also coming back strong, up 1.25%. Still down for the week, but does look to break a 3-day losing streak. Financials and industrials are your best performing sectors, along with utilities. Although everyone's higher except for energy, the NASDAQ is higher by 0.75% into the close. Earlier, it had given up its gains, went negative, has come back. You are seeing groups strong inside the NASDAQ, like the semiconductors, the chip stocks, some of the big cap tech like Apple and Microsoft, and small caps also come back 1.7%.
Welcome to the closing bell, everyone. I'm Wilfred Frost, along with Sarah Eisen and Mike Santoli, CNBC senior markets commentator. Well off the session lows at the close. The NASDAQ up 0.7%. It had been briefly negative for a brief part of the session around 2 p.m. S&P 500 up 1.2%. The Dow up 1.3%, albeit off its highs, 433 points compared to about 600 points at the high of the session. In terms of what remained in the red throughout, ARK Innovation ETF down 2.4%, rounding out a 9% decline so far this week. Tesla down 3%, 15% lower so far this week. Bitcoin as well, worth pointing out, closing just below, well, not closing, it's still trading, but is just below 49,000. Oil prices also declined 3.5%. Investors now turning their attention to quarterly results from Disney, Airbnb, DoorDash, and Coinbase. We'll have instant analysis of all the numbers as soon as they are released. Stephanie Link from Hightower is still with us, and Tiffany McGee from Pivotal Advisors joins the conversation. Mike, to you first of all, and I guess summing up today's action is great intraday bounce, but not everything took part in it.
Yeah, clearly we relieved a little bit of the pressure from this 3-day sell-off, and it was definitely a little bit noisy because of the give and take, because you did have these waves of people doing a little bargain hunting and then taking it back a little bit. What was clear though is once again pretty much a cyclical tone to things. So the overall S&P 500 looks like pretty lukewarm bounce given the declines of the prior 3 days, but you did have equal weighted financials, industrials, and consumer discretionary. The average stock in those sectors up 2.5% or so today. So that's double what the overall index did. That tells you it's a similar story in terms of what leadership of the market is. The macro message haven't changed. We didn't get a lot of credit stress with this little pullback in stocks. This is the fourth 3 to 6% pullback we've had this year. Maybe it's just steady as she goes and a choppy rotation.
And Mike, if you look at some of the new 52-week highs or all-time high list today, there weren't that many, but there were a few consumer staples on that list. Mondelez, Hershey, Tyson Foods, people loading up on more defensive type stocks.
Yes, I would say that loading up on them, I mean, I don't think this has been like a real steep trajectory on those, but definitely they've firmed. And it seems like, you know, there's been a little bit of a defensive tone that's come in. I mean, if you look at biotech's been very weak relative to the rest of healthcare. So I don't know that there's much of a story there, except they are inflation beneficiaries. At least some of them could be a way to play the rising price levels.
Tiffany, what's your take on the action of this week? Nice bounce today, but still significantly lower week to date.
Yeah. So listen, you know, we've always expected volatility kind of creep in as we're really entering this, you know, reopen kind of phase, which is really kind of stretching out. Although we did just hear that news a couple of hours ago that people who are, you know, fully vaccinated can kind of freely move around without masks. So I think that's a good thing. So, you know, what we're doing is just really, again, you know, diversifying our equity positions, really to kind of weather whatever volatility is gonna continue to kind of creep in, and we do think that it is. Again, you know, we love the high growth tech stocks, and I know that, you know, they've struggled a bit, but we still continue to like them. We're also incorporating value and also dividend stocks as well. So, you know, it's fine. We don't manage. We're not managing portfolios from day to day or week to week. You know, our clients are more long-term investors, so we're really managing things, you know, years and years out, 5 to 10 years out.
Let's get to the first earnings result of the afternoon. Airbnb, and Deirdre Bosa's got the numbers for us. Hi, Dee.
Hey, Wilf, it is a beat on the top line. Revenue coming in at $887 million versus $714 million expected. That is growth of 5% year over year, stands in contrast to the double-digit year-over-year declines from Booking Holdings and Expedia. Loss per share, $1.95. This is not comparable to the Street's estimate. We are still sorting through this, and this may be what is hitting the stock right now as investors try to digest this. It includes some one-time offs, including an impairment charge as it consolidates its headquarters in San Francisco. Let me move on. The gross booking value coming in better than expected at $10.3 billion. Average daily rate, $160. That is up 35% year over year. The company warning, though, that the average daily rate could fall in the future and that they have limited visibility for growth trends in the second half of 2021, mostly on Europe uncertainty. There are some interesting trends here. They are seeing more longer-term stays that made up about a quarter of bookings in the first quarter, more growth in family and group travel. Guests, they are booking further in advance. And guys, this is key here. Supply, they say, is increasing in non-urban areas, but overall, Airbnb says that active listings are consistent with the last quarter. That's Q4 of 2020. So we know that this has sort of been a fierce battle to get more listings on the platforms. It's competing with Expedia's VRBO in this space. So we'll continue to watch that. But shares right now are down more than 5%. I'll continue to dig into the bottom line. Back to you.
Deirdre, thanks so much for that. Mike, I mean, the gross booking value, the revenue overall, better than expected, but clearly reacting the shares to some of those individual one-offs.
Yeah, and just very sober comments about what's to come in terms of moderating the expectations for growth down from here. This is a market that's just not that receptive to, you know, we'll make it up down the road on volume. That, you know, these companies have already been pretty suspect, and Airbnb falls into that realm of huge addressable market, great brand, growing really fast, tremendous number of customer connections. We don't know about profitability long term.
Let's get to Coinbase, reporting results for the first time as a public company. Kate Rooney with the numbers. Kate.
Hey there, Sarah. These are the official Q1 numbers for Coinbase. They had given us the preliminary earnings before their public listing back in April. Coinbase with a huge jump in revenue in the quarter thanks to this crypto bull market we've seen in the first quarter. Total revenues coming in at $1.8 billion. We don't have a comparable number for that. Net revenue was $1.6 billion. Almost all of that, $1.5 billion, was from crypto transaction fees. So that is still making up a majority of the business. GAAP earnings, meanwhile, came in at $3.05 for the quarter. Coinbase now has 56 million verified users. That's up about 55% from the same time a year ago. In the first quarter, the company added 3 million verified users. And guys, there's a line in here about competition. I want to bring you that. Coinbase saying that, quote, our competitors are supporting certain crypto assets that are experiencing large trading volumes and growth in market cap. that they don't currently support. They say that they welcome these challenges and they indicate the market is growing rapidly. They also continue to move quickly to address them, and they say that it inspires them to towards some action and growth. Guys, that is likely a nod to Robinhood offering Dogecoin. Coinbase does not offer Dogecoin right now. They have that asset has seen a massive run up lately. And finally, guidance. They gave 3 tiers or sort of scenarios based on market conditions and the price of Bitcoin, which is down big today. It did fall below $50,000. Shares of Coinbase down slightly. They are also down about 38% from the 52-week high. Guys, back to you.
Okay, Rooney, Kate, thank you. And Jim Cramer will break down some of the numbers and the outlook with the CFO of Coinbase tonight on Mad Money. A few other things I would just to highlight in this Coinbase results, 8,000 institutions. So that's clearly been an important growth spot for this company. And as far as guidance within those 3 scenarios, they say so far this quarter, we've seen a continuance of the strong crypto price cycle, high levels of volatility and high interest in crypto across retail and institutional. And they say so far this quarter, performance across business metrics are trending to meet or exceed Q1 results. So they're offering some strong guidance there. The stock is off 2.5% or so. Tiffany, do you want to take this one? Is it all just dependent on Bitcoin's prices and momentum, which is currently down today because Elon Musk is no longer going to take it for Teslas?
I think in addition to, listen, Coinbase gets the majority of their revenue from transaction fees. So I think that's very important. But I also think that, regulations are very important too. And that I think is going to be one of the major risk factors to the entire crypto industry. So we're playing Coinbase, we own it. And our clients are more so institutions. And I noticed we talked about institutions and how they're investing in Coinbase. And it really, crypto, it really depends on what type of institutions you're talking about. So pensions are not investing in crypto. A lot of foundations, like the ones that I work with, are not investing in crypto. So, our purchase of Coinbase was a way that we can kind of participate in the market without having to, participate in buy crypto and really be subject to its volatility. So that's how we're playing it. But really, we're also watching these regulations, which we think are going to come into play, and it's going to be
hedge funds.
Right. Yeah.
No, hedge funds and insurance companies, I think, are 2 institutional sources of growth. Disney earnings are also out. We need to get to those. Julia Borston with the numbers. Julia.
Disney's earnings beating estimates by quite a lot. Earnings coming in at adjusted earnings coming in at 79 cents per share versus a 27 cents estimate. Revenues coming in a bit lighter than expectations, 15.61 billion versus expectations of 15.87 billion. You see the stock is trading down in after hours, and that seems to be because the Disney Plus subscriber number, which is a closely watched number, smaller than expected growth, coming in at 103.6 million subscribers to Disney Plus. That's lower than the 109 million Disney Plus subscribers that Wall Street analysts had been looking for. So that does seem to be putting pressure on the stock. But there are other areas here, certainly in terms of bottom line performance, where the company performed far better than anticipated. I'm going to continue to dig through these results, and we'll be back in Fast Money with a first on CNBC interview with Disney CEO Bob Chapek. Guys, back over to you.
All right, Julia, looking forward to that interview. Thank you very much. Steph, the miss on subs, is that why the stock is down?
Yep. Well, I guess the revenue miss for one, for sure, is always disappointing. Disney Plus, the subs were disappointing. 110, there were whisper numbers higher than that, by the way, Sarah. And then I'm looking at ARPU. Disney Plus ARPU is down 29%. And the other thing, which is strange, because they actually raised prices in the quarter. So it's just, I wonder if that means that they're actually seeing more churn. And we saw exactly the same thing at Netflix. They saw a pull-in, right? Because of stay at home. So these guys have an offset. We talked about it before. They've got parks, right? They've got film. So it's not a disaster. But this is why the stock trades at the premium that it does. And everyone got really excited about streaming in general. And I think it's time to take a pause.
Mike, there was definitely a take that perhaps Disney was still earlier in its stage of growing subscribers, streaming subscribers, than Netflix, and that there wasn't so much of that pull-forward growth that we started to see come out in the last couple of quarters for Netflix. This might start to paint the opposite picture.
Right. I mean, I think it's still, percentage-wise, still a faster rate of growth in terms of net adds than Netflix right now. But I do think also it's a little bit of payback for just how incredibly beyond expectations the growth was up to this point. So they just accelerated. They hit multi-year targets in the first year, it would seem. So I think that's why you have this moderation of trend. And, you know, the stock, as I said, it's been kind of on the defensive for a while, trying to digest that huge move through 2020 and just not really necessarily valued to absorb this right now. I don't think it's much of a story changer, but it definitely is. It explains why the stock has been heavy for a bit.
Well, it's still up more than 70% over the last 12 months. Tiffany, what do you do with this stock down 4.4% after hours on this miss in revenues and particularly Disney Plus subscribers?
Well, you continue to hold it, you know, so when we think about the Disney story, you know, we're thinking about three things: streaming, parks, and film. And, you know, we just mentioned, you know, the streaming story is pure magic, right? So hitting 100 million subscribers within the first 16 months of launching, when it took Netflix to do 10 years to do the same thing. And then, you know, also, when we're talking about Disney and streaming, we're also talking about Hulu and ESPN, right? So by the end of their fiscal year, across all of their platforms, they had 146 million subscribers. And, you know, I'm not totally surprised about their miss. You know, Netflix did the same thing. So for us, again, we're long-term investors. So we're totally fine here. It really is an opportunity for us to buy a little bit more. And when we think about parks, you know, parks are still closed. Before the pandemic, parks represented about 30% of their business. So, you know, parks in California, Paris, and Hong Kong are closed, but, you know, some of them, I think Florida, Japan, and Shanghai are open with limited capacity. So when the world really does open back up, there's going to be a pop, we think, in parks. We're thinking maybe like first part of next year. And then, of course, with film, they have plans to release several movies before the year is out. So, you know, we're really bullish on Disney, and we think it's a buying opportunity right now.
And we will leave the conversation there. Thank you very much for joining us, Tiffany McGee, Stephanie Link. Good to have you both on. Up next, much more reaction to Disney subscriber miss when we are joined by an analyst who thinks the stock can rally another 20%. Plus, value investor Scott Black says the market is still very expensive despite this week's pullback, but he will name two stocks that he thinks look cheap right now. That's coming up. Closing bell back in 90 seconds.
DoorDash's results are out. Deidre Bosa's got those for us. Hi, Dee.
Hey, well, so far, little evidence of a slowdown at DoorDash as the economy reopens. Revenue beat $1.08 billion versus $993 expected. That's up nearly 200% year over year. So that growth continuing. Gross order value holding up also $9.9 billion. That's up 222% better than expected by nearly $1 billion. Loss per share, 34 cents. Unclear if that is comparable, so we'll dig into that. Also, and this is key to why the stock is perhaps popping some 6%, raising guidance, gross order volume for the year, raising it to $35 to $38 billion. Adjusted EBITDA guidance raised to $0 to $300 million. That was previously $0 to $200 million. For Q2, also raising guidance, GOV guidance, that's gross order volume, 9.4 to 9.9, and adjusted EBITDA guidance for the second quarter, 0 to 100 million. There's also some comments in here, guys, about Dasher supply. So they also have been affected by a labor shortage. They said it was affected. They saw a shortage due to better than expected demand, severe weather, and the stimulus impact. But the company says that that shortage was resolved by the end of the first quarter. And that's interesting because that's in contrast to what we're hearing from Uber and Lyft. They're still dealing with their own driver shortages. Lastly, Wilf and Sarah, just want to mention that Airbnb did manage to go briefly positive, I think, as investors sort through that bottom line and some of those one-offs. However, just falling slightly underwater by about 1 1/3% at the moment, already, just hovering, kind of going in from gains and losses. So we'll continue to dig in and bring you that. Back to you.
Dee, thanks so much for that. Airbnb recovering some of its losses, DoorDash jumping nicely. And don't miss, by the way, Jim Cramer's exclusive interview with DoorDash's CEO. That's tonight at 6 p.m. on Mad Money.
Disney shares are falling after hours. The company missing on revenue and subscriber growth, coming in lower than expectations. The earnings call just moments away. Joining us now to talk about the report is Heather Musnick of Musnick Media Consulting. She's also the former Senior Vice President of Content Partnerships at Hulu. It's good to have you on, Heather. That number was a miss, 103.6 million Disney Plus paid subscribers. Do you think they're vulnerable to the same kind of phenomenon that affected Netflix, which is this during the pandemic, it pulled forward so much demand?
Yeah, I think that is part of what's going on. And I think part of what is happening today, they so overshot their expectations in terms of what their performance was, performing 5 years worth of growth in the first year, that it is a little bit of pull forward and a little bit of the success with pent up demand and with coming out of the gate with a great product. But I wouldn't take this as any long-term signal that Disney Plus and Disney streaming services more broadly is slowing down in terms of their ability to acquire new subs and to retain them. They are for sure going to have to start to switch from just an acquisition game, which is what they've been playing for the last year and a half since launch, to more of a balance between acquisition and retention game. And that is a new muscle that they need to learn that Netflix has a lot of history on. So it is. It's something that we can continue to watch, but I don't think that it's really a very big signal that this is a major slip.
Let's bring in Ivan Feinseth into this conversation from Tigris Financial. Covers the company, has a buy rating on the stock, $220 price target. Ivan, anything that changes your view here on Disney? It was a revenue miss and a sub miss, but there was some strength under there as well, and it's a lot of optimism around the reopening in the parks.
Absolutely. You never want to see misses on, especially a key metrics in the situation like subscribers. But, there's so many things that are going on that will help Disney. And you got the parks reopening, you have theaters reopening, studio reopening, and the halo effect that the company has from their content to drive park visits, merchandise sales. So I think that this pullback is a buying opportunity. They did well. They survived well during the pandemic, and they will do exceptionally well in a post-pandemic environment.
Heather, what did you make of the Hulu numbers? And the pricing there was pretty attractive.
Yeah. I would expect Disney to start to lead Hulu and Disney Plus. When you look at when you look at the retention of the bundle of Hulu plus ESPN plus plus Disney Plus, you start to see retention that actually exceeds the gold standard of retention, which is Netflix. So I think that Hulu is kind of the secret sauce for Disney to learn and to grow in terms of their prevention. And outside the U.S., they have a similar play that they're executing on right now by launching Star as part of a bundle. And I think it's going to really help Disney overall with the growth their streaming services globally and compete with Netflix in a world where kids-focused service alone is not going to stand. Is not going to appeal to the entire population, although they've been pretty good at getting at least half of the streaming subscribers so far.
Heather, thank you. And that's from a former Hulu insider. Shaky line there. Heather Musnick, we appreciate it. Ivan Feinseth, thanks to you as well. We'll send it now back over to Mike Santoli for a closer look at earnings expectations. Mike.
Yes, Sarah. In fact, longer-term earnings expectations. This chart shows the long-term expectations for S&P 500 companies collectively. Now, this is not a number that a lot of analysts or investors necessarily spend a lot of time thinking about 5-year forward earnings expectations. This is annualized anticipated earnings growth. But you see here how it shot up to about 15% recently for the coming 5 years. That seems like it's super bullish and basically all the companies are thriving, which is true in the moment. But I also think it acts as a little bit of a sentiment gauge because right in here was 2018, 2019. It was after the corporate tax cut. People thought that we had multiple years of very fast earnings growth to come. Was not the case, of course, once we got into that late cycle and then the crash. And also here, if you go to early 2014, there was an earnings recession here. So I would say that basically people are getting a little bit overconfident perhaps in projecting earnings multiple years, even if right now the forecast revisions are relatively positive. Take a look at this other dynamic in terms of how we're valuing different sectors. Industrials forward PE is now exceeding that of tech. So this really tells you the story of this market after many, many years where tech really was known for being the expensive, if fast-growing group. We have industrials right now that are far more favored, and even materials are getting up there, guys. You could argue that those earnings estimates are going to go up to justify it. We have to wait and see, though.
Yeah, wow, and it's not like the tech PE there has pulled back that much either. It's just a massive surge for industrials. Mike, thank you. The home builder ETF up more than 100% over the past year, but value investor Scott Black thinks one stock in that industry looks very cheap. His pick coming up next. Plus, much more on this wild hour of earnings when we get reaction to results from Coinbase and Airbnb. Coinbase falling on the back of its report. Airbnb volatile after hours. Closing bell back in a couple. Stocks are bouncing back today following yesterday's big sell-off, with the Dow finishing higher by 433 points. Let's bring in Scott Black from Delphi Management. Scott, great to see you. Thanks for joining us.
Thank you for having me, Wilfred.
So we fell about 4 to 5% before today's bounce from the recent highs. How much would the broad indices, we'll get to your stock picks in a moment, how much would the broad indices have to fall for them to look cheap to you?
Well, the multiple right now, based on even 185.90 and bottom-up earnings, is still a 22 PE. But the offset to that is, yes, it's high by historical standards, but interest rates were never this low. You know, you have the 10-year right now closing at 1.65%. So we're sort of in uncharted territories. But as you know, Wilfred, we're bottom-up stock selectors. We don't buy the market or the ETF. I mean, the NASDAQ itself is very expensive. It's 39 times trailing and almost 30 times forward earnings. What's interesting is that about 6 months ago, the 2,000 and 2,500 were much cheaper. Today, they're more expensive than large caps, or roughly the 24 PE. So most of the bargains have disappeared in the small and mid cap.
What about those big cap tech stocks that do have genuine earnings and have really kind of grown into themselves in recent years, but have been affected by this recent pullback? Of the FANG names, the Microsofts of this world, if you had to pick one of them, which would it be?
Well, we've owned Apple since it was a value multiple, so I would continue to own Apple. They have, you know, well over $100 billion in cash on the balance sheet. It's bulletproof. It's a great franchise. It's not cheap. Even if you back out the net cash, I still think it's about 27, 28 times earnings. What's interesting, we own most of the semiconductor capital stocks, AMAT, Lam Research, MKS, KLA. They're going to have great earnings acceleration over this year and next year as wafer spend has gone way up. But they're all somewhere between 17 and 20 times this year's calendar earnings. We normally buy things under 14. We continue to hold them, but they're very good franchises and they're below market multiple at this point.
Want to get to some of your picks, Scott, and I think one is a home builder, which I always find interesting because you do pick home builders, but they have had such a tremendous run up already amid the boom in the housing market. So why would you go there for a value pick?
Well, we've owned Horton and Lennar for a long time. We've also owned MI Homes, but this company has done a great job. The stock closed today was up nicely. It was $67, but they're going to earn between $10.75 and $11 this year. It's a 6 PE. It's ridiculous. The company generated over $75 million in the first quarter in free cash flow. They earned last year 22% return on equity on an annualized run rate. They're earning 25% return on equity. It's only 1.4 times book on a deleveraged balance sheet. And they're going to sell roughly 8,100 homes. They're mostly in the Midwest, where they have a very good position, and also in the Sun Belt. But they're the top three in lots of markets like Columbus, Ohio, Cincinnati, Chicago, Detroit, and even in Florida and Tampa. And it's a well-run company. And of course, the question is, what happens? You know, input costs like lumber have gone up, but they've been able to pass it through. The average price of their house is about $430,000 in backlog, slightly up from about $400,000. And the typical customer is either a first-time buyer or a move-up buyer. And actually, the cancellation rate has still been very low, only about 7 or 8%. That's people who sign the purchase and sales but aren't able to get financing. But as you know, interest rates, mortgage rates, the conventional today closed at 305, which is an APR at 3.27%. By historic numbers in the post-war era, this is very, very low, and it makes affordability much better for the average citizen.
So that's MHO. Scott, give us your other pick today. It's property related, but with a twist.
Yes, it's a REIT. It's called Global Medical REIT, GMRE, based in Bethesda, Maryland. For people looking for yield, this got a solid balance sheet and cash flow. It's got about a 6% yield, about an $830 million market cap. We figured that the NOI this year, which is net operating income, will grow nicely to about $102 million. The actual revenues, because you have to, you know, NOI is after you take out property expenses, is growing almost at a 20% clip. They started the year with about $1 billion in investable real estate. Their goal was to add $200 million in properties, which they've already added $100 million with a stabilized cap rate of 7.4%. If you look at the internal rate of return based on their own NOI divided by capitalization, it's around 7.5%, which is very good compared to many REITs who are selling at 5 and 6% internal cap rates. Mostly it's medical office buildings, and that's about 62%. That's outpatient. They have about 21% of their facilities are rehab, 7% are surgical. And if you look at it by geography, the biggest concentrations are Texas, Ohio, Florida, Arizona, and Pennsylvania make up almost 50% of the book. And the occupancy right now is 99.1%. So it's a good business. We got an aging population. Many people are going to outpatient facilities. And for example, in Boston, around Route 128, Mass General has all sorts of outpatient facilities. And I'm sure this is occurring, throughout the United States. So people, tend to get sick. They have to go visit the doctor. The credits they have been very good. They've had 0 defaults. They have basically 145 buildings with 117 different tenants and 3.8 million square feet nationwide. So for somebody who's looking for some income, which most people are desperately looking for without having to buy a junk bond, I think you got a pretty good business. It's a double-digit grower, and you got a 6% yield.
Oh, thanks for making the case. Scott Black, return to you for some of those value picks. Appreciate the time.
Thank you, Sarah. Thank you very much.
Coinbase shares are lower after reporting its first results since its IPO. We will get reaction from an analyst with a whopping $650 price target, an Uber bull on this stock. Welcome back. Time now to get you a CNBC News update with Leslie Picker. Leslie.
Hey, Sarah, that's right. As President Biden walked to his Rose Garden podium in the last hour, he was maskless, in keeping with the CDC's new guidance that fully vaccinated people generally don't need to wear a mask outdoors or indoors.
I think it's a great milestone, a great day. It's been made possible by the extraordinary success we've had in vaccinating so many Americans so quickly.
Earlier today, the masks were on as Biden started his meeting with some Republican senators looking for a compromise on his infrastructure. Senator Shelley Capito says she thinks a deal can be found and reported that everyone in the meeting took off their masks after the CDC announcement. Also in the last hour, a New York Times report that a group of conservative activists and a British former spy had a campaign to discredit people in the Trump administration they thought might be enemies of the then president, including National Security Advisor H.R. McMaster. The Times said Project Veritas ran its operation out of a large rented house in Georgetown, using female undercover operatives to go on dates with FBI employees and others, hoping to secretly record them saying negative things about Trump. And tonight on the news at 7 Eastern, a top House Republican who is rattling a lot of cages over cybersecurity in the oil and gas industries. Not one to miss. Back over to you, Will.
Certainly not. Leslie, thanks so much for that. The earnings calls for Coinbase and Airbnb are set to kick off in just a few minutes. Coming up, more reaction on those companies' earnings and the stock reaction. As you can see, DoorDash is higher by 8%, the others lower. We're back in a couple.
Shares of Coinbase slipping here after reporting results just moments ago. That conference call kicking off at 5 p.m. Eastern time. Here to break down the numbers is Gil Loria, Director of Research at D.A. Davidson. Really likes this stock. Gil, it looks like the numbers came in pretty much in line with expectations. Profits surged. The monthly transacting users more than doubled in the quarter, and the outlook was strong. So what's the issue here?
I don't think there is an issue. The quarter was fantastic, as they pre-announced a few weeks ago. And most importantly, they said that the second quarter is shaping up to meet or exceed the results from the first quarter. That is far above anybody's expectations right now. So expect expectations and estimates to go up very significantly tomorrow as everybody starts flowing those numbers through their models.
Are they agnostic to which particular cryptocurrency their customers are buying and selling? And what do you think we might hear on the call following Elon Musk's tweet about Bitcoin last night?
That's right. Coinbase benefits regardless of what crypto asset is being traded. And quarter to quarter, sometimes it's more Bitcoin, sometimes it's more Ether, sometimes it's other type of crypto assets. So that's one of the unique investment features of investing in Coinbase, is that they're diversified across those crypto assets. Another really important note is they benefit from volatility. So even though Elon Musk knocked the price of Bitcoin down by talking about its environmental features, that's great for them. That's a bunch of people selling on their platform, paying a transaction fee. So as long as there's a lot of volatility and a lot of transactions and interest in crypto, Coinbase is going to do very well.
Gil, thanks so much for joining us. Coinbase moving higher by 1% after hours, though after a big sell-off during the session.
And on that note,
today.
Wilfred, 39% of their volumes are in Bitcoin, 21% in Ethereum. Those are two of the biggest, obviously. So the rest of the 40% does reflect some broader interest in other cryptos. They just don't have Dogecoin, which they even say in the release they missed out on from some of the competition from not offering everything.
Either way, it's going to be a very interesting call, that one, given all of the headlines of late and the big pullback in Bitcoin during today's session. Airbnb was lower by about 4 or 5% after hours. It then popped a little bit. It's down only 1% now, well off that initial move low, as you can see at 4 p.m. We'll dive into that move with an analyst who's very bullish on the stock. That's next. Airbnb ticking lower on the back of earnings, while revenue increased 5%. Its net loss tripled as we await the conference call. Let's bring in Bernie McTernan, analyst with Needham. He's got a buy rating and $210 price target. Bernie, good to see you as always. Thanks for joining us. So why the initial kind of gut check on the shares and then recovery from there? What's your take?
Yeah, look, I mean, stocks in general haven't been working when they report, but the numbers at Airbnb they just reported are really strong. Estimates are going to be going higher off this, and what it's showing, with the 30% beat in bookings and then better than expected EBITDA, is that the recovery is happening and it's happening profitably. The commentary on the 2Q margins of being break even to positive was really good, and that sets up for even a better second half of the year. So with all these unprofitable tech stocks trading off, Airbnb, by you can't put a multiple on near-term profitability yet, but they're getting closer, and we think they have the potential in the consumer marketplace sector to be a leader in margins.
My sort of two-part question, because we only have time for one more, Bernie, is about pricing power and how much Airbnb has and how much some of the other hotels have, and competition, because the other hotels are also gearing up for this huge surge in demand for travel. So how do those two factors play out for Airbnb?
Yeah, no, it's a great question. And really why we're so bullish on Airbnb is just the amount of organic demand that they have to the platform. 90% of their users coming in are through unpaid channels. And if you just look at the Google Trends too, it just dwarfs their competitors in terms of the amount of people they have on their platform. It's just a really strategic asset that gives them pricing power and just a lot of consumer mind share and wallet share. We think they'll be a share gainer with the recovery.
Bernie, thanks so much for joining us. We appreciate it.
Thanks for having me.
That was clever, Sarah. Way to ignore our producers. 2 questions in one.
I totally heeded their orders.
I know, you did. Now I'm breaking them even further. We're getting some news from Disney's earnings call. Julia Boston has that for us. Hi, Julia.
Well, Bob Chapek, Disney CEO, just announcing 2 additional sports rights deals, which will not just bolster the linear network, but also ESPN Plus, announcing an extension of the deal with Major League Baseball through 2028, with the option of streaming some of those games on ESPN Plus. Also announcing an 8-year deal with La Liga, that's the Spanish Football League. All of that intended to bolster the options there in that ESPN Plus streaming service. Back over to you.
It's no Premier League, though. The NBC still has, parent company. Much more important.
Then you see a surge in the stock. It's still down 3% after hours. Up next, after 17 years with Coca-Cola, NBA champ LeBron James is now the face of rival Pepsi's new energy drink. We've got his exclusive comments on why he made the switch next.
Up next, your earnings rundown. It's been a busy afternoon session. Shares of Disney falling thanks to some weakness in a key metric. We'll explain when Closing Bell comes back. Plus, LeBron James discusses his switch to Pepsi after a long endorsement deal with Coke. That story too, coming up next. We are all over this busy earnings season, including Disney, Airbnb, and Coinbase. And here are some of the other big names moving after us. DoorDash higher on a revenue beat. The delivery company also raising gross order volume guidance. Aurora Cannabis slipping despite a beat on revenues, and Plantronics plummeting. The company topped revenue estimates, but did say it's being hit by the chip shortage, down some 16%. By the way, don't miss on Mad Money tonight with Jim Cramer, his all-star lineup of guests. The CFO of Coinbase, the CEOs of DoorDash and Sonos. That's at 6 p.m. Eastern Time, as always, this evening.
Meantime, LeBron James is out with his first commercial today with his newest endorsement partner, Pepsi. After 17 years with rival Coca-Cola, he was the face of Sprite. He is now helping PepsiCo launch an energy drink line. Four-time NBA champion spoke exclusively to CNBC's producer, Jess Golden, about what drew him to the energy drink category.
More than the energy drink, I think the concept behind the energy drink is what I gravitate towards. And the narrative behind it is rising above self-doubt, rising above the occasion, rising above obstacles, rising above people that don't believe that you can do certain things. And that's what resonated with me more than anything.
This deal with Pepsi came as Coke was looking to shed costs, though we don't know the full backstory. James did say because of the pandemic, hasn't had a chance to meet Pepsi's CEO.
That opportunity of meeting the CEO and meeting all the great people at Pepsi. As far as the creative side, definitely involved in that. You know, you're very, can do that through email, can do that through some, certain Zoom calls and things of that nature, but heavily involved because my name is attached to it.
Heavily involved. LeBron James, clearly one of the most marketable athletes out there. Analysts say it's a big win for Pepsi as they look to grow energy. And of course, I wanted to bring you the market share breakdown because this is not the soda wars anymore. It's the non-soda wars. And energy is one of the fastest growing beverages. Here's how it shapes up right now. So Red Bull and Monster dominate, and that's notable because it's neither Coke nor Pepsi. Coca-Cola does have a 17% stake in Monster, so I would say that they're leading, but the third one, Bang, is distributed by Pepsi. The fourth one, Rockstar, was just bought by Pepsi. So this is clearly a battleground for these two companies. And what Pepsi's trying to do here and put LeBron in front of is Mountain Dew, which they claim was the original energy drink, but it wasn't allowed to have as much caffeine because they had this deal with Rockstar, which didn't let them boost caffeine. Now they can do that. They're positioning it, Wilfred, as an energy drink for the mornings. So like instead of coffee, you would have an energy drink. That's what the commercial.
Mountain Dew.
The Mountain Dew. The new drink,
and
LeBron's going to be the front man.
So do we expect?
It's only 25 calories, I think.
Really?
Yeah.
Do we expect some bespoke drinks with his name specifically on it, or he's the face of the brands that already exist?
He's the face of some of these newer, low-cal, high caffeine energy drinks. Not sure more than that. He obviously is going to be working very closely with them. They are starting by launching this, which, as I just laid out, is a pretty important category for them to try to dominate and take from some of the market leaders. But he was in front of Sprite. He was the face of Sprite for so long. So,
Sarah,
big change.
In my typical role of taking it back multiple decades, I immediately thought, and now we're talking about energy drinks as distinct from sports drinks, but, Michael Jordan, Be Like Mike, early 90s Gatorade ads were, viral before there was viral. And, that was also before Gatorade was owned by PepsiCo, but still, it's in the PepsiCo portfolio now. So it's fascinating to me that it's energy drinks as opposed to what you would consider sports or exercise drinks.
Right. No, it's pure caffeine.
Yeah.
Right. Always good for a throwback, Mike. Thank you.
Mike, pivoting to the markets, final minute of the show. I guess Disney probably the most high profile of the after-hours movers.
Yes, I would say so. I don't know that it's necessarily going to have, coattails to the downside just because it's a pretty singular story in terms of Disney in general. It continues the pattern of pretty poor responses on a net basis to earnings. And in general, I think the market kind of held where it need to. It looks a little bit like a relatively tame bounce in a somewhat tame pullback for now, but have to see how that develops. As I mentioned before, it's not about credit, it's not about the macro story. It's really about what are we going to pay for earnings here, and are people full up? So resetting sentiment is probably the main thing the market's been up to the last couple of weeks.
And some swings. Look at Coinbase; it's now higher by 2.5%.
Yeah.
It was down more than 4% on those initial results.
Yeah, stretched pretty tight to the downside, bullish. You would think. Yeah.
Lots of after-hours movers, more analysis coming up throughout the evening on CNBC, but we're out of time here on Closing Bell. Fast Money's next.
I'm Melissa Lee, and this is Fast Money. Tonight's trader lineup: Guy Adami, Tim Seymour, Dan Nathan, and James McDonald. Tonight on Fast, we are all over the after-hours action. Shares of Disney. That stock moving lower on the back of earnings. The company's call is underway. As soon as that call wraps, we will hear from Disney CEO Bob Chapek. He will join us in a first on CNBC interview straight ahead. Plus, breaking news out of Fisker. New details crossing the EV maker's deal with Foxconn to build cars here in the U.S. Fisker's CEO joins us exclusively. And later, we're breaking down the bounce. Stocks rebounding from yesterday's big sell-off. We'll tell you how our traders are playing today's turnaround. But we start off with an earnings alert on Disney. Let's get straight to Julia Borson with all the details. Julia.
Well, Melissa, Disney earnings far surpassing expectations. Earnings per share grew 32% to 79 cents instead of falling by 55% as analysts had anticipated, though the company's revenue came in a bit light. But as you see that stock dropping, it's slower than expected streaming subscriber growth that seems to be weighing on Disney shares right now. The company grew Disney Plus subscribers to 103.6 million, but that's lower than the 109 million Disney Plus subscribers analysts anticipated. On the call just now, though, I have to note that Disney's CFO said that subscriber growth in the third month of the quarter was faster than growth in the first 2 months. Now, on the earnings call as well, CEO Bob Chapek just announced 2 new sports rights deals that will bolster the library of content on ESPN+, including an extension of its deal with Major League Baseball through 2028, with the option to simulcast all live MLB coverage for ESPN networks on ESPN Plus, as well as an 8-year deal with La Liga, that's Spanish League Football, covering both English and Spanish language rights. And as for the future of the theatrical movie business, after 3 movies this summer that will be distributed simultaneously in theaters and on Disney Plus for a $30 fee, Disney announcing that it will give an exclusive 45-day theatrical window for 2 upcoming films, Ryan Reynolds' Free Guy and Marvel's Shang-Chi and the Legend of the Ten Rings. So we'll have to discuss all of that and more with Disney CEO Bob Chapek, who, as you mentioned, Melissa, will be joining me as soon as that earnings call wraps. Back over to you.
We look forward to that. Julia, thank you. We'll see you in a few. Let's get the trade on Disney here. Guy, kick it off.
Well, I mean, Tom Rogers says this all the time, and Rich Greenfield just tweeted it, so I give a HT, is that what they call it, a hat tip to him. But, you know, in terms of subscribers, they have half the amount of subscribers as Netflix, but 1/6 the revenue. So, as Tom has said a number of times, not all subscribers are created equally, number one. Number two, you know, ARPU, Tim can speak to that, for Disney Plus was disappointing. Street was expecting $4.10. It came in at $3.99. That's trending in the wrong direction. That sort of lines up with my earlier statement. Valuation now at 175, the stock's trading 35 times next year's numbers. I think the market is trying to consider that. Where do you buy the stock? Final point. 162 is a 50% correction of the recent low, that 120 low, and that recent high that we saw of 203. So I think it might actually get there. That's where you draw your line in the sand.
Tim, yesterday we talked about the forward PE of Disney, which is about 61 right now. A lot of that PE gain had been on the back of the hopes for streaming, and here we are in a situation where subs just didn't come in as high as forecasted. So is this right for Disney to be down 3%? Maybe it should be down more.
I would have thought it'd be down more. I actually think this is a pretty good show as a Disney shareholder, and I think this is about expectations. I think on March 9th, when we heard from the company that they were over 100 million subs, the entire street reset their numbers even higher, even though we just heard that the third month of the year was a lot better than the first month of the year. Like I could also say that Disney's got half the amount of subs as Netflix in 1/20th the amount of time, and so ultimately for Disney, also the ARPU. Guy, a great point. It went from 563 down to 395, and a very disappointing even relative to the 410. It was expected to decline, but they're nowhere near bringing in the top line from the DTC business as Netflix. But remember the Disney business strategy, and remember that the media and the content and essentially the distribution company is there also to be a lubricant for the experiences business. And a case where whether it's parks or cruises or experiences, this is what Disney's always done. And the fact of the matter is their content and their content spend is going to rival anybody's over the next couple of years. So I think if you value this on a multiple of DTC on a sales number, which a lot of people used to do for Netflix, and then you throw the core business on an earnings multiple, if you listen to JP Morgan, it's a $220 stock.
So maybe I'm being obtuse, but when you say that, I understand that it's part of this whole, driving the ecosystem of Disney, Tim. But when we say that, are we also sort of implying that part of that gain in PE, that it shouldn't be that much of a gain because it's the accretion should really be towards the other parts of the business? So the comparison is not fair at all when you're saying the comparison of Disney streaming business versus Netflix in terms of a PE.
Well, first of all, Netflix PE doesn't make sense at all.
Yeah,
and Netflix's PE's never made sense. They've never made money. They burn cash. So my point is that Disney ultimately, what they proved with their studio is that it was a flywheel for 3 other core businesses, including consumer products and themes and experience. I'm just saying that ultimately this is why the profitability inherent in Disney's model is a lot better than it is in Netflix model. And meanwhile, Netflix has more competition than ever. So it's clearly, I'm not would you rathering, but relative value, I just did, didn't I? But Disney ultimately is to me a very different story. I'm just saying that I don't care that their DTC streaming business isn't as profitable right now.
Yeah, I guess my point is that, the argument for Disney streaming business to have a little bit more of the Netflix PE may be a little bit false, Dan, because you're not really looking at it. You're looking at it sort of like, I don't want to say a loss leader, but a way of boosting the other parts of the business. You're not looking at it as a standalone business.
Well, you're not now because it isn't the main part of the business. That's why it's kind of apples to oranges.
Yeah.
We've been talking about Netflix versus Disney Plus for years, and it doesn't make a whole lot of sense. I think the way that Tim has laid out his bullish thesis for the last few years does make sense, and thinking about it from a flywheel. I would also add that, look at that Hulu did beat on the subs, and when you look at, I think Julia just told us they renewed some sports deals. I think that live deals, programming is really important for that Hulu property, and so to me, I think that should be beneficial. Listen, Guy kind of laid it out here. It broke out the prior high. Last year Q1 was about 150 or so. It broke out that 150 to 160 range. It probably heads back there. Listen, just a few weeks ago, I was thinking when the stock was in the mid 180s that you'd have a push back on that kind of reopening trade towards that prior high at $200, and now it just feels like it's kind of in no man's land here. And I don't really think it's about PE. I think that sounds, I don't mean to sound obtuse, and I know on some shows or in some movies I'll get you thrown in the hole for calling somebody obtuse here. It just feels like we've kind of crossed the Rubicon on valuations here. We didn't care on the way up, but we seem to care on the way down. And I know we're going to talk about some of these high valuation names later. So this one, should probably hang out in that 170 to 160 range, in my opinion, for the near term.
What do you think, James?
I love coming last because I get to borrow everybody else's points to make mine. Starting with Guy, the fib levels here, a 50% retracement from the recent range puts us at 161.5. In this market where valuations have been bonkers, energy for buying has been unabated, and every asset around the world is swelling up, you got to look at technical charts. We can't look at fundamentals. We can't look at historical references. We have to look at things referencing the environment. And in this environment, looking at the charts gives us some clues. We saw last week a breakdown on Bitcoin that followed through. We've seen some other technical weaknesses in big names. And Disney is a company that's going to be successful no matter what, but it carried itself into 2021 on the coattails or flywheel, to Tim's point, of this streaming business. And with it being a strong brand, a Dow component, everyone's favorite, Mickey Mouse has been around for generations. It gathered subscribers faster than anyone else in the world could have. It got priced into the stock. Now it's coming into potentially a transition into a late cycle. We all know my bear suit has been fried, but this is definitely late cycle. We have to assume Disney's going to get pressure with the rest of the market. Parks are opening. Netflix is there. The competition's there. Disney is not going to be continuing its path because of the market environment, but I think 161.5 is right for what Guy's saying. But then to the other point, as markets get choppy, we've all been in institutional desks. We've all seen what money managers do. There's got to be a rotation out of the heavy stuff, out of the technical, out of the speculative stuff into names in the Dow, names you can count on. Disney's going to get support at some point where other companies aren't because it's a big, strong Dow company.
All right, we'll keep track of Disney. It's down 3.7%. And a reminder, we've got CEO Bob Chapek of Disney coming up straight ahead on the program. Meantime, we got breaking news here on Fisker. The stock is soaring right now, up 18%. The EV maker announcing final details on its deal with Foxconn to do the final assembly of its cars right here in the United States. Let's get to Phil LeBeau live with the CEO of Fisker. Phil.
Thank you, Melissa. Let's bring in Henrik Fisker, the CEO of Fisker, joining us from California. Henrik, let's be clear. You are finalizing the deal today, but you made it clear back in February that this deal was essentially in the works. You signed a memorandum of understanding with Foxconn. Now that the deal has been inked, are you planning to build these vehicles at the Foxconn plant being built in southeastern Wisconsin?
Hey, Phil, good to see you. Well, of course, this is one of the lead places that we're looking at. The truth is that Fisker, we have received offers from 3 other states for manufacturing, and we have to do proper due diligence as a public company and spend a couple of months reviewing the best option. And of course, Wisconsin is one of the options that's clear, but we will announce the final site probably in about 2 to 3 months together with Foxconn.
Henrik, I'm sure you're aware of, if you mention the name Foxconn to a lot of people in Wisconsin, they will roll their eyes. There are elected leaders in Wisconsin who sit there and say, wait a second, these guys said they were going to be investing several $1 billion in our state. Now it's going to be less than $1 billion. They're not going to bring as many jobs as they originally announced back in 2017. And there's a fair amount of skepticism that Foxconn will ever follow through with building a plant in southeastern Wisconsin. What do you say to people who have a lot of skepticism about Foxconn right now?
Well, we're an American car company. We just, as you know, went public, have still about $900 million in the bank. And this program has now been going on for a couple of months. We signed a final deal, firm deal today. That's important. And, Foxconn, I believe is going to become more and more important in the automotive world, specifically because, as you have seen with the chip shortage, one of the part of our deal with them is that we will never be out of chips. And being a small car manufacturer like us, not having to stand in line to get chips is a big thing. I've spent multiple times on Zoom and Teams with the chairman of Foxconn, and I can tell you this deal is real. We are going to be building vehicles here in the U.S. We are far along in development. The exterior design has been signed off. It's going to be incredibly innovative. So this is going to happen.
Henrik, will you co-own the facility where the vehicle will be built, or will this be a Foxconn facility? And obviously, you guys are going to be one of the first clients building vehicles at that facility in conjunction with Foxconn.
So it's not a usual automotive deal. The way we have structured this deal, and as we also mentioned, is that it's kind of a co-investment where we have divided certain things up that each have responsibility for. So, for example, Foxconn will own the factory. We will own the tooling. We, of course, brand the vehicle, design the vehicle, market and sell the vehicle. And then we are doing profit sharing on this vehicle. So it is a joint investment. However, Foxconn is owning the factory. They're also taking a lead in the global supply chain. And as you know, a car is becoming more and more a computer, and Foxconn probably have one of the biggest electronic supply chains in the world. And that's how we're going to be able to drive costs down. And remember, Phil, this is not just another electric car. It's a premium electric car under $30,000. So it is a high volume mass market product that's going to be sold globally.
And I know you said production possibly of 250,000 vehicles. Last question, Henrik. When you announced this memorandum of understanding back in February, your stock was at 19. Coming into today, I think it was down close to $9 a share. It's basically been whacked along with the other EV stocks. There are more than a few cynics out there who look at especially EV SPACs and they say they're a long ways from profitability. Why should I get into them right now? What do you say to those people?
Well, I would say don't put everybody in the same bucket. You know, we have closed 3 deals in less than a year. You know, the first was going public with the Apollo SPAC. The second was the Magna manufacturing agreement with Magna. And finally, now with Foxconn. So one of the things we're doing different than all the other SPACs is we are really lining up to have a complete product portfolio accelerated within only 2 years. So before 2025, we'll have 4 vehicles on the road. You can't exist with just one cool car. You know, I've been in this business for a while. I've had some difficulties and some failures. I've learned from them. And I think our investors understand that we're different. Now, we're going to get put in with everybody else. And of course, you've seen also a lot of movement that has to do with Tesla's maybe sales going down in China. But in the end of the day, I think you'll see a few winners coming out, and I believe Fisker is going to be one of them.
Henrik Fisker, the CEO of Fisker. Thank you, Henrik, for joining us from California on a day, Melissa, when they have finalized the agreement with Foxconn to build a vehicle here in the United States. Exact location remains to be seen, but no doubt you see from the reaction of the stock that investors are looking at this and saying, okay, let's see the next step between Fisker and Foxconn. Melissa?
Yep. Phil, thank you. Phil LeBeau. We see the reaction of the stock in the after-hours session. It's interesting, Henrik Fisker had mentioned the time frame, and it seems like a very fast time frame to get a car out into the public and on the market guide. But at the same time, Goldman Sachs points out that by the time the Ocean all-electric SUV hits the market, there will be a dozen other all-electric SUVs specifically out there as competition.
And Goldman downgraded the stock a few weeks ago, I think, to sell from hold, $10 price target. There's a lot to unravel here. First of all, they're supposed to report earnings on Monday, this coming Monday the 17th. If I had been, you know, one of my questions would have been, wouldn't it have been cleaner just to announce everything at once? That's neither here nor there. With that said, major double bottom around that level that Phil talked about at $9 from the October low. And you just mentioned we were trading 32 at one point. I'm inclined personally to wait until see what they have to say at earnings and see how the stock trades. A lot of people negative in this name. It's had a huge run to the downside, held that low, but you have that catalyst on Monday you got to be watching out for.
It's got 26% short interest as well, James, in a space that has just been grim death in the past few months.
Right. And I go back to the point of look at the environment we're in. Fisker has got a very storied, checkered and interesting background story with this turnaround. It's a car that people will like because it's less expensive than other EV plays. It's a car and it's a manufacturer that will be in the race for this EV market. And I think the environment and the timing right now is going to be challenging for them because we've had so much money made in so many areas. I think there's going to be a propensity of selling this stock as opposed to buying it, given the competition and given the fact that this particular car isn't necessarily going to make as much money as some of the other manufacturers.
All right, up next, we're all over the after-hours action. Shares of Coinbase and Airbnb, both stocks on the move right now after reporting results. We'll break down the numbers straight ahead. And we're just minutes away from our can't-miss interview with Disney CEO Bob Chapek. He's wrapping up the company's earnings call right now. As soon as he's done, he will join us live. Don't go anywhere. Much more Fast Money right after this.
All right, guys, we're going to use this opportunity in this commercial break to sign off. We've had a very, very interesting day. Overall, the markets were positive today. There were some things within the market that were extraordinarily positive and some that were extraordinarily negative. For the most part, especially in the second half of the day, most stocks did very well. Came back from early losses early on. Some of them came back but didn't quite come back all the way. Then there was a few that had some really good earnings reports, or really mixed earnings reports, I should say, after hours, but some of them still had good results. So Coinbase, for example, surged right into the end in the last hour, then had mixed earning reports. I guess revenue was low, but earnings, EPS was high. And so their after hours reaction was good. They're up to 271 after closing at 265. Most of the meme stocks did really well today. AMC blowing everything out of the water, up 23% at a certain point today. I think it was up about 35%. Hits well over 14 there for a brief moment. And of course, I sold all but one of my shares, taking advantage of that. DoorDash also did really well in its earnings report after hours. So a couple of the different stocks that I own had earnings after hours. Cryptocurrencies are up from their lows, but still all having a very down day. So hopefully we will get something going tomorrow. If they're up from their lows, and there's a good chance they might swing northward tomorrow, so that would be a good thing. SafeMoon's been an interesting one. So it's down today, but from what I'm gathering from number of SafeMoons being put into my wallet, there's a lot of people selling over the past 2 or 3 days. Mostly probably in sentiment of the rest of the crypto market. And so that's kind of where we're at. So, they had a extraordinarily negative reaction to Elon Musk commenting Tesla's change yesterday, that they weren't going to accept Bitcoin yesterday. And then more comments today apparently came out as well that they were not going to, that just reinforcing that that statement due to environmental concerns. So just kind of an overall interesting day. But anyway, hopefully we will be back tomorrow. Tomorrow will be the last live stream for this week, and maybe last in a little bit. Next week, I will likely not be doing any live streams next week. They're coming back, so we'll meet them. Airbnb, that was the other news. And they also have mixed reports and that their prices are going up. So I've got DoorDash, Airbnb, and Coinbase, all that I have earning, all I have stocks in, and all doing really well. So anyway, guys, we are going to sign off, and we will see you guys tomorrow.